Hello, hi guys. This is CA Balakrishna. How are you? Hope you people are doing well. Even I'm fantastic. So today we are going to see the audit marathon for CA final for the upcoming Jan 2026 examinations. So before you start watching the marathon session, I want to discuss with you people about how to go with these marathon sessions and how you can best utilize the benefit of these marathon sessions for CA final audit. So firstly, these marathon sessions, they will be uploaded as two parts. So each part will be of around 12 hours. Actually, I wanted all the complete marathon session to be uploaded in one video only, but the YouTube restrictions, they doesn't allow for more than 12 hours. A video, it shouldn't be more than 12 hours, so I have to break it into 12 hours part. So like this, you will get two parts of marathon which are completely updated for Jan 2026 CA final attempt. So if you see the first part, it contains all the standards, complete standards I have kept in first part of marathon session, and the second part contains SRE SAE series and remaining all the chapters. Got it? So this is how the part 1 and part 2 of marathon sessions are going to be. And so here you can see what you can find in part 1 and what you can find in part 2. Got it? So these sessions, you can follow whatever the book you have. Okay, you can follow from ICS study material, you can follow from audit concise book, whatever the book you have, you can follow, because here I will be going conceptually, understanding, and most of the standards, most of the concepts, we will be revising through the PowerPoint presentation. If you have purchased my regular classes, you might be knowing we will be taking up the regular classes through PowerPoint presentations, where you can find the lively images and the lively content. So to help you people, I have taken even the revision classes also through that PPTs only, so that you can remember whatever the discussion that we have made during the regular class. Understanding, even the students who have who have not taken the regular class, you can fully utilize the benefit of these marathon sessions. Understanding. So all in all, the total duration of this marathon session will be around 23 to 24 hours. Got it? And what I would suggest is, before starting any revision of any chapter, you better go through the revision of this you go through the video through this marathon. I will also be giving the timestamps. So when you are reading any particular chapter, you feel like you wanted a revision from the faculty, you can go to that timestamp directly. So in the video, I will be also giving a timestamp. So instead of watching entire video, you can just skip to that particular chapter which you wanted to watch. Got it? And yes, these marathon sessions, it includes all the amendments. Okay, as per the amendments only, I have recorded these marathons. Understanding? Yes. So this is the brief intro that I wanted you people to know. And yes, now you can start. And another thing, these recordings, I have not done all of them at a stretch. Each day I have done some portion, so you might be finding change of my shirt in the videos. You don't get tensed by that. I have ensured that there will not be any portion that will be missed. Okay, only after completing the all chapter, I have ended the video. Understanding? Yes. So yes, now you can start watching the marathon sessions. All the best. The first chapter that we are going to discuss in the today's class is quality control. As you already know, this chapter will have two standards. One is SQC1, standard on quality control 1, and SA220. Right? These two standards, they deal with quality. Now, why quality is required? Basically, if you see, in case of a manufacturing company, this example I will be frequently using to explain this quality control. In case of a manufacturing company, once the product has been manufactured, to verify the it will be verified whether the quality of that product is up to mark or not. Okay, before you sell that product to the customer, you will verify the quality. In the same manner, the quality of the service that the auditor has provided, okay, the quality has to be maintained in the service that the auditor provides. So SA 220 and SQC 1 speaks about these quality related aspects. Okay, yeah, quality control SQC 1 and SA 220, these are the two standards that we will be discussing in the today's class. Now, standards dealing with quality, you already know SQC1 and SA220. Now if you see what is the difference between SQC1 and SA220, to put it simply, SQC1 deals with quality control at the entire firm level, whereas SA220 deals with quality at the audit engagement level. Right now, the CA firm, it will take up various engagements, right? It will take audit engagement, it will take assurance engagement, it will take review engagement, it will also provide various other services. Right now, SQC1 deals with quality that has to be maintained at the entire firm level. That means SQC1 is applicable all these assignments that the entity or the firm takes up, whereas SA220 deals with quality at the audit engagement level, and SA220 is applicable only for the audit engagement level. Okay, at the audit engagement level, in order to maintain the quality, SA220 will be having certain provisions. Okay, now if you see in SQC1 and SA220, both will be similar. We will be discussing certain 6 elements of quality control. Okay, the both 6 elements we will be discussing in SQC1 and SA220, but in SQC1 we will be discussing them from the point of view of the entire firm. Okay, whereas in SA220 we will be discussing the same 6 elements from the point of view of the particular audit engagement. Okay, now if you see the name of SQC1, what it says, quality control for firms. Okay, in the name itself it clearly specifies the firm. Okay, at the firm level, quality control for firm that performs audits. Okay, firm will perform audit, it will also perform review of historical financial information and other assurance and related service engagements. Okay, SQC1 deals with the quality at firm level that will perform all these engagements, whereas SA220 deals with quality control for audit of financial statements. Okay, SA220 is applicable only for the audit. Okay, it is SA220 is not applicable for quality related to all other engagements. Hope that is clear. Next, examples of quality lapses. What are certain examples of quality lapses? Now in the audit report, you will mention a particular line which goes like this: audit report issued under Companies Act 2013 referred to profit in the financial statements. However, audited financial statements reflect a loss. Okay, if you remember in your audit report, you will mention that you have audited the financial statements, and in particular you will mention you have audited the profit and loss statement that shows either profit or loss for so and so year. Now, one of the example for quality lapse is in the profit and loss statement, the company has shown profit, but in the audit report you are mentioning that the profit and loss statement shows loss. This is one of the example for lapse in quality of your audit. Another example, audit report of company referred to cash flow statement. Now in the audit report you mentioned that you have audited cash flow statement, but actually for that company cash flow statement is not applicable. If you see for small companies, cash flow statement is not applicable, right? But in the audit report you have mentioned that you have also audited cash flow statement. Why? Because you have copy pasted the audit report from of other company, so you have mentioned that cash flow statement is also applicable for that company. So this is also one of the example for quality lapse. Next, SQC1 versus SA220, certain differences. As you already know, SQC1 is applicable for firm level, SA220 is applicable for audit engagement level. Okay, SQC1 is applicable for audits, reviews, other assurance and related service engagements, whereas SA220 is applicable only for audits. And responsibility to maintain quality at the firm level lies with CEO or managing partner of the firm, whereas responsibility to ensure quality as per SA220 lies with engagement partner. Okay, engagement partner has this responsibility. And as per SQC1, to obtain reasonable assurance that firm and its personnel comply with the PLR requirements. PLR requirement means P means professional, legal and regulatory requirement. Okay, as per SQC1, the objective is to ensure that the personnel and the firm complies with PLR requirements. Okay, and SA220 is premised on the basis that firm is subjected to SQC1. This is an important point. Now, in order to establish SA220 at the audit engagement level, first of all, the firm should have established quality control at the firm level as per SQC1. Okay, so SA220 is always based on the premise. Premise means assumption that SQC1 has been implemented at the firm level. Hope that is clear. PLR means professional, legal and regulatory requirements. Next. Now we'll start with discussion of SQC1. Till now we have just seen the difference between SQC1 and SA220. Now starting with SQC1, you already know the name of the standard, right? This is applicable for the entire firm level. Now, objective of SQC1. What is the objective of SQC1? If you see, SQC1 is having three objectives. What are those three objectives? First of all, to establish system of quality control. What is meant by system of quality control? System of quality control is a document that will contain the policies and procedures with respect to establishment of quality control aspects at the firm level. Okay, that is known as system of quality control. Okay, you remember that system of quality control means policies and procedures related to the quality. Okay, so establishment of system of quality control is one of the objectives of SQC1. Next, to obtain reasonable assurance that firm and its personnel comply with PLR requirements. This is also one of the objectives which we have already discussed. Next, reports issued are appropriate in the circumstances. Okay, to ensure that whatever the reports the firm issues, they are appropriate in the circumstance. Okay, these are the three objectives of SQC1. Next, what is the system of quality control? Just now I have explained what is meant by system of quality control. System of quality control is the policies and procedures designed to achieve objectives as per SQC1. Okay, now what will be there in this system of quality control? What will be there in this system of quality control is the entire SQC1. Okay, there will be 6 elements of system of quality control. Okay, once we complete discussion of these 6 elements, the SQC1 gets completed. After that, in SA220 also we will be discussing the same 6 elements of quality control, but from the point of view of audit engagement level. Hope you understood this. Now, elements of system of quality control. There are 6 elements of system of quality control. Now, how to remember these 6 elements? In order to remember these 6 elements, you remember this term leadership. Okay. Now, in the leadership, L stands for leadership responsibilities for the quality within the firm. That is the first element with respect to which policies and procedures has to be present in the system of quality control. We will discuss all these 6 elements element by element in the coming slides. Okay. Now I will just list down all the elements of system of quality control. Next element, E. Okay, in the leadership the second term is E, right? So ethical requirements, that is the second element. Next, third letter is A. A for acceptance and continuance of client relationship and specific engagements. Don't worry, we will discuss each of this element one by one in the coming slide. Next letter is D. Now you replace D with H. H for human resources. Next letter is E. E for engagement performance. And finally, you need to monitor all these 5 aspects. That is the 6th element, which is monitoring. Okay, these are the 6 elements of system of quality control, which you can remember by remembering the term leadership. Okay. Now, starting with the first element, what is the element number 1? Leadership responsibility for quality within the firm. Now, tell me, who is having leadership responsibility to implement quality control at the firm? CEO or managing partner? Okay, this point we have already discussed while discussing the differences. See, firm's CEO or managing partner shall take ultimate responsibility for establishing quality control at the firm level. Now, firm's business strategy should not override the quality. What is meant by this line? Firm's business strategy should not override the quality. Now, what will be the business strategy of any firm? Business strategy of any firm would be to earn more money, right? To make more revenue, to get more clients, right? This would be the broad business strategy of any firm. Now, this business strategy should not override the quality. Okay, just to earn money, just to make more and more clients, you should not compromise the quality. Okay, you have to maintain utmost quality in your services. Okay, so in order to maintain this quality in the services, you have to assign management responsibility so that commercial considerations do not override the quality. Okay, you have to assign the responsibility to manage the work to other people who are very much capable. Okay, next, demonstrate the same in designing policies and procedures regarding the firm's personnel. Okay, now while designing the policies and procedures with respect to the firm personnel means human resources. The fourth element is human resources, right? With respect to human resources, you will frame policies and procedures. While framing policies and procedures with respect to the human resources, you have to demonstrate that you are giving utmost importance to the quality. Okay, that means you should implement those policies which will encourage the people to improve quality in their work, which will encourage your employees to improve quality of their work. Okay, next, devote sufficient resources to develop, document and support quality control policies. Okay, you have to have and you have to deploy sufficient resources for developing, documenting and supporting quality control policies. Hope that is clear. This is with respect to the leadership responsibility for quality within the firm. Next element, moving to the second element. What is the second element? The second element is ethical requirements. These ethical requirements we already know. What are the 5 fundamental principles? Integrity, objectivity, confidentiality, professional competence and professional behavior, right? You need to comply with all these 5 fundamental principles, that is known as ethical requirement. Okay, in order to make all the employees of the firm comply with these 5 fundamental principles, you have to frame policies and procedures where in your system of quality control. Okay, see, design policies and procedures to provide reasonable assurance that firm and its personnel comply with its ethical requirements. What are the ethical requirements? The 5 ethical requirements as per the code of ethics. We will be discussing these ethical requirements even in our professional ethics also. See, integrity, objectivity, professional competence, due care, confidentiality, professional behavior. Right now, if you find that any of the person in your firm is not complying with these professional ethics, you have to take not complying with these ethical requirements, you have to take appropriate action, and you should also ask the partners of your firm and employees of your firm to report to your firm at least once in a year whether they are complying with these ethical requirements and whether they are having any threat in compliance with these ethical requirements. Okay, see, policies and procedures to maintain independence. Notify firm if there is any threat to the independence. Okay, if they are facing any threat to the independence, they have to notify the same to the firm and obtain written confirmation of compliance with independent policies at least once annually. Hope that is clear. That is element number 2. Now moving to element number 3, which is acceptance and continuance of client relationship. See, acceptance and continuance of client relationship. That means while accepting a new client, what aspects you have to verify, and also while you decide to continue the existing relationship with the existing client, what aspects you have to verify. There are 3 aspects that you need to verify. Okay, with respect to these 3 aspects, there should be policies and procedures in your system of quality control. What are they? First of all, you need to verify integrity of the client. See, firm should obtain information related to integrity of the client. Okay, integrity of client, promoters and key manager personnel. Integrity means the truthfulness of the client, the honesty of the client. Okay, that you need to verify. If you find that a client is involved in fraudulent activities, the client is involved in some money laundering activities, there are many cases against the client, then you should think once before accepting the engagement. It would be better not to accept the engagement or not to continue the relationship with the client. Okay, after that you should also verify whether your firm personnel, that means your employees, are having sufficient knowledge to discharge the work that you are going to take up. That is competence of your firm. Okay, competence to perform engagement. See, you have taken up an engagement, but you don't have any persons with proper knowledge to complete that engagement, then there will be a serious lapse in the quality. Okay, you cannot achieve the quality in your engagement. So you should also verify competence to perform that work, and compliance with ethical requirements. Before accepting the engagement or before continuing the relationship, you have to once check whether you will be able to comply with all the ethical requirements that we have discussed or not. Okay, so that is element number 3, and still we are having some more points in this element number 3. With respect to integrity of the client, what points you will verify? This is one of the important question. See, matters to be considered with respect to the integrity of the client. Okay, element number 3 says that you have to verify integrity of the client before accepting the engagement or before continuing the relationship with him. Now, in order to verify, what points you will see, let us see. Nature of client's operations and business practices. Okay, client's attitude towards compliance with accounting standards and internal control environment, whether client is interested in complying with laws and regulations, whether he is interested in compliance with accounting standards and internal controls. Okay, you have to verify the interest of the client in complying with all these aspects. Next, whether client is aggressively concerned to maintain the firm's fee as low as possible. In such situation, you have to think whether to accept this engagement or not, because client is always thinking to keep the fee as low as possible. If the fee is very low, there might you might have to compromise on the quality in order to match that fees, right? So you have to think once. Next, indications of an inappropriate limitation on the scope of work. You should also see whether the client is putting any limitation on your scope of work. Next, indications that the client might be involved in money laundering or other criminal activities. Okay, if you find that the client is involved in money laundering or any other criminal activities, then it raises a serious question on the integrity of the client, right? Next, the reasons for the proposed appointment of the firm and reappointment of the previous firm. Now you have been appointed as the auditor of the firm for this year. Now previously some other auditor would have audited the firm, right? Now why that auditor has been removed and why you have been appointed, what are the reasons for that? You should also look into those reasons. Okay, next, still continuing the third element, in verifying the competence of the firm, what matters you need to consider? Let us see. Knowledge of firm personnel in relevant industries or subject matters. Okay, whether the firm personnel is having knowledge with respect to the industry in which the client is operating. Okay, that you need to see. Next, experience of firm personnel with relevant regulatory or reporting requirements. Okay, whether the firm's employees are having experience with respect to the relevant reporting requirements of the client. Next, availability of experts if needed, whether experts are available. Individuals meeting the eligibility requirement to perform EQCR are available. EQCR means engagement quality control review. Basically, in case of listed company audits, after the auditor has conducted the audit, the same has to be reviewed by the engagement quality control reviewer. That engagement quality control reviewer is also a chartered accountant. Okay, he should also be a chartered accountant, but he should not have done the audit of this company. Okay, so whether EQCR is available to review the work after the audit is completed or not, that also you need to check. Next, the firm would be able to complete the engagement within the reporting deadline, whether you will be able to complete the engagement if accepted within the given time limit or not. Even that aspect you need to see while verifying the competence of the firm, the capability of the firm. Okay, see, all this is under element number 3 only. Okay, in element number 3, while accepting the client or continuing the client relationship, you will verify the integrity of the client. So for verifying the integrity, what points you have to check? You will also verify the competence of the firm. For verifying the competence, what points you have to check? Okay, these two are important questions actually. Next, considerations for withdrawal from the engagement. See, withdrawal from the engagement, this situation arises not in the case of new engagement. Okay, if you are continuing the engagement or you have accepted the engagement and you are doing the engagement, and in middle of the engagement you realize that there are various aspects because of which you cannot continue this engagement. Okay, in that situation, what points you need to consider before withdrawing from the engagement? See, where new information is obtained, and if such information was obtained earlier, it would have caused the firm to decline the engagement. Policies in this regard should include the following. Okay, during the audit engagement, the auditor has obtained new information, and this new information is such that if he would have obtained this information at the time of accepting the audit itself, he would have not at all accepted the audit, but after accepting the audit, he came to know about this information. In this situation, what he has to do? See, professional and legal responsibility for the firm to report to the person who made the appointment. Okay, you have to report this to the person who has made your appointment. Okay, you have to discuss them. See, these are the aspects. Because of this, I am resigning, I am withdrawing. Okay, in order to prevent my withdrawal, you please correct these aspects. Like this, you need to disclose and communicate with the person who has made your appointment. And possibility of withdrawal, you should also check the possibility for withdrawal. And you should also, before withdrawing, discuss about the firm's action with the client's management and those charged with governance, including the reasons for the same. Okay, consider professional, regulatory or legal requirement for the firm to remain in place or to report the withdrawal to the regulatory authority. In some situations, what happens is law or regulation will prevent the auditor from withdrawing once he has accepted the audit engagement. One example is SEBI. Okay, basically this point we will be discussing in professional ethics, I guess. Okay, wherein if auditor has not in professional ethics, standard on review engagement. Okay, in SRE series we will be discussing this point, wherein after auditor has conducted quality review of 3 quarters, then it is obligation on the auditor to complete the quality review of 4th quarter and also the entire audit of complete financial year. Okay, until and unless he completes the audit of entire complete financial year, he cannot resign. Okay, so here if you see in this example, SEBI, the authority, is not allowing the auditor to resign or withdraw from the engagement. In such situations, he has to continue the engagement. So before withdrawal, he should consider whether there is any such law or regulation that is preventing me from withdrawal, or whether there is any responsibility on me to communicate to that particular authority with respect to my withdrawal. Okay, these aspects you need to check before withdrawal. Next, documenting significant issues, consultations, conclusions, and the basis for conclusions. Okay, you have to document why you have taken this decision to withdraw from the engagement. Okay, your conclusions has to be documented. Hope that is clear. Next, element number 4. Element number 4 is human resources. Right, now human resources means in the CFM, who will be the human resources? Their employees. Okay, their article assistants, their paid assistants, their employees. Okay, their partners, they are the human resources. So with respect to these human resources, you have to frame certain quality control procedures in your system of quality control. Let's see. Policies to obtain reasonable assurance that it has sufficient personnel with capabilities and competence to perform the engagement. Okay, it has to ensure that it is having competent people to perform the engagement. And policies and procedures shall require identity and role of engagement partner are communicated to the client. Okay, now in the entity there are 5 partners. After you have accepted the engagement of the client, you have to clearly communicate to the client who will be engagement partner for their audit and who will be their audit team. Okay, this has to be clearly communicated to the client. And in the same way, you should also communicate to the auditor, the engagement partner, about his responsibilities with respect to that audit client. See, responsibilities of engagement partner are clearly defined and communicated to that partner. Okay, you should communicate to the client that he is your engagement partner and this is your engagement team, and the firm should also communicate to that respective partner about his responsibilities that he has to discharge. Okay, next, engagement partner has the appropriate capabilities, competence, authority, and time. Okay, quality control procedures should ensure that the engagement partner should have the sufficient knowledge, capabilities, competence, and time to discharge that particular work. Okay, next, engagement performance. Okay, engagement performance means discharge of service. So for performing the engagement also, what quality related aspects has to be followed? You need to design them. See, brief engagement teams of their objectives, processes to comply with engagement standards. Okay, during performance of engagement team you have to brief during performance of audit you have to brief the engagement team about the responsibilities that they have to discharge and their responsibility to comply with the standards for doing that work. And consultation in difficult or contentious matters, you should also brief the team that if in case with respect to any matter, if they have any doubts or if they feel any difficulty, they can consult about that aspect to any person within the firm or with the client or with the engagement partner. Okay, consultation has to be done if any difficulty or any contentious matter has been faced. Okay, next, resolving differences of opinion between engagement team and those consulted engagement partner and EQCR. Okay, there is a possibility that differences might arise between engagement team and the people whom they have consulted in case of difficult situations, and there is also possibility of difference of opinion between engagement partner and engagement quality control reviewer, because quality control reviewer will review the work that has been done by the engagement partner. Now engagement partner has taken a particular opinion, a particular decision with respect to a particular matter, but quality control reviewer says that opinion or that decision is wrong, you have to act like this. Now there is a difference of opinion between these two people. In these situations, how you should react? See, that should be clearly mentioned in your quality control procedure. Okay, in your system of quality control you have to clearly mention, okay, if differences of opinion arises, whom to approach, whose decision will be final. Okay, next, issue report only after issues are resolved. Okay, only after these issues or these differences of opinion are resolved, you have to give your report. If not resolved, follow procedures established by the firm. Okay, firm will establish the procedures in the system of quality control. Okay, in the system of quality control it will clearly mention if there is difference of opinion, what procedure you have to follow in order to resolve the issue. Okay, and engagement quality control review is mandatory for listed entities. See, I'll here only I'll quickly explain about this engagement quality control review, so that I need not touch this aspect in other places. Okay, wherever this engagement quality control review comes in other slides, I'll explain all those points here only. Okay, now see, first of all, this engagement quality control review, what is meant by engagement quality control review? I have already told you, I'll just explain it again. Okay, now auditor, he will conduct the audit. After he conducts the audit, okay, the engagement partner conducts the audit. That audit work has to be reviewed by another person. Okay, that another person is known as engagement quality control reviewer, and this process is known as engagement quality control review. Now such other person should also be a chartered accountant, and he can be either employee of our firm, or he can be partner of our firm, or he can be belonging to some other firm, but he should be a chartered accountant because he is verifying work of a chartered accountant. That is what you need to remember. Next, this engagement quality control review, it is applicable only for the listed entities. Okay, and for unlisted entities it is optional. Okay, if the auditor wants, he can apply this concept of engagement quality control review there also, but in case of listed entity it has to be mandatorily followed. Okay, next, auditor, he should not date or he should not issue the audit report until and unless engagement quality control review has been completed. Hope that is clear. Next, in case of audit, it is the responsibility of engagement partner to ensure that engagement quality control reviewer has been appointed to this engagement. Hope that is clear. Next, now engagement quality control reviewer has been appointed. After appointing him, what will engagement quality control reviewer verify? Okay, now engagement quality control reviewer will review the financial statements, he will review the audit report, he will review the conclusions, decisions that has been taken by the engagement partner and all the engagement team. Okay, all these aspects will be reviewed by the engagement quality control reviewer. And engagement quality control reviewer will also maintain documentation. Hope that is clear. So all these are the aspects or discussion points with respect to engagement quality control review. Next, documentation. Not more than 60 days after the date of audit report. Okay, after the date of audit report, within 60 days, you have to finish the complete documentation. Next, procedures required by firm policies on engagement quality control reviewer have been performed. Okay, you should ensure that the EQCR procedures are performed. Next, EQCR has been completed before the audit report date. Just now I have told you this point. Retain engagement documentation for a period sufficient to enable monitoring procedures. Basically, this engagement documentation has to be retained for a period of at least 7 years. Okay, not less than 7 years. Next, engagement documentation is a property of the firm. This point you already know. Next, element number 6, monitoring. Now the firm, it has to monitor all these 5 elements. Okay, it has to keep on monitoring this system of quality control, because whether the policies it has framed, whether they have been working properly or any updation has to be done to those policies. And you know, new laws and regulations will be implemented, there will be amendments to the standards on auditing, right? So based on those amendments, based on those new laws and regulations, whether the firm has updated his system of quality control or not, it needs to continuously monitor. Okay, if it finds any old provisions, they has to be updated in line with the new amendments. Okay, this is with respect to monitoring. See, firm should ensure that quality control policies and procedures are relevant, adequate, and operating effectively. Monitoring involves, is quality control system properly designed and effectively implemented? Okay, or new PLR developments are reflected in quality control policies. Okay, PLR means professional, legal, and regulatory requirements. Next, entrust monitoring responsibility to partner or other person. Okay, this responsibility to continuously monitor this system of quality control has to be assigned to a particular partner or any other person. Okay, his duty will be to continuously monitor the system of quality control. Next, remedial action against a person who did not comply with the quality control procedures. Okay, if anyone doesn't comply with the quality control procedures, you have to take respective action with respect to that particular person. Next, take action if deficiencies in firm's quality control policies are identified. Okay, during monitoring process, if you identify any deficiencies in quality control policies, you have to take appropriate action. What will be the appropriate action? You have to update that quality control procedure. Okay, so by this, we have completed SQC 1, which is with respect to the quality control at the firm level. Now we'll enter into SA 220. SA 220, which deals with quality control for audit of financial statements. That is at the quality control at the audit engagement level. We'll be completing this SA 220 within 5 to 10 minutes. Okay, the same 6 points will be covering here also. See, SA 220 is premised on the basis that the firm is subject to SQC1. This point we have already discussed while discussing the differences between SA 220 and SQC1. Right. Next, quality control policies of audit engagement are decided by engagement team based upon quality control system of the firm. Okay, you will frame quality control policies for the audit engagement based on the quality control policies that are designed at the firm level as per SQC1. Right. Next, objective is to implement quality control procedure at the engagement level. Okay. Next, responsibilities of engagement partner. Okay, with respect to the quality control at the audit engagement level, what are the responsibilities of engagement partner? See, in SQC1, we have discussed these 6 points as elements of system of quality control. The same 6 points we will be discussing in SA 220 as responsibilities of engagement partner. See, you will find the same 6 points. Leadership responsibility for quality on audits. Who will be having leadership responsibility for quality on audits? In case of audit engagement, the engagement partner will have. In case of a firm, the CEO or managing partner will have. Right, the same point. Next, Ethical requirements, the 5 ethical requirements need to be completed even by the engagement partner for the audit engagement level. Next, acceptance and convenience of client relationship and audit engagement, right? The same point. Okay, at the firm level, firm will verify at the time of accepting the audit engagement the integrity of the client, the competence of the competence of our people of our firm, and whether they will be able to comply with ethical requirements or not. The same 3 points need to be again verified by engagement partner also while doing the audit. Okay, see, assignment of engagement teams. Assignment of engagement teams means this is human resources. Okay, we have discussed this as human resources in SQC1. Next, engagement performance, this is a 5th responsibility. Next, monitoring. All these 5 has to be monitored, right? Now we'll quickly go through each element. Responsibility number 1, leadership responsibility for quality on the audits. Who is having leadership responsibility? The engagement partner. See, engagement partner shall take ultimate responsibility of the quality. Engagement partner shall emphasize on compliance with PLR requirements, that means professional legal regulatory requirements, compliance with firm quality control policies, issuing auditors report that are appropriate in the circumstances, and engagement team's ability to raise concerns without fear of reprisals. Next, responsibility number 2, ethical requirements. You need to comply with 5 ethical requirements. See, identify threat to independence that safeguards may not be able to eliminate, and reporting to relevant persons in the firm to determine appropriate action, eliminate threat or withdrawal from the engagement. Okay, this threat to independence point we have discussed in SQC1 also. Next, responsibility number 3, acceptance and continuance of client relationship. The same 3 points will repeat here also. Okay, responsibility of engagement partner in this regard in an audit engagement is on lines with SQC1. Okay, engagement partner shall consider integrity of the client, okay, competence of the competence to perform the engagement, and compliance with ethical requirements. The same 3 points will be again considered by the engagement partner also for his audit engagement. Okay, next, responsibility number 5, which deals with engagement performance. Now, engagement partner is responsible for direction, supervision, and performance of the audit as per the PLR requirements. Okay, he needs to direct, to supervise, and perform the audit engagement as per PLR requirements. Okay, he needs to direct, to supervise work that has been done by audit engagement. Okay, audit engagement team. Next, engagement quality control review. Okay, these points with respect to engagement quality control review I have already discussed with you, right? The same points will be there here. Now, what will EQC reviewer do? Okay, we have discussed all these points. Next, responsibility number 6, monitoring. The engagement partner shall consider results of the firm's monitoring process as evidenced in the latest information circulated by the firm, and whether deficiencies noted in that information may affect the audit engagement team. See, now the audit firm at its firm level, it will conduct the monitoring. Okay, after it monitors the system of quality control procedure, if any lapses are found, those lapses will be fixed. Now, based on the results of the monitoring of the firm at the firm level, the engagement partner should also update his quality policies at the engagement level based on the results of monitoring that has taken place at the firm level. Okay, he should also monitor the quality control at the engagement level. Hope that is clear. See, this SA 220 is completely dependent on SQC1. Okay, now coming to documentation. Now the engagement partner has to maintain the following documentation. What are they? See, engagement partner need to document issues in compliance with ethical requirements. In complying with ethical requirements, what issues he has faced. Okay, in compliance with independent, what issues he has faced. Results of consultation undertaken. Conclusions regarding acceptance and convenience of client relationship. Okay, engagement partner need to document these aspects. Next, engagement quality control reviewer should also document EQC procedures that have been performed by him. I have already told you, na, engagement quality control reviewer will also have to document certain aspects. Okay, and he should also document EQs you are completed before date of auditor's report or not. Next, reviewer is not aware of any unresolved matters that would cause him to believe otherwise. Okay, he should document that he is not aware of any matter that would cause the reviewer to decide otherwise. Okay, all these aspects needs to be documented. Okay, by this we have completed the discussion of SA 220 and SPC1, and we are also having three authorities which will oversee these these quality related aspect. One is peer review board. Okay, peer review board is a board that has been established by the institute, and the peer review board will conduct a review of audit firms. Okay, in the peer review the peer review will also be done by a chartered accountant. Okay, since it is being done by another chartered accountant, it is known as peer review. Okay, we have discussed this in detail in our regular class. Next, we are having quality review board. Basically, quality review board is established by the central government. Okay, quality review board will verify the quality of the audits that has been done by the chartered accountants. So you should be careful. Okay, the audit that you have done, it is not final. There is a possibility that in future these authorities can verify your audit, and there is also NFRA, National Financial Reporting Authority, which will also verify the audits of listed entities. Okay, so these are the three authorities. By this we have completed discussion of entire quality control chapter, right? And before winding up the class, we have recently launched Lecturepedia app. On this Lecturepedia app, you can practice MCQs of all the subjects. Okay, not only audit, you can practice MCQs of all the subjects of CA Final, CA Inter, and CA Foundation. And apart from these, you can also purchase classes of topmost faculties, all over India on our Lecturepedia app. You can download Lecturepedia app from the Play Store. Okay, in the next class we'll revise another chapter. Until then, take care. Bye bye. See you. Now in this video we'll be revising audit planning and strategy. Basically, essay 300 will deal with this audit planning, right? As usual, we'll be discussing from our PowerPoint presentation. Okay, so audit planning, strategy, and execution. This execution part will not be discussing in this class. We'll be discussing execution part in the next class. Basically, execution is related to SA 315, SA 330, SA 450. Those standards will deal with execution part, that will deal later on. Okay, now basically there will be three stages in audit. You already know those three stages. What are the three stages of audit? First of all, audit planning, next execution, and finally reporting. These are the three stages of audit, right? So in this video we will be covering this first stage, which is planning stage. And the execution stage, various standards deal with execution stage. Basically 300, 315, 330 and 450, and other standards also deal with execution part. Okay, some standards in SA 500 series and some standards in SA 600 series, they deal with execution part, that we will be discussing in the coming classes. And finally reporting stage, basically SA 700 series will deal with this reporting stage. Okay, these are the three stages of audit. Now the basic question, why to plan the audit? See, you have to plan the audit so that you will be able to conduct the audit in an effective, efficient, and a timely manner. What is meant by effective? Achieving your final objective is known as effectiveness. If you plan the audit properly, you will be able to achieve your final objective, right? Next, efficient means achieving the given work with as much as lesser resources is known as efficient. In order to conduct the audit efficiently, you have to properly plan it. And finally, in order to conduct the audit in the given timeline, you should properly plan the audit. Okay, because of this you will plan the audit. Effectiveness means Achieving desired objective is known as effectiveness. Efficient means achieving maximum results with minimum resources. Okay, so because in order to conduct effective and efficient audit in a timely manner, you have to plan the audit. Okay, if anyone asks you why you have to plan the audit, you have to give this reason. Okay, now what are the advantages of planning audit? You will get various advantages because of planning the audit. Firstly, you can give attention to most important areas, and you can also timely resolve the potential problems. Potential means as of now you have not yet identified them, but the problems that might occur in the future can be addressed by you by properly planning the audit. Okay, potential problems can be solved on time. Next, proper organization and management of engagement. Okay, you can properly manage the engagement, and you can properly select the engagement team if you have properly planned the audit. Okay, if you have properly planned the audit, only then you will be if you have planned the audit, you will know in advance which areas require highly efficient people and which areas can be assigned to some junior level staff, right? So based on the audit plan, you can properly select the audit staff or the engagement team, right? And directions and supervision of the engagement team can be done properly with the help of this audit plan. And finally, easy coordination in work done by auditors of components and experts. Okay, these are the advantages that you will get if you properly plan the audit. Okay, next, audit planning involves, basically in the audit planning there are two parts. Firstly, you have to establish overall audit strategy. Okay, after establishing overall audit strategy, based on the strategy, you will develop audit plan. Okay, so the first stage of audit planning is development of overall audit strategy. Based on the overall audit strategy, you will develop audit plan. Okay, so audit planning involves establishing overall audit strategy and developing an audit plan. Okay, now if you see, audit strategy is broader. Okay, and audit plan will be developed based on the strategy. Okay, if the strategy changes, then obviously audit plan will also change automatically. If you see, audit strategy focuses on what and when of an audit. Okay, audit strategy focuses on what has to be audited and when it has to be audited, whereas audit plan focuses on how it has to be audited. Okay, on the how part. Okay, focuses on how of an audit. Strategy is prepared first, and based on the strategy, plan is developed. Hope this is clear. A small example: company plans to launch a new product to increase the sales. This is a strategy. Okay, company wanted to increase the sales. Sales can be increased in various ways. One is increase the sale price, right? Or you reduce the cost of manufacturing, right? Then you can increase profit. Or you launch a new product. Okay, if you launch a new product, then also sales will automatically increase. So this is broad strategy for increasing the sales. You will select any one of this strategy. Okay, you have selected to launch new product. This is the strategy. Now, in order to launch the new product, you have to conduct research and development in that area to identify the new problem, and based on that new problem, you will develop a new product, right? So, in order to achieve this strategy, invest in research and development, production facilities, etc. This is known as a plan. Okay, plan will focuses on how to implement the strategy. Okay, implementation part will be dealt by the plan. Hope that is clear. Okay. Nature and extent of planning. Now if you see, nature means qualitative aspect, like scope of the planning, objective of the planning. Okay, these terms will be used while discussing about nature. Okay, nature is a qualitative aspect, whereas extent means quantitative aspect. Okay, extent of planning means how many resources are required, how much of time is required, okay, to conduct this audit, which employees has to be involved in the audit team. This is known as extent of planning. Still, how many audit procedures has to be performed, even this is also a extent of planning. Okay, extent speaks about quantitative aspect, nature speaks about qualitative aspect. See, nature, qualitative aspect like scope, objective, risk assessment, understanding the entity, all these will come under nature of the planning. Okay, and extent of planning, this involves quantitative aspect like level of detail, timelines, resource allocation for completion of the work. Okay, all these will form part of extent of planning. Okay, now, nature of planning varies. Okay, the nature of planning that has to be done will vary based on size and complexity of the audit. Okay, if the size of audit, that means client is huge, then the nature of planning that you have to done, that you have to do will also change. Okay, you have to extensively verify the tools that you will use will change if the size of the entity changes. Next, the past experience of the auditor will also impact on the nature of planning. See, past experience and expertise. If as per the past experience of the auditor, if he feels that there are many misstatements in this entity, then in this year while planning the audit, he will be very careful in those areas, right? Next, change in the circumstances. If the circumstances has changed, then that also will impact the nature of planning, right? Next, planning is a continuous process. See, at the time of starting the audit, you have planned the audit, you have developed overall strategy and you have planned the audit. And during the audit, if you find any new circumstances or if you know about any new information, then you will have to change the audit plan based on that new information that is available. So planning is a continuous process. It is not that once you plan the audit, you have to do the audit as per that plan only. No. Okay, planning keeps on changing during the audit. That is why you will call planning as a continuous process. See, planning is not a discrete phase, rather a continual and iterative process. It keeps on changing. You need to update it continuously. Begins shortly after completion of previous audit and continues till conclusion of current engagement. Okay, the planning for this audit will begin shortly after completion of previous audit and will complete only after the current audit is completed. Till that time you will be continuously planning. The plan will continuously keeps on changes. Okay, next, responsibility for overall audit strategy and audit plan. See, who should take this responsibility for developing overall audit strategy and audit plan? Obviously, the engagement partner, that is the auditor's responsibility, right? To develop audit strategy and audit plan, it is the responsibility of auditor. See, it is the responsibility of auditor along with the engagement team to develop this audit plan and audit strategy. See, the key members of the audit team should also be involved for developing audit strategy and audit plan. Hope that is clear. Next, auditor may discuss elements of planning with entities management. Okay, once the planning has been done, you can discuss the elements of this planning with the management, but care should be taken that you should not disclose the entire audit plan to the management. Okay, if you disclose your entire audit plan to the management, then there is a possibility that management might take some actions in order to hide the frauds that they have conducted. If they know that you are going to audit that particular area in a particular manner, if you reveal your audit plan, then management might take some steps to hide their frauds. So you have to take care that you will not reveal your plan completely to the management. See, but care has to be taken not to compromise on effectiveness of audit. Hope that is clear. Next, what is the relationship between audit strategy and audit plan? See, audit strategy will be developed first. Next, based on audit strategy, audit plan will be developed. Okay. Next, if audit strategy changes, then plan will also change. If audit plan changes, then strategy will also change. Both are interlinked. Okay. See, audit strategy is prepared before audit plan. Audit plan is more detailed than audit strategy. Okay. Audit strategy, it will be developed broadly, and audit plan will speak detailedly about each and every item. Okay. Audit plan and audit strategy are interrelated. Audit strategy provides guidelines to develop audit plan. Okay. Next, overall audit strategy. See, auditor shall establish overall audit strategy that sets scope of audit, that means what areas has to be covered in the audit, timing of audit, okay, within how much time the audit has to be completed, and direction of the audit, okay, in which area auditor has to spend more time and in which area the auditor has to spend less time, that is direction of the audit. Okay, audit strategy should set all of these. Now, factors that will impact while establishing overall audit strategy. First of all, the characteristics of the audit will impact the way in which overall audit strategy has been developed. Characteristics of audit means what is the financial reporting framework as per which the financial statements have been prepared. Okay, if Indian accounting standards are followed, then the way you will develop audit strategy will change. Okay, if accounting standards are followed, then you will develop your audit strategy in a different manner, right? So you have to see the financial reporting framework. Next, industry specific reporting requirements, whether there is any industry specific reporting requirements. Let's say, for example, in case of banking industry, you have to report on various aspects. There will be NPA reporting, there will be Ghosh and Jilani report that has to be given, there should be interest subvention report that has to be given, right? So based on the industry, the reporting of the auditor, the reporting responsibility will vary. So based on that also the audit strategy will change, because auditor has to verify those areas also, those additional reporting responsibility areas should also be verified by the auditor, right? Next, effect of IT on audit, etc. Okay, the effect of information technology on the audit should also be taken into account while developing overall audit strategy. Next item, reporting objectives. What are the reporting objectives of the auditor? Okay, in case of company, if auditor should also report on Caro, then the auditor has to include this reporting aspect also in his audit strategy, right? If Caro reporting is not required, then he need not include it. If auditor needs to report on this what is that you call, if auditor has to report on internal control over financial reporting, internal control over financial reporting, IFCR. Okay, if auditor has to report over on IFCR, that is internal control over financial reporting, then also the auditor's strategy will change, overall audit strategy will change, right? So you need to consider the reporting objectives, okay, to plan timing of audit and nature of communications. Okay, whether it is Caro or internal controls over financial reporting. Okay, what are the reporting objectives of the audit. That will impact the overall audit strategy. Next, team's effort. See, consider factors that are significant in direction of team's effort. Okay, in which area the highly qualified people has to be deployed, and in which area of the financial statements risks will be there, and high time, okay, more time is required to be allotted for audit of a particular area in the financial statement. Okay, that has to be taken into account while developing overall audit strategy. Next example, materiality, high risk of material misstatement. Okay, these areas will require more team efforts. Next, consider results of preliminary engagement activities. Okay, you should also consider results of preliminary engagement activities while developing this overall audit strategy. Preliminary engagement activities we have discussed in essay 220. Basically, while accepting the client, you will verify for the integrity of the client. Okay, and you will also check whether you will be you are competent enough. Okay, your team is having sufficient knowledge and competence to complete that work, and whether you will be able to comply with the ethical requirements or not. Okay, and you will also see some more preliminary engagement activities in essay 210. Okay, agreeing to the terms of audit engagement. Next, so you should consider preliminary results of preliminary engagement activities in developing overall audit strategy. Next, knowledge gained in other engagements performed by the auditor, even that has to be considered. Example, recurring audits, network firm providing other services, etc. And finally, nature, timing and extent of resources. Example, engagement team selection, budget, etc. Okay, all these points has to be taken into account while developing overall audit strategy. Now, preliminary engagement activities. What are preliminary engagement activities? Procedures required by SA 220 regarding continuance of client relationship. Just now we have discussed integrity of client, ethical requirements and competence. Evaluating compliance with ethical requirements as required by SA 210. Understanding terms of engagement as required by SA 210. Right? These are preliminary engagement activities that you will perform. Preliminary engagement activities means activities that are performed prior to acceptance of engagement. Next, benefits of overall audit strategy. What benefits you will get because of this overall audit strategy? Employment of qualitative resources, allocation of quantity of resources, timing of deployment of resources and management of resources. Okay, basically you can employ qualitative resources and you can decide on timing and allocation of resources with the help of this overall audit strategy. Next, contents of audit plan. Okay, what will be there in this audit plan? The nature, timing and extent of planned risk assessment procedures as per SA 315. Okay, you'll perform risk assessment procedures as per SA 315. Okay, so what risk assessment procedures has to be performed will be there in this audit plan. Next, after performing risk assessment procedures, you will perform further audit procedures as per SA 330. So what further audit procedures has to be performed will be there in this audit plan. See, nature, timing, extent of further audit procedures as per SA 330. Next, other planned audit procedures to be carried out so that engagement complies with SAs. Okay, so other audit procedures required as per other SAs will also be forming part of this audit plan. Okay, basically audit plan will contain all the audit procedures, whether they are risk assessment procedures or further audit procedures. Hope that is clear. That will be the content of audit plan. See, you can find here. Audit plan is record of risk assessment procedure and further audit procedure, RAP and FAP. Can audit plan or strategy be changed during the audit? Yes, obviously audit plan and audit strategy can be changed during the audit. See, auditor can change audit strategy or plan as necessary during the audit. So in which situations you might have to change audit strategy or audit plan. See, result of unexpected events. Okay, if you find any unexpected events, then because of that, if there is a necessary to change audit plan or strategy, you can change it. Changes in conditions of the audit, changes in audit evidence obtained, or change in law, notification, or government policy, that is change in external situations. Then also, if that will impact the audit plan or strategy, you can change audit plan or audit strategy. Okay, note, if there is change in audit strategy, then audit plan also will change, and vice versa. Documentation. So what has to be documented by the auditor? Auditor has to document overall audit strategy, his audit plan, and significant changes that are made during the audit to this audit plan and audit strategy. These three has to be documented. Now, what are the benefits of documentation? Record of key decisions considered to plan the audit, and record of nature, timing, extent of further audit procedures, right? This is a benefit of documentation. Next, can be reviewed and approval prior to the performance, and record of reasons for change in strategy and plan. Okay, if you have changed the strategy or the plan, then audit documentation will act as a record of reasons for such a change in audit plan or strategy. Next, audit program. Now, what is this audit program? We have discussed audit strategy, we have discussed audit plan. Okay, audit plan is more detailed when compared to audit strategy. Now, what is audit program? Now, this audit program is the document that you will give to each member of the audit team. Okay, so what work has to be done by a particular member of the audit team will be given to him through this audit program. Okay, in this audit program will be specific to each member with respect to the work that has to be done by him. Okay, this audit program will have details about how to audit that respective area. Let's say a particular member has been allotted to conduct audit of inventory. Now, how the inventory has to be audited, a detailed checklist will be there in the audit program. Okay, so this audit program will be given to that particular audit team member. Hope that is clear. Okay, see, this audit program, it is prepared to allocate work to team members. It contains list of audit procedures, instructions to be followed by the member, and duration for completing the task. Okay, this audit program, it will be given to the member of the audit team. And what will be there in this audit program? This audit program will contain list of procedures that has to be performed by that member with respect to that particular area, and what is the time limit within which he has to complete that work, and what are the instructions that has to be followed by the member during auditing that particular area. Okay, these aspects will be there in audit program. Okay, next, information required to formulate audit program. Okay, in order to develop the audit program, what information is required? You will be requiring nature of the business. Okay, what is the financial and accounting setup of the company? In case of industrial concerns, visit the factory. Okay, in order to develop the audit program, you will need information with respect to the accounting aspects of the company, right? Next, you will also require overall plan. See, based on the audit strategy, audit plan will be developed, and based on the audit plan, audit program will be developed. Okay, this is how these three will be developed. Next, in drawing audit program, if any divergence from plan is required, then modify the plan first. In case of industrial concerns, visit the factory. Okay, while developing the audit program, if you feel that any divergence or deviation from the plan has to be made for developing the audit program, then first of all you change the audit plan. After that, you develop the audit program according to the audit plan. Okay, next, you will also require information about system of internal control and accounting policies. See, while conducting the audit, the auditor will first of all verify internal controls around that area, right? So in order to verify the internal controls, you should have knowledge about the internal controls that the entity has implemented, right? So you should have this information about internal control also while developing the audit program. This audit program will also contain how to verify the internal controls working around that particular area. Okay. Next, you'll also require client's history and business, and you'll also require accounting and management policies. All this information is required in order to formulate audit program. Hope that is clear. So by this we have completed discussion of audit planning and audit strategy, right? In the next class we will be discussing reporting aspect. Basically the entire SS 700 series will be revising in the next class. Okay, and a small information, we have launched Lecturepedia app. On this Lecturepedia app you can practice MCQs of all the subjects of CA final, inter and foundation, and along with that you can also purchase classes of various topmost faculties from our Lecturepedia app. Okay, you can download Lecturepedia app from the Play Store. Okay, I'll be winding up this video. We'll meet in the next video. Until then, take care. Bye bye. See you. In the today's class, we'll be revising all the standards related to reporting. See, whenever the term reporting comes, you have to remember all the standards of 700 series, right? Now, in the previous class, we have discussed audit planning and audit strategy, right? After that, we will be discussing in the today's class reporting. In the next class onwards, we will be covering the execution part. Okay, so now if you see the entire 700 series, it deals with audit report. Okay, each standard deals with a specific aspect. If you see, the question that you might get is why audit report is required. See, the management, they will prepare financial statements. If you just give that financial statements to the users don't believe whether management have correctly prepared the financial statements. So in order to increase the confidence of the users on the financial statements, auditor will audit the financial statements and he will give the audit report. So if you give financial statements together with the audit report to the users, then the confidence of the users on the financial statements will increase. That is the reason for audit report. Okay, see, only financial statements, no credibility. Users will have no credibility. If you give financial statements along with the audit report, then the credibility of the users on the financial statements will increase. Okay, next, what are the standards that are dealing with audit report? If you see entire 700 series, there are 6 standards that will deal with audit report. See, firstly, SA 700, which deals with the format of audit report in case of unmodified opinion. Next, SA 701, which deals with key audit matter, CAM, we will discuss that. SA 705 deals with modification to the opinion of the auditor. SA 706 deals with emphasis of matter and other matter paragraph. SA 710 deals with comparative information, and SA 720 deals with auditor's responsibility with respect to other information. What is meant by other information? All this will revise. Okay, these are the 6 standards that we are going to cover or that we are going to revise in this class. Okay, now purpose of SA 700 series. Now, why the Institute of Chartered Accountants of India has given this SA 700 series and prescribed the format of audit report. See, if each and every auditor gives different format of audit report, then the users will confuse. okay, regarding the audit report. So if a standard format of audit report is maintained, then you can easily compare the audit reports of all the auditors, and it will also become easy to the users to understand the audit report. So in order to prescribe the audit report format and in order to standardize the reporting aspect in case of a audit, SA700 series has been given. Okay, that is purpose of SA700 series. C, to maintain consistency and comparability of audit reports, conducting audit in accordance with SS promotes credibility in the global market. Okay, help to promote users' understandings of the audit reports. Okay, next. SA700. Now we'll start with SA700. I have already told you SA700 deals with format of audit report in case of unmodified opinion, right? Now, objectives as per SA700. What is the objective of auditor as per SA700? See, the objective of auditor is to form an opinion on the financial statements based on the conclusions that are drawn from his audit, and therefore he will report that opinion in the form of a audit report. That is the objective of auditor as per SA700. Okay, to form an opinion and to report that opinion, right? Next, types of audit opinions. If you see broadly, there are two types of audit opinions. One is unmodified opinion and another one is modified opinion. Okay, here in SA700 we will deal with unmodified opinion. With respect to modified opinion, we will cover in SA705. Modified opinion, again it is of three types, right? Qualified opinion, adverse opinion, disclaimer of opinion. That we will cover in SA705. See, types of audit opinions. Unmodified opinion, modified opinion. Modified opinion will deal with SA705. Now, when auditor will give unmodified opinion, if auditor feels that the financial statements are prepared in all material respects in accordance with applicable financial reporting framework. Okay, applicable financial reporting framework means either Ind AS or accounting standards in case of India. Okay, if the financial statements are prepared as per applicable financial reporting framework and there are no misstatements in the financial statements, then auditor will give unmodified opinion. Okay, if based on the audit evidence financial statements are not free from material misstatements, auditor is unable to obtain audit evidence to conclude that financial statements are free from material misstatements. In this situation, auditor will give modified opinion. Hope that is clear. Next, elements of audit report. Elements of audit report means in the audit report there will be subheadings, right? So we'll call them as elements. What are the various elements of audit report? Let's see. First of all, you will have title. What will be the title? Independent Auditors Report. That is the first element. Next, addressee. To whom you are addressing this audit report. Generally, you will address audit report to members, the shareholders, right? Next, opinion paragraph. In the opinion paragraph, auditor will express his opinion. Next, basis for opinion. Okay, on which basis auditor has derived this opinion, that auditor will express in basis for opinion. Next, material uncertainty related to going concern. If at all there is any material uncertainty related to going concern as per SA 570, then auditor will report the same in this paragraph. Okay, material uncertainty related to going concern. Next, emphasis of matter paragraph. Emphasis of matter paragraph will be dealt by SA 706. We will discuss about that in SA 706. Next, key audit matter dealt by SA 701. See, this is the order in which the paragraphs has to be presented in the audit report. Next, other information paragraph, which will be dealt by SA 720. Next, you will have management responsibility, auditor's responsibility. Okay, in the management responsibility, you will disclose the responsibility of the management, like preparation of financial statements, establishment of internal controls to provide the required information to the auditor, right? These are the responsibilities of management. In the same way, responsibilities of auditor to express the audit opinion. Next, other matter paragraph again will be dealt by SA 706. And signature, place of signature where you have signed, and the date of signature. Okay, date of auditor's report, on which date you are issuing audit report. So these are the elements of audit report. Now we will discuss each element one by one. Firstly, auditor's opinion. See, the first element, title and addressee, you already know that. Okay, title means independent auditor's report, addressee, you will address whoever have appointed you. Okay, generally the members. Next, auditor will give his opinion. You will call it as auditor's opinion paragraph. Okay. Now, in the auditor's opinion paragraph, auditor has to refer to certain aspects. What are they? First of all, auditor has to identify the name of the entity whose financial statements have been audited. Okay, identify name of the entity. Next, you have to state that you have audited the financial statement. Okay, state that financial statements have been audited, and you have to recognize the name of each statement constituting the financial statement, like balance sheet, profit and loss statement. If the cash flow statement is applicable, cash flow statement, you need to identify name of each statement forming part of the financial statements. See, identify the title of each statement comprising financial statements. Next, refer to the notes. Okay, you will also give notes to the financial statements. You should also refer to that notes and specify the date or period that is covered by financial statements. Basically, the balance sheet, it will be prepared as on 31st March. So you should refer that date as on 31st March of so and so year. Profit and loss will be prepared for a period, like you should mention from 1st April 2024 to 31st March 2025. So the period you have to clearly mention in your opinion paragraph. Okay, so all these aspects needs to be referred in your opinion paragraph. Okay. Next, coming to basis for phrase to be used for unmodified opinion. Okay, if you are giving unmodified opinion, then which phrase you have to use? The phrase that you have to use will depend on the financial reporting framework that the entity is using. See, if the entity is using fair presentation framework, there are two types of frameworks. One is fair presentation framework, another one is compliance framework. What is the difference? In case of fair presentation framework, it will allow to deviate from the framework if such deviation gives more fair representation of an item. Okay, if the deviation from the framework allows more fair presentation, then such framework is known as fair presentation. Okay, a fair presentation framework. Okay, if any framework allows to deviate from the framework for preparing the financial statements, then such framework is known as fair presentation framework. Okay, and such deviation should be made when the management feels that because of such deviation it results into more fair presentation of that particular matter. Okay, in such a situation only the deviation from the framework has to be allowed. That is known as fair presentation framework. If the deviation is not allowed, you have to strictly follow the framework. Whatever might come, you have to strictly follow the framework. That is known as compliance framework. Now, if a fair presentation framework has been used, then auditor, the phrase of the auditor's opinion in case of unmodified opinion will be like this. See, in our opinion, the accompanying financial statements present fairly in all material respects. Or the auditor can also use the following phrase: in our opinion, accompanying financial statements give true and fair view. Okay, you can say either present fairly or giving true and fair view. Okay. Next, if compliance framework has been used, in case compliance framework has been used, auditor has to state that financial statements have been prepared as per the financial reporting framework. That's it. See, the accompanying financial statements are prepared in all material respects in accordance with the applicable financial reporting framework. Okay. Those are the phrases that you will be using. Next, coming to basis for opinion paragraph. Now, in the basis for opinion paragraph, auditor will express how he has derived that opinion which he has given in the opinion paragraph. Here, auditor should refer the following. See, basis for opinion paragraph shall state that the audit was conducted in accordance with the standards on auditing. Okay, for purpose of conducting this audit, we have followed standards on auditing. This point you need to mention. See, you have to mention this point only if you have actually followed all the standards on auditing. Otherwise, you cannot mention this point. Okay. Next, refers to the section that describes the auditor's responsibility under the SS. See, in this audit report, we are giving a separate paragraph, auditor's responsibility paragraph. Okay, that paragraph will be after the management's responsibility paragraph. So now in the basis for opinion paragraph, auditor has to refer that auditor's responsibility paragraph which the auditor has given in the audit report, stating that our responsibilities are as per the auditor's responsibility paragraph. Okay, you have to give such reference. Next, includes the statement that auditor is independent of the entity and he has complied with all the ethical requirements. Okay, all the ethical requirements, the 5 fundamental principles we have discussed, right? Integrity, objectivity, confidentiality, professional competence, and due care, right? Professional behavior. All these 5 fundamental principles auditor has complied, and he has also been independent during the entire audit. This point he needs to mention in the basis for opinion paragraph. Next, state whether the auditor believes that audit evidence obtained is sufficient and appropriate for the purpose of expressing the audit opinion. Okay, whether the audit evidence that the auditor has obtained is sufficient and appropriate for the purpose of expressing audit opinion or not. Okay, this point also you should mention in the basis for opinion paragraph. Hope that is clear. Now, coming to the next paragraph, which is management responsibility paragraph. In this management responsibility paragraph, you will express the responsibility of the management. What is the responsibility of the management? They are responsible for preparing financial statements in accordance with applicable financial reporting framework. They are also responsible for establishing internal controls, right? It is the responsibility of management to establish the internal controls. Okay, next, assessing entity's ability to continue as a going concern as per ST 570, whether the entity is eligible to continue as a going concern or not. Okay, you have to, the management has to mention that it has assessed the entity's ability to entity's ability to continue as a going concern. Okay, it is the responsibility of the management to assess the entity's ability to continue as a going concern. After management has assessed, auditor will verify, okay, whether the assessment of the management is proper or not. You will find that point in auditor's responsibility paragraph. Okay, in auditor's responsibility paragraph, you will mention that auditor is responsible for verifying the appropriateness of management's assessment of entity's ability to continue as a going concern. Hope that is clear. Next, this section shall identify those responsible for oversight of financial reporting process if the persons who are responsible for implementing them are different. Okay, if the person who is, or if the people who are responsible for implementing is different from the people who are responsible for overseeing the financial statements, then you have to mention the person who is responsible for overseeing the financial statement. Okay, see, this section shall identify those responsible for oversight of financial reporting process when those responsible for oversight are different from those who fulfill the responsibility described in the paragraph. Hope that is clear. Okay, the people who have implemented the requirements of paragraph is different from the people who is having responsibility to oversee the financial statements, then you need to mention in this paragraph, in the management responsibility paragraph, the people who are responsible for oversight of the financial statement. That people you need to mention in management responsibility paragraph. Okay, next comes auditor's responsibility paragraph. Now, responsibility of the auditor is, in this paragraph, auditor needs to state that his objective is to examine, obtain reasonable assurance about whether financial statements are free from material misstatement. After obtaining reasonable assurance, he will express the opinion in the form of audit report. Issue an auditor's report that includes the auditor's opinion. Next, state that reasonable assurance is a high level of assurance but not a guarantee that audit will detect all the misstatements. Okay, in case of an audit, auditor will give only reasonable assurance. He cannot give absolute assurance. So he need to mention this point in his auditor's responsibility paragraph, stating that I will give only reasonable assurance. Reasonable assurance means a high level of assurance but not a absolute assurance. Like this, you should clearly mention in the auditor's responsibility paragraph. Okay, to avoid confusion. Next, state that misstatements can arise either from fraud or from error, and these misstatements will become material if they impact the decision making of the users. You have to mention this point. Describe that they are considered material if they could reasonably expect it to influence the economic decision making of the users. or if the material misstatement is having any different definition as per the applicable financial reporting framework, then you have to mention that same definition here. See, or provide definition or description of materiality in accordance with the applicable financial reporting framework. Okay, if the applicable financial reporting framework has a defined materiality in a different manner, you have to give the definition here. If the applicable financial reporting framework is silent with respect to materiality, you have to mention this point. Okay, next, still auditor's responsibilities only. Auditor exercises professional judgment and maintains professional skepticism throughout the audit. You have to mention that throughout the audit, I will exercise professional judgment, and I will also maintain professional skepticism. Okay, professional skepticism means questioning mind. Professional judgment means ability to apply all the knowledge and experience that you have obtained is known as professional judgment. Okay, in taking any decision, you have to apply all these. Okay, next, describe an audit by stating the auditor's responsibilities or to identify and assess risk of material misstatement, to obtain understanding of internal control that are relevant for the purpose of audit, to evaluate appropriateness of accounting policies used and reasonableness of accounting estimates that the management has made. Right, while preparing the financial statements, management will use various accounting policies. Management will make various accounting estimates. The auditor has to verify whether those accounting policies and accounting estimates that the management has taken are reasonable or not. Next, to conclude on appropriateness of management's use of going concern basis of assumption. Okay, in the management responsibility paragraph, we have discussed that it is responsibility of the management to assess the entity's ability to continue as a going concern. Now, auditor has to check the appropriateness of assessment that has been made by the management to evaluate overall presentation structure and content of the financial statements. Okay, these are the auditor's responsibilities. Okay, now where the auditor's responsibility paragraph has to be presented. Location of auditor's responsibility paragraph. There are three options. You can include auditor's responsibility paragraph in the main audit report, in the body of audit report, or you can give the auditor's responsibility paragraph as a annexure to the audit report, or if the responsibilities of the auditor are mentioned somewhere else or in any website, the responsibility of auditor is mentioned. In such a situation, you have to make reference to such website where the auditor's responsibilities have been prescribed. See, within body of auditor's report or as an appendix to the auditor's report or specific reference to location of such description on a website. Let's say, for example, in case of a bank audit, the bank will make the appointment of auditor. Now, bank in its website has listed the responsibilities of auditor. In such a situation, auditor in his audit report can make reference to the website of the bank wherein the responsibilities of auditor has been prescribed. Just an example I have given. Okay. Next, report on other legal and regulatory requirements. See, the audit report, it will be divided into two parts. One is report on audit of financial statements. After the report on audit of financial statements is completed, at the end you will also find the second part, which is report on other legal and regulatory requirements. What will be covered here? Reporting under section 143 subsection 1 of Companies Act, reporting under section 143 subsection 3 of Companies Act. Next, CARO reporting. Next, internal controls over financial reporting. Okay, all these are reporting requirements under other laws or regulations. Okay, so all these will be given in this second part. Let us see. These are in addition to auditor's responsibilities under standards on auditing. Okay, the responsibilities of auditor under standards on auditing will be reported in the first part, that is report on audit of financial statements. In the second part, you will report this. Okay, present in separate section with the heading report on other legal and regulatory requirements. If you observe any audit report, you will find two parts. Okay, in the audit report, the first part, in the starting itself, it will be mentioned report on audit of financial statements. After the entire report is completed, at the end, you will also find report on other legal and regulatory requirements. In that report, you will find reporting under section 143 subsection 3 and CARO reporting. You will mention that CARO has been given as an annexure to this audit report. Like this, you will mention. If the internal control of financial reporting is also there, you will also mention that ICFR is also has been given as a annexure to this audit report. Like this, you will mention. Right. All this reporting you will do in other reporting, you will do in report on other legal and regulatory requirements. Okay. See, report on other legal and regulatory requirements shall follow the report on audit of financial statements. Okay. So the audit report can be divided into two parts. One is report on audit of financial statements and the second part is report on legal and regulatory requirements. Now, if the legal and regulatory requirements is same as that of standards on auditing, okay, whatever has been required in the standards on auditing, the same has been required in some law or regulation also. In such a situation, you need not separate, okay, you need not give two parts of the audit report. In the same single part itself, you can continue. See, same topic as is covered in standards on auditing is also prescribed by some other law or regulation. In such a situation, presented in the same section as the related report elements required by this SS. Okay, you need not present the second part. But however, there should be clear differentiation from the reporting that is required by SS. Okay. In the same section itself, you can present the reporting requirement under other law regulation also, if the requirement of other law regulation is same as that of the standards on auditing. Hope that is clear. Example for reporting and under other law regulation is section 143 subsection 3 Kovuru 2020. Okay, in section 143 subsection 3 there will be list of points on which the auditor has to report. There will be around 12 points on which auditor has to report, right? Next, signature. Auditor, if auditor is a sole proprietorship firm, then auditor will sign on behalf of himself, right? Shall be signed in the personal name. If auditor is partnership firm, then he will sign on behalf of his name and on behalf of his firm also. See, shall be signed in personal name as well as in firm name. Here is an example I have given. Note, mention membership number and firm registration number also. You should also mention UDIN, right? Unique document identification number you should also mention in the audit report. That is with respect to the signature. Next, place of signature. See, wherever you are signing the audit report, that place you need to mention. See, mention the city where the audit report is signed. It need not be head office of the audit firm. See, it need not be registered office of the client or the auditor. Wherever you are signing the audit report, that city name you can mention. Next, date of auditor's report. See, you should not date your audit report until and unless all the audit evidence has been obtained. Okay. You should date your audit report only after all the audit evidence has been obtained. However, you can document the audit evidence after the audit report has been given. Okay, within 60 days from the date of audit report, you can document that audit evidence. But gathering or collecting of audit evidence from the client has to be done before the date of audit report only. Hope that is clear. See, shall not be dated earlier than the date on which auditor obtains sufficient appropriate audit evidence. Okay, auditor's report prescribed by law or regulation. Okay, if any law or regulation prescribes the audit report, then in that audit report, auditor has to mention that standards on auditing have been complied while doing this audit only if standards on auditing have actually been complied. Okay, and if the law or regulation prescribes a different wording of his opinion, okay, basically SS 700 has prescribed the wordings of the auditor's opinion, but different law or regulation as per which auditor's appointment has been made prescribes different wordings. Now, in such a situation, auditor can state that he has complied with the standards on auditing only if all the wordings mentioned in the audit opinion as per SS is also present in the wordings that is mentioned as per that other law or regulation, and the audit report that you give as per that other law or regulation, if it contains all the basic elements that we have discussed in SS 700 series, only then you can mention that the audit was conducted in accordance with standards on auditing. Okay, this is a situation if you are giving audit report as per other law or regulation. Okay, you have been appointed as per other law or regulation. Okay, If you don't follow standards on auditing, you should not mention that you have followed standards on auditing. That is simple. Okay. Next, auditors report for audits conducted in accordance with both SS and international standards on auditing or standards of other jurisdictions. Sometimes what will happen is, let's say an American company is having a branch office in India or a subsidiary in India. Now, for the Indian subsidiary, you will conduct auditing in accordance with standards on auditing, and the audit report of Indian subsidiary should also be sent to that American parent company. So, for sending the audit report of Indian company to the American parent company, it has to be, the audit report has to be as per international standards on auditing, because the parent company is American company. So, in this situation, you can give same audit report for both standards on auditing and international standards on auditing only if certain conditions are satisfied. What are they? There should not be conflict between standards on auditing and international standards on auditing. Okay, that is the first situation, first point that needs to be satisfied. Next, if let's say as per standards on auditing, auditor has to mention emphasis of matter paragraph or other matter paragraph in the audit report, then as per international standards on auditing also that requirement should be there. Okay, for that particular matter, auditor should mention emphasis of matter paragraph or other matter paragraph in the audit report. Only then he can issue same audit report for standards on auditing and international standards on auditing. Okay, see, otherwise he has to give different audit reports. US company is having a branch or subsidiary in India, then auditor's report may refer SS in addition to international standards on auditing only if no conflict between standards on auditing or ISAs, that is international standard auditing, that would lead the auditor to form different opinion, or not to include emphasis of matter or other matter paragraph that in particular circumstances required by SS. Okay, as per standards on auditing, auditor is required to give emphasis of matter or other matter paragraph for a particular situation, but for that particular situation, international standard on auditing is not requiring any emphasis of matter or other matter paragraph. In this situation, there is a conflict between these both standards on auditing and international standards on auditing. So here auditor cannot give same report for both of them. Okay, you have to give a separate report for standards on auditing, you have to give separate report for international standards on auditing as per their requirement. Next, there is also another condition that needs to be satisfied. See, the auditor's report include at minimum each of the elements set out in the auditor's report prescribed by law or regulation discussed above when the auditor uses layout or wording specified by the standard on auditing. Okay, at least the minimum basic elements that we have discussed in this ESA 700 must be present in that audit report that the auditor gives as per that particular law or regulation. Basically, this point is for the audit report that the auditor uses as per the audit report that auditor issues as per different law or regulation. Okay, for that this point has to be applicable, right? Next, supplementary information presented by financial statements. Supplementary information means, let's say for example, auditor has prepared the, not the auditor, the management has prepared profit and loss statement. In the profit and loss statement there will be sales, right? In the notes the management has given region wise sales. This is known as supplementary information. Okay, this information is not required by the financial reporting framework, even then you are giving this information. So this is known as supplementary information. Now if management gives such a supplementary information in the financial statements, whether auditor's report should also include the opinion on such supplementary information or not. Hope you understood. Okay, auditor will give his audit opinion on the financial statements. Now in the financial statements there is a supplementary information that is not required by the financial reporting framework. Now whether auditor's report should also include opinion on this supplementary financial information, the answer is it depends. You have to check whether supplementary information is integral part of financial statements. Integral part of financial statements means without having supplementary information you cannot understand the financial statements. In such a situation supplementary information will become integral part of financial statements. Okay, so if supplementary information is integral part of financial statements sorry, then obviously auditor in his audit report must give opinion on supplementary information
also. If supplementary information is not integral part of financial statements, then auditor need not give his opinion on the supplementary information. Okay, when you will say supplementary information is not integral part of financial statements, when you can understand the financial statements even without having supplementary information, then you will say supplementary information is not integral part of financial statements. Okay, now when supplementary information is not integral part of financial statements, care has to be taken that there has been proper separation between supplementary information and the financial statements. Hope that is clear. See, okay, supplementary information given in the financial statements, but it is not required by the applicable financial reporting framework. Then auditor shall evaluate whether such a supplementary financial statement is integral part of financial statements. If it is integral part of financial statements, then supplementary information shall be covered by the auditor's opinion. If supplementary information is not integral part of financial statements, then evaluate whether clearly differentiated from the audited financial statements. Okay, if the supplementary information is not integral part of financial statement, then you have to evaluate whether there has been a proper separation between financial statements and supplementary information. And if not, if there is no proper separation, okay, if there is no clear differentiation, then ask the management to change the presentation of the financial statements by clearly differentiating supplementary information. Okay, if management refuses, then explain in auditor's report that supplementary information has not been audited. Okay, if management refuses to properly differentiate between financial statements and supplementary information, then auditor in his audit report has to clearly mention that the financial statements are in such a way that they are not differentiating supplementary information and the financial statements. Okay, they are looking as if they are integral part, but they are not integral part. So I am not providing any opinion on the supplementary information. Like this, you have to clearly mention in your audit report. Hope that is clear. So by this, we have completed discussion of SA 700. Okay, next we'll discuss SA 705. Let me open that PPT related to SA 705. Now moving to SA 705. Now SA 705 deals with format of audit report in case of modified opinion. See, the format of audit opinion, the opinion that we have discussed, the format of audit report that we have discussed in SA 700, it remains as it is, but some changes will be made to that format if auditor wanted to give modified opinion. So what are those changes and what are types of modified opinions, and what will be the paragraphs that the auditor will give, what will be the language of the opinion paragraph in case auditor wants to give modified opinion, and in which situations which type of modified opinion will be given. All these points will be discussing in SA 705. See, SA 705, which is modifications to the opinion of the independent audit report. It deals with format and content of audit report in case auditor wants to give modified opinion. Now, scope of SA 705. See, SA 705 deals with form and content of audit report if auditor wants to give modified opinion. The same point. Types of audit opinions. See, previously in SA 700 we have discussed that there are two types of audit opinions: unmodified opinion, modified opinion. Unmodified opinion we have covered in SA 705. Modified opinion now we will cover. Now if you see this modified opinion, it is again of three types. See, first of all, unmodified opinion as per SA 700. Next, modified opinion, it can be of qualified or adverse or disclaimer. These are the three types of modified opinions. Now in this entire chapter we will be discussing in which situation which type of modified opinion will be given. See, situations when modified opinion is given. See, auditor will give modified opinion when based on his audit evidence, if auditor comes to a conclusion that financial statements are not showing true and fair view, or there are misstatements in the financial statements. See, based on audit evidence, financial statements are not free from material misstatements, or auditor is not able to obtain audit evidence to conclude that financial statements are free from material misstatements. Okay, in these two situations, auditor will give modified opinion. Which type of modified opinion, that we will see. Okay, but basically, if any of these two situations is present, auditor will modify his opinion. Okay, see, if auditor expects to modify or include emphasis of matter or other matter paragraph in his audit report, he has obligation to communicate the same to those charged with governance. Okay, whenever auditor wants to give modified opinion or auditor wants to express emphasis of matter or other matter paragraph in the audit report, he is having responsibility to communicate the same to those charged with governance. Those charged with governance, I am giving modified opinion in my audit report. This is the reason. Like this, you have to communicate with those charged with governance. Okay. Where this point is told, it is told in essay 260, communication with those with governance. Okay, next, understanding the term pervasiveness. Now, before discussing the situations in which qualified opinion will be given, adverse opinion will be given, disclaimer of opinion will be given. Okay, before understanding those situations, you have to understand one particular term, that is pervasiveness. Okay, what is meant by pervasiveness? Now here in this context, we will be using the term pervasiveness with respect to the misstatements. Okay, pervasiveness of misstatements, that means pervasiveness means spread all over. Okay, spread across various items is known as pervasiveness. Okay, pervasiveness means not present in a single item. Okay, it is spread across the various items. That means misstatements are pervasive, means misstatements are present across the financial statements. Okay, various items have been misstated. Okay, there is misstatements in fixed assets, there is misstatements in current assets, there is misstatements in sales, there is misstatements in purchases. Like this, misstatements are in various items, then you will call that misstatements are pervasive. Hope that is clear. Or another situation, misstatement is only in one item, but that single item represents a majority portion of financial statements. Let's take for example balance sheet. Okay, there are misstatements in inventory. Okay, only in the inventory there are misstatements, but inventory constitutes 80% of the total assets of the entity. Now in this situation, even though only one item is misstated, but that misstatement is pervasive because that item itself represents most of the financial statement, right? Hope that is clear. That is known as a pervasiveness. Pervasiveness means present across various items. See, describes the effect of misstatements or possible misstatements on the financial statements. In relation to amounts, they are not confined to specific element, account or items of financial statements. If so contained, represents a substantial portion. That means misstatement is not in one particular item. Okay, misstatement is in various items, then you will call it as pervasiveness. Or misstatement is in one item only, but that one item represents a majority portion of the financial statement, then also you will call the misstatement as pervasiveness. Okay, the same example that I have given you. Next, in relation to disclosures, if that are fundamental to users' understanding of the financial statements. Okay, if you have not properly made the disclosures that are fundamental to the users' understanding of the financial statements, then you will say that there are misstatements in the disclosures. Okay. Now, determining the type of modified opinion. Now, in order to determine which type of modified opinion you will give, you have to remember three terms. What are they? First of all, whether audit evidence is available or not. You have to check this point. Next, whether misstatements are material or not. This is the second point that you need to check. Third point, whether the misstatements are pervasive or not. This is the third point you need to check. Okay, based on the answers that you get for these 3 points, you will decide which type of modified opinion has to be given. Let us see. Now, availability of audit evidence, that is the first point that you need to check. Next, Is misstatement material? Next, is misstatement pervasive? Okay, based on the answers that you get to these three questions, you will decide which type of modified opinion has to be given. See, type of modified opinions. If audit evidence is available, yes, and the misstatement that you have identified is material, yes, it is material, but the misstatement is not pervasive. In this situation, you will give qualified opinion. Okay, next, evidence is not available, you are not having evidence, but if at all there are any misstatements, those misstatements will be only material but not pervasive. In this situation also, you will give qualified opinion. Okay, next, a audit evidence is available, and based on the audit evidence you have concluded that misstatements are material as well as pervasive, then you will give adverse opinion. Okay, next, audit evidence is not available, but auditor concludes that if at all there are any misstatements, those misstatements will be both material as well as pervasive. In this situation, auditor will give disclaimer of opinion. Hope this is clear. Okay, you can determine which type of modified opinion has to be given with the help of this chart. Okay, you can just take a screenshot of this chart. Okay, next, now when you give unmodified opinion, the format is as per SA 700, right? If you modify your opinion, then some of the paragraphs of the audit report will get affected. You have to change the terminologies of some of the paragraphs. So because of modification of your opinion, what paragraphs of the audit report are getting affected? Let's see. First of all, obviously opinion paragraph will get affected because you are modifying the opinion. So opinion paragraph will be affected. See, opinion paragraph will be affected. Now, after opinion paragraph, even basis for opinion paragraph also will get affected, right? See, basis for opinion paragraph will also get affected. After that, auditor's responsibility paragraph will also get affected if you are giving disclaimer of opinion. Okay, see, auditor's responsibility paragraph will also get affected if you are giving disclaimer of opinion. Okay, only if you give disclaimer of opinion, then auditor's responsibility paragraph will also get affected. Okay, so because of giving a modified opinion, these are the paragraphs that are being affected. Now we will see how they will get affected. Okay, so wordings of qualified opinion. So first type of modified opinion, which is qualified opinion. If the auditor wants to give qualified opinion, then how the wordings of that opinion will look like? Here, auditor will use the wordings stating that except for the matter described in basis for matter paragraph, all other financial statement, okay, all other items of financial statements are showing true and fair view. Like this, the auditor will say, okay, except for the matter, because auditor will give qualified opinion when misstatements are not pervasive. That means only one item is misstated in such, okay, one means not exactly one, only some items are misstated. Okay, it is not pervasive. Then auditor will give qualified. So auditor's opinion is qualified only with respect to these items. Okay, so he uses the terminology except for the matters described in basis for qualified opinion paragraph, financial statements are showing a true and fair view. Okay, if the financial reporting framework that has been used is fair presentation framework. Okay, see, except for the effects of matter described in basis for qualified opinion section, when you are using fair presentation framework, you will state that, okay, you will state that the accompanying financial statements are present fairly in all material respects. Okay, if you are using compliance framework, then you will say except for the matters described in the basis for qualified opinion paragraph, the financial statements have been prepared as per the applicable financial reporting framework. See, The accompanying financial statements have been prepared in all material respects in accordance with the applicable financial reporting framework. Okay, you have to use this terminology when you are following compliance framework. Okay, that is the wordings of qualified opinion. Next, wordings of adverse opinion. Next, if you are giving adverse opinion, you need to remember the chart. Audit evidence available, misstatements material, and they are pervasive. That means entire financial statements are misstated. Then here you will say that financial statements, entire financial statements are not showing true and fair view. See, the auditor's opinion, because of the significance of the matter described in the basis for adverse opinion section, when reporting as per fair presentation framework, the accompanying financial statements do not present fairly in all material respects, and the accompanying financial statements have not been prepared in accordance with applicable financial reporting framework. Okay, when you are using compliance framework. Hope that is clear. This is the wordings in case of adverse opinion. Next, if you give disclaimer of opinion, wordings of disclaimer paragraph. When the auditor disclaims an opinion due to inability to obtain sufficient appropriate audit evidence, then the auditor shall state that auditor does not express opinion on the financial statements. See, disclaimer of opinion means you are not claiming any opinion. That is known as disclaimer of opinion. Okay, you are not claiming any opinion. That means you are not giving any opinion. So, in the opinion paragraph, you have to tell that auditor does not express any opinion on the financial statements. Why? Because he cannot obtain audit evidence and the misstatements are material and pervasive. Okay, if at all there are any misstatements, those misstatements will be material and pervasive. Because of this, I am not able to express my opinion. Okay, you have to mention this, that auditor does not express any opinion on the financial statements. Next, state that because of the significance of the matter described in the basis for disclaimer of opinion section, the auditor has not been able to obtain sufficient appropriate audit evidence. Okay, you have to clearly mention, because of the matter that I have described in the basis for disclaimer of opinion, I am not able to obtain sufficient appropriate audit evidence. Okay, you have to mention this point in the opinion paragraph if you give disclaimer of opinion. Next, amend the statement required by SA 700, which indicates that financial statements have been audited, to state that auditor was engaged to audit the financial statements. Now, if you see, as per SA 700, in the opinion paragraph, you will include a particular point stating that these financial statements have been audited. Okay, this point we will include, I guess, second point, right? In opinion paragraph of SA 700, we have discussed the auditor should mention a statement saying that these financial statements have been audited. Now, if you give disclaimer of opinion, you are not expressing any opinion. Why? Because you have not done any audit. Why? Because you are not able to obtain audit evidence. So, you should mention that auditor was just engaged to audit the financial statements, but financial statements have not been audited. Hope that is clear. So, those are the wordings of disclaimer of opinion. Next, basis for modification of opinion. Even basically we have discussed that because of giving modification of opinion, 3 paragraphs will get affected. The first paragraph is opinion paragraph. How the opinion paragraph will get affected, we have seen just now. Okay, in case of qualified opinion, how it will get affected, how the wordings will change. In case of adverse, how the wordings will change. In case of disclaimer, how the wordings will change. The next paragraph that will get affected is basis for opinion paragraph, right? So the heading of the basis for opinion paragraph will change if you give modified opinion. How it will change? If you are giving qualified opinion, the heading will be like basis for qualified opinion. If you are giving adverse opinion, the heading will be like basis for adverse opinion. If you are giving disclaimer of opinion, the heading will be like basis for disclaimer of opinion. Okay, see, amend the heading basis for opinion as per SA 700 to following. What are they? Basis for qualified opinion, basis for adverse opinion, basis for disclaimer of opinion. Okay, like this you have to change the heading first of all. After that, include a description of the matter giving rise to modification. Okay, you have to clearly include why you are giving modified opinion. Okay, which matter has made the auditor to give qualified adverse or disclaimer of opinion, you have to clearly mention in the basis for opinion paragraph. Let me drink some water. Next, Just now I have told you that you have to clearly mention why the auditor is giving qualified opinion, or why the auditor is giving adverse opinion, or why the auditor is giving disclaimer opinion. So how the auditor should mention, that will vary based on the misstatement. Let's see that. What should be included in the basis for opinion? Let's see. Okay, causes of modification. Okay, for this cause you have to, the description should be like this. For this cause, description should be like this. Okay, now let us see cause by cause. If you are giving modified opinion because of material misstatement related to specific amount in the financial statements. Okay, there is a material misstatement in a particular amount in the financial statements, because of which you are giving modified opinion. Then in the basis for modified opinion, you have to quantify the effect of that amount on the financial statements. Okay, because of that misstatement in the amount, how much amount is being affected, okay, on the financial statements, you have to quantify. If you are not able to quantify, you have to clearly specify why you are not able to quantify. Okay, see, description and quantification of effect of misstatement on the financial statements. If it is impracticable to determine and quantify, then state the fact why it is impossible to determine to quantify the effect. Okay, next, if you are giving modified opinion because of material misstatement related to narrative disclosures, then you have to explain how the disclosures are misstated. Okay, next, if material misstatement related to non-disclosure of information required to be disclosed. Okay, the applicable financial reporting framework asks to disclose particular item or particular disclosure, but in the financial statements such a disclosure is not there. Because of that, you are giving modified opinion. Then what should be included in the basis for opinion paragraph? See, discuss the non-disclosure with those charged with governance. First of all, you have to discuss with those charged with governance. Those charged with governance, in the applicable financial reporting framework, this disclosure has to be given, but in the financial statements, the disclosure is not given. Like this, you have to discuss the matter with those charged with governance. Then describe the nature of the omitted information. Okay, what is the nature of such omitted information? You need to clearly describe it in the basis for opinion paragraph. And if it is possible, since that matter is not disclosed in the financial statements, auditor can disclose that matter in the basis for opinion paragraph. Okay, whatever the matter has to be disclosed in the financial statements, that same point you can include in the basis for opinion paragraph, because it is not disclosed in the financial statements. Okay, if the law permits, you can do this also. See, unless prohibited by law or regulation, include the omitted disclosure if it is practicable to do so and the auditor has obtained sufficient appropriate audit evidence about the omitted information. Okay, next, if inability to obtain sufficient appropriate audit evidence, then state the reason because of which you are not able to obtain sufficient appropriate audit evidence. Okay, so because of these reasons, this is how you have to include in the basis for opinion paragraph. Okay, next, exclusions from the basis from opinion paragraph. Okay, what should be excluded from the basis for opinion paragraph? Now, if you see in SA 700 series, we have discussed that 4 points should be mentioned in the basis for opinion paragraph. Okay, of those 4 points, if auditor expresses disclaimer of opinion, following 2 points should not be mentioned. What are they? Reference to auditor's responsibility paragraph is not required in the basis for opinion paragraph if you are giving disclaimer of opinion, and also statement about whether audit evidence obtained is sufficient and appropriate to provide basis for auditor's opinion is also not required. Okay, even this statement is also not required in the basis for opinion paragraph if you are giving disclaimer of opinion. Okay, the remaining points, that is, auditor has acted independently throughout the audit and complied with all the ethical requirements, that point you can mention, and also the audit has been conducted in accordance with the standards on auditing, even that point you can mention. Okay, except that points, remaining these 2 points you have to remove, you should not include. Okay, next, will there be any change in auditor's responsibility paragraph in case of modified opinion? Yes, there will be a change in the auditor's responsibility paragraph only when auditor disclaims the opinion. Okay, if auditor gives qualified opinion or adverse opinion, then there will not be any change in the auditor's responsibility. Okay, auditor's responsibility paragraph will be as it is. But if auditor disclaims the opinion, then auditor's responsibility paragraph will change. Okay, here he needs to mention that auditor was appointed to audit the financial statements, but he has not audited. See, yes, only when the auditor disclaims the opinion, auditor's responsibility paragraph has to be amended to include only following. What are they? Statement that auditor's responsibility is to conduct the audit. Okay, statement that because of a matter described for the disclaimer of opinion section, the audit was not able to obtain sufficient appropriate audit evidence. Okay, you have to mention that yes, my responsibility was to conduct the audit, but because of the matter that I have described in the basis for disclaimer of opinion, I was not able to conduct the audit because I was not able to obtain sufficient appropriate audit evidence. Okay, and the statement about auditor independence and other ethical responsibilities. Okay, you should also include the statement about your independence and your ethical responsibilities. Okay, this is how the auditor's responsibility paragraph will change only if you give disclaimer of opinion. Hope that is clear. Okay, so when auditor expresses qualified opinion or adverse opinion, only two paragraphs will get affected. What are they? Opinion paragraph and basis for opinion paragraph. But auditor expresses disclaimer of opinion, then apart from these two paragraphs, even auditor's responsibility paragraph will also get affected. Okay, we have discussed this while discussing the previous chart, right? The fourth or fifth chart. While discussing that, we have seen this, right? Next. Unless required by law or regulation, when auditor disclaims an opinion on the financial statements, you should not include key audit matter paragraph. Okay, if you are giving disclaimer of opinion, then in that audit report you should not include key audit matter paragraph. Okay, because when key audit matter paragraph will be included, first of all, what is key audit matter? Key audit matters are those matters that the auditor felt significant for the current period's audit. Now, when he is giving disclaimer of opinion, auditor has not at all obtained the audit evidence and auditor has not at all done the audit. Then how can he give key audit matter paragraph? Okay, so if you are giving disclaimer of opinion paragraph, you should not give key audit matter paragraph until and unless required by law or regulation. Okay. See, you should also not give other matter paragraph. Not other matter paragraph, other information as per SA 720. Okay, you should also not give your opinion or on other information as per SA 20 if you are as per SA 720 if you are giving disclaimer of opinion. Okay. Next. Management imposed a limitation after the auditor has accepted the engagement. See, after auditor has accepted the engagement, then management has imposed the limitation saying that you should not obtain written confirmation from the debtors, you should not obtain written confirmation from the bank, you should not attend for physical verification of stock audit, stock. Like this, the management is imposing limitations after auditor has accepted the engagement. In this situation, what the auditor has to do is, see, if limitation leads to auditor express qualified or disclaimer of opinion, request the management to remove the limitation. Okay, if this limitation leads the auditor to express qualified or disclaimer of opinion, then auditor should ask the management, please remove this limitation. If management doesn't agree, you should intimate the same to those charged with governance, saying that asking those charged with governance to remove the limitation. If those charged with governance also doesn't agree, then you have to check whether you can obtain audit evidence by performing alternate procedures. See, whether it is possible to obtain sufficient appropriate audit evidence through alternate procedures. If through alternate procedures also you are not able to obtain sufficient appropriate audit evidence, see, unable to obtain sufficient appropriate audit evidence through alternate procedures also, then if possible effects of undetected misstatements could be only material but not pervasive. See, in this situation, which opinion you will give? Okay, audit evidence not obtained, misstatements if any could be material but not pervasive, you will give qualified opinion. See, qualified opinion. If misstatements if any could be both material as well as pervasive, then you will give disclaimer of opinion or you will withdraw from the engagement if it is possible. See, possible effects of undetected misstatements could be both material and pervasive. In such a situation, you will either withdraw if it is practicable or you will give disclaimer of opinion. Okay, if it is not practicable to withdraw, you will give disclaimer of opinion. Hope that is clear. Next, auditor's withdrawal SEBI LODI regulation. See, now auditor of a listed entity, if he wants to withdraw from the engagement, he cannot withdraw just like that. SEBI has imposed a responsibility on that particular auditor if he wants to withdraw from the engagement. What is that responsibility? Let us say. See, if the auditor proposes to resign as an auditor of a listed entity and he proposes to resign within 45 days from the end of the quarter, in such a situation, before resigning, auditor has to give limited review report of that particular quarter. Okay, within 45 days of the end of the quarter, you wanted to resign, then you have to give limited review report of that particular quarter and resign. Next, if you have applied for resignation after 45 days from the end of the quarter, then you have to give limited review report of that quarter as well as next quarter. Okay, of that quarter as well as next quarter. If you are resigning after you have conducted a limited review of first 3 quarters, then you can resign only after conducting limited review of 4th quarter as well as the financial audit of the complete financial year. See, after issuing limited review report of first 3 quarters, you have applied for resignation. In such a situation, you can resign only after providing limited review report of 4th quarter as well as the final audit report of the entire financial year. Okay, hope this is clear. By this, we have completed discussion of essay 705. In the next class, after this, I'll open the not next class. Okay, in this class only we'll be completing all 700 series, right? I'll open the PPT of next chapter or next standard. Let me just close this. Okay, now we'll see essay 701, that is key audit matters. In format of audit report as per essay 700, we have seen one of the paragraph, that is key audit matter paragraph. So what are key audit matters, how to present them, okay, how the auditor will identify key audit matter paragraphs, all this we'll see in this essay 701. Okay, now key audit matter, what is meant by a key audit matter? See, key audit matters are those matters that in the auditor's professional judgment were of most significance in the current financial statement period audit. Okay, those items that are very much significant. Significant means important for the current period audit as per the professional judgment of the auditor are known as key audit matters, and these key audit matters has to be communicated in the audit report. Okay, and this key audit matter is mandatorily applicable only for listed entities. Okay, for unlisted entities, auditor at his discretion, if he wants, he can give key audit matter paragraph or he need not give key audit matter paragraph. Okay, that is left to the discretion of the auditor. Okay, how auditor will identify these key audit matters, that we will see. Okay, applicability of essay 701, just now I have told you. See, to all the listed entities, it is mandatorily applicable, and auditor otherwise decides to communicate key audit matters in the auditor's report. Okay, in case of other entities, that is unlisted entities, if auditor decides that he wanted to communicate key audit matters, then he can give. Or key audit matters is made applicable as per requirement of any law. See, required by law or regulation to communicate key audit matter in the audit report, then also auditor will have to communicate key audit matters. Okay, next, purpose of communicating key audit matter. Now in the audit report, auditor is giving opinion, right? Again, why to communicate key audit matters? In order to increase communicative value of the audit report to the users of the financial statements or to the users of the audit report, this key audit matter has been introduced. That means auditor, he will do audit. While auditing, if he finds that any matter is very much important for the current period's audit, then auditor has to explain about that matter, how auditor has dealt with that matter to the users, right? It will increase communicative value of the audit report. So key audit matter has been introduced. See, to enhance communicative value of auditor's report and to assist users in understanding those matters that in the auditor's professional judgment were of most significant in the audit of financial statements of the current period. Okay, Now, auditor himself felt that these matters are very much important for the audit of current period. Now, if auditor felt that they are important means it will be useful if they are communicated to the users, right? So, you can communicate them through key audit matter paragraph. Next, determining key audit matter paragraph. Now, how auditor will determine key audit matter paragraph? Here there are certain steps. Now, auditor, he will communicate certain matters to those charged with governance. So, he will first of all take all the matters that he has communicated to those charged with governance. See, from the matters communicated to those charged with governance, identify matters that require significant auditor's attention in performing the audit. Okay, from all the matters that auditor has communicated to those charged with governance, auditor needs to identify those matters that require significant attention of the auditor. Okay, from all these matters, auditor will take up those matters where auditor feels that his attention is required. Okay, he has taken up all those matters that requires his attention. Now, while selecting the matters that requires his attention, how auditor will select? First of all, auditor needs to consider the areas which are having high risk of material misstatement. See, in making the determination, consider the following. What are they? Areas of high assessed risk of material misstatement. Okay, if any of the items communicated to those charged with governance is having high risk of material misstatement, then for that particular item, auditor's attention is required. Auditor will take up that. Okay, next, significant auditor judgment relating to areas in the financial statement that involve significant management judgment. Okay, if auditor feels that for any particular item, judgment of auditor is required because management has applied their judgment, those items also auditor will pick up. Next, significant events or transactions that occur during the period. Okay, from these items, auditor will also pick up those items and events that are significant which have occurred during the year. Okay, all these auditor will pick up. Now, from these picked up items, auditor will see which are significant for the current period's audit. Okay, from these items also auditor will again further filter. See, from the matters determined above, those matters having most significant in the current period audit will be communicated as key audit matter. Okay, first of all, you will take up all the matters communicated to those charged with governance. From those matters, the areas which require significant attention of the auditor, that you will take up. From those items which are significant for the current period audit, that you will take up and communicate as key audit matter. Hope that is clear. Next, communicating key audit matter. Okay, how you will communicate key audit matter? In the audit report, you will use a paragraph, key audit matter, and in that paragraph you will communicate key audit matter. Okay, describe each key audit matter in a separate subheading. Now, introductory language of this section shall be like this. Key audit matters are those matters which are most significant in the audit of current financial year, and that these matters were addressed in the context of audit, and audit does not provide separate opinion on these. Okay, you have to explain the nature of key audit matter. Okay, key audit matters means those matters that are significant for the purpose of current period audit, and auditor doesn't provide any separate opinion on these matters. Okay, like this you need to explain the nature of those key audit matters in the introductory language of key audit matter paragraph. Okay, next, description of individual key audit matter. Okay, now in the key audit matter paragraph, let's say you wanted to communicate 5 matters as key audit matters. Now you have to give appropriate subheading. In that subheading, you need to explain that key audit matter. How you will explain? What points you need to cover? See, you need to describe why the matter was considered to be one of the most significant. Auditor, you are saying that this is a key audit matter. Now, why you consider this matter as a key audit matter? You need to explain. Okay. Next, how the matter was addressed in the audit. Okay, you are saying that these are key audit matter and you have addressed them in the audit. How you have addressed them in the audit? You need to explain that in the key audit matter paragraph. Okay, for each key audit matter. Next, description of each key audit matter shall include a reference to the related disclosures, if any, made in the financial statement. Okay, if at all any description of this key audit matter has been made in the financial statements, then auditor has to make a reference to that description in the financial statements. Okay, circumstances where matter determined as key audit matter is not communicated. Okay, when will you not communicate a matter even though it is determined as a key audit matter? See, if law or regulation precludes the auditor in the public interest, okay, this matter is a key audit matter, but law or regulation says that even though that matter is a key audit matter, you should not communicate it, then auditor should not communicate it. Or auditor feels that the positive impact of communicating this key audit matter is lesser when compared to the negative impact that will generate. Okay, in the situation also auditor will not communicate key audit matter. See, auditor determines the adverse consequences of doing so would reasonably be expected to outweigh the public interest benefits of such communication. Let's say, for example, the entity has developed a formula with respect to certain medicine. Now, auditor considers this as key audit matter. Now, if auditor communicates about this formula in his audit report, this formula will be leaked to all the people, right? So, this will cause loss to the entity. So, here, adverse effect of communicating key audit matter is more when compared to the benefit of comparing the key, benefit of communicating the key audit matter. So, auditor should not communicate key audit matter even though it is a key audit matter. Okay? Yes. This shall not apply if entity has already disclosed the information publicly. Okay, if that information is already available publicly, then it doesn't cause any new loss because of communicating this matter, because it is already available in a public, so you can communicate. Okay. Next, what if there are no key audit matters to be communicated? See, in case of listed entity, if there are no key audit matters to be communicated, then you have to specify the same, that there are no key audit matters to be communicated. Okay. See, include a statement to this effect in a separate section of the auditor's report under the heading key audit matters. Okay, under key audit matters, you have to say that there are no matters to be communicated as key audit matters, but you have to include key audit matter paragraph in the audit report of a listed entity. You cannot skip that paragraph. Okay, you must include the paragraph key audit matter paragraph. Okay, if there are key audit matters, you will communicate. If there are no key audit matters, you will say that there are no key audit matters. Hope that is clear. Okay, by this we have completed discussion of key audit matter paragraph SA 701 in the. Okay, now I will open the PPT of SA 706, emphasis of matter and other matter paragraph, right? Yes. Now moving to SA 706. SA 706 deals with emphasis of matter and other matter paragraph. Okay, in this standard we will be learning what is meant by emphasis of matter paragraph, what is meant by other matter paragraph, when we will be using this EOM paragraph and when we will be using this OM paragraph, and where these paragraphs has to be used. Okay, all these aspects we will be covering in this standard. First of all, we will see this emphasis of matter paragraph. What is meant by this emphasis of matter paragraph? Generally speaking, if auditor wants to communicate about a significant matter that has already been presented in the financial statements, okay, an item which is already presented or disclosed in the financial statements, and auditor feels that understanding of that item is very much important to the users in order to understand the financial statements, then auditor can emphasize such matter in his audit report under emphasis of matter paragraph. Okay, if you see the name of the paragraph, emphasis of matter, emphasize means you are stressing a matter that is already presented in the financial statements, which is significant for users understanding of the financial statement. Okay, those type of matters you will present or you will communicate in the emphasis of matter paragraph. See, a paragraph included in the auditor's report that refers to a matter appropriately presented or disclosed in the financial statements. Okay, the matter appropriately presented or disclosed in the financial statements, already that matter is disclosed in the financial statements, and that in the auditor's professional judgment is of such importance that it is fundamental to users understanding of the financial statements. Okay, and auditor feels that matter is very much fundamental, very much important for the users to understand the financial statements. Then auditor will communicate such matter in emphasis of matter paragraph. Okay, note, to present a particular matter in emphasis of matter paragraph, it should have already been presented or disclosed in the financial statement. Okay, if the matter itself is not disclosed or presented in the financial statements, you cannot communicate that matter in the audit report in emphasis of matter paragraph. Okay, to communicate a particular matter in emphasis of matter paragraph, it should have already been presented or disclosed in the financial statements. Next, some of the examples of emphasis of matter paragraph. See, uncertainty relating to future outcome of exceptional litigation. Okay, there is a court case pending against the company. Okay, now if that court case turns against the company, then company have to pay certain huge sum of penalty. Now this matter is disclosed in the financial statements. Now auditor feels that this is very much important for the users to understand the financial statements. Then auditor will communicate this matter in emphasis of matter paragraph. Next, significant subsequent event. Okay, an important subsequent event has been disclosed in the financial statements. It can be communicated in emphasis of matter paragraph by the auditor. Early application of a new accounting standard. Okay, a new accounting standard has been issued by MCA. Now the applicability of that accounting standard is from next year, but our entity has prepared the financial statements as per that accounting standard from current year only. So early application of accounting standard can also be communicated through emphasis of matter paragraph. Okay, provided this matter is already disclosed or presented in the financial statements. Next, a major catastrophe that has or had continues to have a significant effect on the entity's financial position. Okay, this also you can communicate in the emphasis of matter paragraph. Alert the users that financial statements are prepared as per special purpose framework. Okay, if the entity has prepared the financial statements as per special purpose framework and that is already disclosed in the financial statements, then auditor can communicate this point in emphasis of matter paragraph. Next, when financial reporting framework prescribed by law or regulation would be unacceptable, but for the fact that it is prescribed by law or regulation. Okay, the financial reporting framework is unacceptable for the auditor, but for the fact that it is prescribed by law or regulation, the entity has prepared the financial statements as per that financial reporting framework. Now you can communicate this in the emphasis of matter paragraph. Okay, now you can remember that if auditor wants to communicate something about the financial statements, okay, then auditor can communicate such matter in emphasis of matter paragraph, provided that matter is already disclosed or presented in the financial statements. Hope that is clear. Next, important points regarding the emphasis of matter paragraph. Certain important points, let us see. Auditor would not be required to modify opinion because of this matter. Okay, if auditor has given emphasis of matter paragraph, then it doesn't mean that auditor has modified his opinion with respect to that particular matter disclosed or communicated in the emphasis of matter paragraph. Okay, you should understand that giving emphasis of matter paragraph doesn't mean that auditor has modified his opinion. Okay, and also if because of a particular matter auditor wants to modify the audit opinion, then that matter should not be presented in the emphasis of matter paragraph. Hope that is clear. There are 2 points. Okay, first point and sixth point. Sixth point is that if auditor gives emphasis of matter paragraph, it doesn't mean that auditor is modifying the audit opinion. First point is that if auditor has modified the opinion because of a particular point, then that point should not be included in the emphasis of matter paragraph. Hope you are understanding. Okay, it doesn't mean that auditor should not modify the opinion if he gives emphasis of matter paragraph? No. In the audit report, auditor can modify the opinion and also can include emphasis of matter paragraph both, but the point because of which auditor has modified the opinion should not be presented as emphasis of matter paragraph. Okay, should not be presented in emphasis of matter paragraph. Okay, certain other item because of which auditor has not modified the opinion, that item can be presented in emphasis of matter paragraph. Okay, hope you understood this clearly. Here there are 3 points to understand. First of all, giving emphasis of matter paragraph doesn't mean that auditor has modified the opinion. This is the first point that you need to understand. Next, if at all auditor has given modified opinion because of a particular point, the same point should not be communicated in the emphasis of matter paragraph. That is the second point. Next, third point, auditor can both give modified opinion as well as give emphasis of matter paragraph in the auditor's report, but the point because of which auditor has modified the opinion should not be, okay, that same point should not be presented in emphasis of matter paragraph. Hope you understood this. Next, matter has not been determined to be key audit matter. Okay, the matter which the auditor is communicating in the emphasis of matter paragraph, okay, that same matter should not have been determined as key audit matter. Okay, if auditor has determined a particular matter as a key audit matter, he will present that in key audit matter paragraph. Then why again to present it in the emphasis of matter paragraph? Okay, repetition is not required. Okay, next, use the heading that includes emphasis of matter. Okay, for emphasis of matter paragraph, the heading should be should include the term emphasis of matter. Okay, next, include a clear reference to the matter being emphasized. Okay, in the emphasis of matter paragraph, you have to clearly give a reference to the financial statements where this matter that the auditor is communicating has been presented or disclosed. Okay, there will be notes in the financial statements, right? So that particular note number you have to give reference. Okay, there should be a clear reference. Next, refer only to information presented or disclosed in the financial statements. This point we have already discussed. Okay, if the information is not at all presented or disclosed in the financial statements, how can you emphasize that matter in the emphasis of matter paragraph? It is not possible, right? Next, other matter paragraph. Now, in the emphasis of matter paragraph, auditor will communicate something about financial statements, right? Now, if auditor wants to communicate to the users about the audit that he has conducted, then he will use other matter paragraph. Okay, see, other matter paragraph is used to communicate something about the audit. Emphasis of matter paragraph is used to communicate something about the financial statements. Hope you understood. See, a paragraph included in the auditor's report that refers to matter other than those presented or disclosed in the financial statements, that in the auditor's judgment is relevant to users' understanding of the audit. Okay, if auditor wants to communicate something that is relevant for the user's understanding of the audit, then auditor will communicate that matter in other matter paragraph. The auditor's responsibilities or the auditor report. Okay, if auditor wants to communicate something about the audit or auditor's responsibility or the auditor report, then auditor will use other matter paragraph. And this matter that is communicated in the other matter paragraph should not have been disclosed or presented in the financial statements. Okay, you see, we have covered this almost entire standard in around 10 to 15 minutes. The same standard in the regular class we'll discuss for 1.5 hour to 2 hours, right? We'll be discussing with examples and all those things. But since this is a revision class, I am trying to complete this standard with utmost explanation in as much as little time as possible, so that you can quickly revise it at the time of examination, right? Sorry, this one, right? Yeah, certain important points regarding other matter paragraph. Let us see. The same points that we have discussed for emphasis of matter paragraph. If you have determined a particular matter as key audit matter, then the same should not be presented in other matter paragraph. Okay, see. This matter has not been determined as key audit matter. Next, this should not be prohibited by law or regulation. Okay, use the heading that includes other matter. Okay, for this paragraph, the heading should include the term other matter. Okay, next, finally, communication with those charged with governance. See, if auditor wants to include emphasis of matter paragraph or other matter paragraph, or if he wants to give modified opinion, then he has to communicate his intention, okay, his expectation and the wording in which he will communicate these matters. Okay, the same has to be communicated to those charged with governance. See, if auditor expects to include emphasis of matter or other matter paragraph in the auditor's report, auditor shall communicate with those charged with governance. Regarding what? Regarding the expectation that he wanted to communicate. Other matter paragraph or the emphasis of matter paragraph, and the wordings of this paragraph should also be communicated. Hope that is clear. So by this we have completed discussion of essay 706. Okay, we have hardly taken some 12 to 13 minutes, right? Now we'll shift to revision of essay 710. Let me open that PPT. Yeah, now moving to next standard, that is essay 710. Essay 710 deals with comparative information. Now this comparative information, it is of two types. One is corresponding figures, comparative financial statements. See, in the financial statements, we will give the previous year period, previous year figures, right? First of all, we will present the current period figures. Beside that only, we will present previous year figures. That is known as comparative information. Okay. Now, this comparative information is of two types. One is corresponding figures. Okay. In the general balance sheet or general profit and loss statement, we will give the previous year figures. That is known as corresponding figures. Okay. We also have comparative financial statements. Now here the difference is that we will give entire financial statement of the previous year for the comparison purpose in the current period also. And in case of corresponding figures, the auditor's report will not refer to that corresponding figures. Whereas if comparative financial statements are presented, auditor's report, his auditor's opinion should refer to that comparative financial statements also. Okay, we'll discuss all that. I'm just giving a brief. So essay 710. Oh. Comparative information. Okay, so the comparative information is of two types. One is corresponding figures. Corresponding figures means generally we'll give, right, the figures of current year, previous year. That is known as corresponding figures. And comparative financial statements means along with the financial statements of current year, we will also give the financial statements of previous years. Okay, now the difference between these two is that in case of corresponding figures, auditor's opinion will not refer to these corresponding figures, whereas in case of comparative financial statements, auditor opinion will also refer to these comparative financial statements. Hope that is clear. Now, comparative information. What is meant by comparative information? The amounts and disclosures included in the financial statements in respect of one or more periods in accordance with applicable financial reporting framework, right? This is known as comparative information. Now this comparative information, it is of two types. One is corresponding figures. What is meant by corresponding figures? Comparative information where amounts and other disclosures for a prior period. Okay, if you are preparing financial statements of 24-25, you will also present the amounts, figures of 23-24 as an integral part of current period financial statements. Okay, you can read the corresponding figures only with reference to the current period. Okay, see, for prior period are included as integral part of the current period financial statements and are intended to be read only in relation to the amounts and disclosures relating to the current period. Okay, you can read the corresponding figures only in relation to the current period financial statements, whereas if you include comparative financial statements, you can read comparative financial statements separately also. Okay, you can read those comparative financial statements either separately or in relation to in relation with the current period financial statements. Okay, see, next, comparative financial statements. Now, comparative financial statements is also one type of comparative information where amounts and other disclosures for prior period are included for comparison with the financial statements of current period, but if audited or referred to in the auditor's report. Okay, if comparative financial statements are presented by the management, then auditor's report should give opinion on that comparative financial statements also, whereas if management presents corresponding figures, auditor opinion need not refer to that corresponding figures. Okay, next, audit procedures. What are the specific audit procedures that the auditor will perform? See, auditor, he has to first of all ensure that comparative information agrees with the amounts and disclosures presented in the prior period. Okay, in the prior period you would have prepared a balance sheet to profit and loss statement. Okay, the same figures you have to get and write in the current period as corresponding figures. So auditor has to check whether the corresponding figures that are presented in the current period financial statements are matching with the figures of previous year's financial statements or not. Okay, next, accounting policies has to be followed consistently. Okay, whatever the accounting policies that you have followed in the previous period, the same accounting policies you have to copy and paste them in the current period also. Okay, you have to follow the same accounting policies. If at all there is any deviation in the accounting policy in the current period, then such a deviation has to be properly accounted for and disclosed. See, changes in accounting policies have been properly accounted in the current period financial statements. Okay, next, still the further audit procedures. See, in order to identify whether there are any possible misstatements in the corresponding figures, auditor has to perform audit procedures. Okay, to obtain sufficient appropriate audit evidence that there are no misstatements in the corresponding figures or the comparative information. Okay, next, if auditor had audited the prior period financial statements, see, if the auditor has audited prior period financial statements also, okay, auditor is auditing current period financial statements and the same auditor has audited prior period financial statements also, then he needs to see or he needs to comply with the requirements of SA 560, that is subsequent events statements. He shall follow the requirements of SA 560. Okay, subsequent events, because he was also the auditor of previous year. After completing the audit of previous year, some subsequent events have taken place. Whether those subsequent events were actually included in that previous year's financial statements or not, the auditor needs to once go through. Okay, now written representation has to be requested for all periods referred to in the auditor's opinion. Now the auditor, he has to take written representation. Now, for which periods the auditor will take written representation? For whatever periods the auditor is referring in the audit report, for them he has to take written representation. Now, in case of corresponding figures, auditor will refer only current period in his audit report. So, in case corresponding figures are presented, auditor will take written representation only for current period. If in case comparative financial statements are presented, auditor in his audit report should refer to those comparative financial statements statements also. So auditor will ask for written representation for all the periods of which comparative financial statements are presented in the current period financial statements. Okay. Now reporting with respect to corresponding figures, that means just the amounts of previous year are presented as an integral part of financial statements. Now in this situation, what will be the reporting aspect? Let's see. Auditor's opinion shall not refer to corresponding figures except in the following cases. Okay, we have already discussed. If corresponding figures are presented, auditor should not refer to such corresponding figures in his audit report, right? But there are exceptions. That means in these exceptional situations, auditor has to refer in his audit report even the corresponding figures. What are those exceptions? We'll see. Prior period included a modified opinion, and matter which gave rise to modified opinion is unresolved. See, in the prior period, the auditor has expressed modified opinion, okay, either qualified or advised or qualified or disclaimer, and the matter which have given rise to such a modification is still unresolved in the current period also. In such a situation, even though in the financial statements corresponding figures are presented, auditor in his audit report should refer to corresponding figures stating that the opinion with respect to the corresponding figures was modified in the previous period and the same has not yet been resolved even in the current period also. Okay, like this, auditor will make a reference to the corresponding figures. Hope that is clear. If the matter which gave rise to modification of the corresponding figures is not yet resolved. Next situation in which auditor will make a reference to the corresponding figures. If auditor has sufficient evidence that a material misstatements existed in the financial statements of prior period which was not addressed earlier. See, in the prior period there is a material misstatement. That material misstatement was not known in the prior period, but during the audit of current period, that material misstatement has come out. Now, auditor came to know that material misstatement is not addressed, that is carried forward. In this situation also, the corresponding figures, there is material misstatement, right? So, auditor will refer to corresponding figures in his audit report of the current period. Okay, simply you can remember that if there is a material misstatement in the prior period and it has not been resolved, it is carried forward now also, then you have to refer to the corresponding figures in your audit report. In except these two situations, you need not refer corresponding figures in your audit report. Whereas if you are giving comparative financial statements, you must refer comparative financial statements in your audit report. Okay, you must give your opinion on the comparative financial statements also. Next, reporting with respect to comparative financial statements. See, auditor's opinion shall refer to each period of which financial statements are presented, right? Next, if auditor's opinion on prior period financial statements in current period differs from the opinion previously expressed, disclose the reasons for the same in other matter paragraph. Now, what is this? See, auditor, see, first of all, management has presented comparative financial statements in the current period. That means the financial statements of previous year are also presented in the current period. Now, in the previous year also, auditor would have audited those financial statements and he would have expressed the opinion. And in the current period, since comparative financial statements are presented, auditor should also express the opinion on comparative financial statements also. Now, while expressing the opinion on comparative financial statements, auditor is deriving a different opinion than the opinion that he has previously given on the previous year's financial statements. In such a situation, auditor has to give this matter in other matter paragraph, stating that in the previous year I have given this opinion on the previous year financial statements, but the same financial statements have been presented as comparative financial statements in the current period, but I am giving this type of opinion, a different opinion on comparative financial statements. Why? What is the reason? You have to explain clearly in the other matter paragraph. Hope this is clear. Okay, you can say this is important. You need to remember this. Okay, next. Material misstatement in the prior period financial statement, but predecessor or auditor reported without modification. See, the previous year financial statements are audited by some other auditor, and that auditor has not reported a material misstatement. Okay, there is a material misstatement in the financial statements of previous year, but that auditor has reported without modifying the opinion. He has given unmodified opinion. Now, the current auditor has found out that there is a material misstatement and that has to be corrected. Now, the management has to communicate the same to the predecessor auditor. Okay, you auditor, during the audit you found that there are misstatements in the prior period. Now you have to tell the management in the previous year audit or in the previous year financial statements there are misstatements, but the auditor has given unmodified opinion. You please communicate the same to the predecessor auditor. Now management will communicate to the predecessor auditor. Now if management changes the previous year's financial statements and predecessor auditor also changes his audit report, then the auditor, the present auditor, need not refer to that modified opinion. Okay, he can just give his opinion on the current period financial statement. See, communication with management and those charged with governance, and request the predecessor auditor to be informed. If prior period financial statements are amended and predecessor auditor issues a new report, current auditor shall report only on the current period. Okay, if predecessor auditor doesn't give a new report, then current period auditor should give a different opinion on the comparative financial statement also. Okay, next. This reporting, it is common for both, whether it is comparative financial statements or it is corresponding figures. See, in case of corresponding figures, you have to remember that you should not refer to the corresponding figures in the audit report except if there are misstatements in the previous period and they are not resolved. Okay, next, coming to comparative financial statements. In case of comparative financial statements, you have to refer comparative financial statements in the current period also, in the current period audit report also, that you need to remember. Next, coming to the reporting that is common to both. See, prior period financial statements audited by predecessor auditor. Okay, the prior period financial statements are audited by predecessor auditor, and in such a situation, okay, if at all the prior period financial statements are audited by predecessor auditor, then the current auditor in his audit report in other matter paragraph, he must tell that previous year's financial statements audited by some other auditor. See, prior period financial statements audited by predecessor auditor, and type of opinion that he has expressed. Okay, what type of opinion predecessor auditor expressed, you have to communicate in the other matter paragraph. Next, date of that report. What is the date of that report? You should communicate in other matter paragraph. See, this has to be communicated in both the situations, whether management has presented corresponding figures or the management has presented comparative financial statements. In both the situations, auditor in the other matter paragraph, auditor means which auditor? Current auditor. In the other matter paragraph has to mention that previous year's financial statements audited by predecessor auditor and the type of opinion that he has expressed and the date of audit report of that previous year's financial statements. Okay, next, prior period financial statements are not audited. If prior period financial statements are not audited, in the other matter paragraph you have to mention the same. See, state in other matter paragraph that comparative financial statements are unaudited. Okay, so this is SA 710. Now we will move to SA 720, the last standard of this 700 series. Yes, this standard SA 720, we will discuss it from our audit concise book. Okay, for this there is no PPT, we will directly discuss this from our concise book. Yeah, SA 720. Now this SA 720 deals with auditor's responsibility with respect to other information. Now you can get it out. What is meant by other information? Now if you see, the entities, the companies, they will present their financial statements to the users in the form of an annual report. Okay, there will be this much of book You will call it as annual report. Now in that annual report, the companies will present financial statements, audit report. Okay, apart from audit report and financial statements, there will be various other information that will be included in this annual report. Okay, that all other information that is included in the annual report apart from the financial statements and audit report is known as other information. Okay, now auditor is having certain responsibility with respect to other information. Okay, see, auditor will not express any opinion on the other information, but since the financial statements and audit report are given along with that other information, auditor has to ensure that the other information is not inconsistent with this financial statements and audit report. Hope that is clear. So for that purpose, auditor should read the other information and he has to check whether this other information is matching with the financial statements and the knowledge that he is already having. Okay, that is the auditor's responsibility as per SA 720. If you see, I have explained the entire SA 720 in just 1 minute. Okay, this is the crux of SA 720. Now see, annual report, the definition of annual report they have given, just now we have discussed, right? The companies, they will give the financial statements and audit report in the form of an annual report. This annual report will contain various other information like the sales growth, various ratios, management report, directors report, okay, chairman's message, like this various information will be there in this annual report. All this information together you call as annual report. Okay, and other information, just now I have told you. Okay, in the annual report, apart from financial statements and audit report, remaining all other information is known as other information. Okay, next, examples of such other information. See, what will be such items that will be included in the annual report? Let's see. Summary of key financial results, capital expenditure segment wise that has been made by the entity, financial measures or ratios, explanation of critical accounting systems and related assumptions, identification of related parties, general description of business environment and outlook. Okay, like this various other information will be included. Okay, if you want, you can just search on the Google for the annual report of Reliance Industries or annual report of TCS or Wipro. You will find, okay, some 300-400 pages of PDF you will find. You can go through it. Okay, now objectives. What is the objective of the auditor as per SA 720? See, objective of the auditor is to consider whether there is a material inconsistency between what? Between other information and the financial statements. See, other information and the financial statements, or other information and the knowledge that the auditor has obtained during the audit. See, other information and the auditor's knowledge obtained during the audit. Auditor has to check whether there is any material inconsistency between these two. If at all there is a material inconsistency, auditor has to report accordingly. See, respond accordingly. This is the objective of the auditor. Now, obtaining the other information, how the auditor will obtain other information? Obviously, he will ask the management, because management prepares the other information, right? So auditor will discuss with the management, you will prepare annual report. So in that annual report, what information you are giving? Then management will respond, we are including this information, we are including that information, like that management will respond. Once management says that, auditor will ask management, before giving that information to the public, you please once give me that information so that I will read that information. Okay, in case of audit of, see, mostly auditor should try to get this other information from the management before the date of audit report. Okay, before the auditor signs the audit report, okay, before that date only, auditor should take this other information from the management and should read this and find out whether there is any inconsistency between this other information and the financial statements. However, in such certain exceptional situations, management might have not yet prepared that other information. In such situations, auditor can sign the audit report, but auditor should take a written representation from the management, asking the management that you should provide me the other information once it has been prepared, before you furnish that other information to the public. Okay, before you issue the other information to the public, you have to first of all give it to me. After I read it, only then you can issue to the public. Like this, you have to take a written representation from the management. See how the auditor will obtain other information. He will, by discussion with the management, will get to know what is included in the annual report, and that will be other information. Now, make appropriate arrangements with the management to what? To obtain in a timely manner, if possible, prior to the date of audit report, all the other information that is included in the annual report, that is the final version of the documents. If in case, see, when some or all of the documents determined in will not be available until after the date of auditor's report, in such a situation, auditor can sign the audit report, but take a written representation that final version of the documents will be provided to the auditor prior to its issuance to the public. Okay, prior to its issuance by the entity. Okay, this way auditor will obtain other information. Now, once auditor obtains other information, what he has to do? He has to read it. Okay, while reading it, what the auditor has to do? Auditor has to see whether this information is not consistent with the financial statement. Auditor has to find out that whether this information is not consistent with knowledge of the auditor that he has obtained. Okay, he has to see that. See, auditor shall read the other information, and while reading, he shall consider whether there is a material inconsistency between other information and the financial statements, or material inconsistency between other information and the knowledge of the auditor. Next, while reading the other information, auditor shall remain alert for indications that other information not related to the financial statements or auditor knowledge might in the audit appears to be materially misstated. Okay, not only this, the auditor should also check other information that is irrelevant for the purpose of financial statements, and other information that is not relevant with respect to the auditor's knowledge, whether such a type of other information is also misstated. Auditor has to check this. Okay, not only he should check not only that the other information is not inconsistent with the financial statements and auditor knowledge. Okay, if other information is having nothing to do with financial statements or the auditor's knowledge, even then auditor has to see whether that other information is misstated. Okay, next, now if he finds that there is a inconsistency between other information and the financial statement, see, auditor has not yet found misstatement, he just found inconsistency. Okay, not matching. Okay, other information is not matching with the financial statement, or other information is not matching with the knowledge of the auditor. In such a situation, what he has to do? He has to first of all communicate with the management. Management, other information is not matching with the financial statement, other information is not matching with my knowledge. Okay, like this he has to communicate. After that, he has to verify where the misstatement exists. Okay, just because of the fact that other information is not matching with the financial statement, it doesn't mean that other information is misstated. Okay, even the financial statements might be misstated. Okay, other information might be correct only, financial statements might be misstated. That is the reason why both might not be matching. So auditor has to identify where the misstatement exists, whether the misstatement is in the other information, or the misstatement is in the financial statement, or the misstatement is in the auditor's knowledge that he has obtained. Okay, that he needs to identify. See, if auditor identifies that material inconsistency appears to exist, see here auditor has not yet identified misstatement, he just identified inconsistency. Okay, not matching. Then see, he shall discuss the matter with management, and he needs to conclude whether material misstatement of other information exists. Okay, whether there is a material misstatement in other information, or material misstatement of financial statements exist, or the auditor's understanding of entity and its environment needs to be updated. Okay, whether he has not properly whether he has not properly gained the knowledge about the entity during the audit. In such a situation, he has to update his knowledge so as to match with the other information. Okay, now in this step, auditor has found out misstatement. Okay, either other information might be misstated or the financial statement might be misstated. See, if the financial statement is misstated, then obviously auditor will ask the management to correct the financial statement. If management doesn't correct the financial statement, then auditor will give modified opinion. Okay, either qualified advisor or disclaimer. That is a separate issue that we have discussed in SS 705. Now, what if there is a misstatement in other information? Then how the auditor will react? That we'll see. See, responding when auditor concludes that a material misstatement of other information exists. In this situation, see, if auditor concludes material misstatement exists, then auditor shall request the management to correct the other information. Okay, management, in the other information there is a misstatement, you please correct it. Now, if the management has corrected the misstatement in other information, then auditor will see whether management has actually corrected that other information or not. See, agrees to make the correction, the auditor shall determine whether the correction has been made or not. If refuses to make the correction, auditor shall communicate the same to those charged with governance. Okay, if management refuses to make the correction in other information, then auditor has to communicate to those charged with governance. Okay, higher level authority than the management. Those charged with governance, I have communicated to management that there is a misstatement in other information, but they have not corrected it. You please correct it. If those charged with governance corrects this, then again auditor will check whether the correction has been made or not. If those charged with governance also doesn't correct, then what the auditor will do? Then auditor will see whether this other information has been obtained prior to the date of audit report. Then see, if auditor concludes that material misstatement exists in the other information that is obtained prior to the date of audit report, in such a situation, okay, and it is not corrected by those charged with governance, in such a situation, considering the implications for the audit report and communicating with those charged with governance, okay, you have to consider implication on your audit report. Okay, because of this misstatement in the other information which has not been corrected by the management, will there be any implication on my audit report? Okay, will I have to give qualified opinion, or will I have to give any adverse opinion, or will I have to refer the uncorrected misstatement of the other information? Okay, the impact he needs to analyze, or he should also check whether he has to withdraw from the engagement because of that matter. See, withdrawing from the engagement where withdrawal is possible under applicable law or regulation. Okay, so this auditor has to do if other information is obtained prior to the date of audit report. Okay, here he can withdraw from the engagement because he has not yet issued the audit report. But in some situations we have discussed, the other information might not be available till the time auditor has signing his audit report. In such a situation, auditor will sign the audit report and he will give the audit report by taking a written representation from the management that management will give the audit report, will give the other information to the auditor before management publishes it. In such a situation, okay, if the auditor finds misstatement in the other information that has been obtained after the date of audit report, in such a situation, what the auditor has to do? See, if auditor concludes that material misstatement exists in other information obtained after the date of audit report, then if other information is corrected, then perform the procedures. Okay, if the other information is corrected by those charged with governance, then happy, you just check whether the correction has been made or not. If the correction has not been made, then you have to take appropriate action in order to bring to the notice of the users about this uncorrected misstatements in the other information. Okay, whatever action you want, you can take, but you have to communicate to the users of the audit report that there is uncorrected misstatement in the other information. See, if other information is not corrected after communicating with those charged with governance also, you have to seek to have the uncorrected material misstatements appropriately brought to the attention of users for whom the audit report is prepared. Okay, next, reporting. Now, if you see in the audit report, you will find a paragraph with the name other information. Okay, or you will find a paragraph with the name auditor's responsibility with respect to other information. Like this, you will find a paragraph in the audit report. You can check. Okay, now in case of listed entities, this other information paragraph will be there because auditor will include other information paragraph in the audit of listed entities if he has obtained the other information or he expects to obtain the other information. Okay, whether he has obtained the other information or he expects to obtain the other information from a listed entity, then he will include other information paragraph in the audit report. But in case of unlisted entity, he will include other information paragraph in the audit report only if he has already obtained the other information. Okay, if he expects to obtain the other information after the date of audit report, then he will not include the other information paragraph in the audit report. Hope that is clear. That is the difference between listed entity and unlisted entity. See, the auditor's report shall include a separate, just a second. Yeah, include a separate section with heading other information. Now, for an audit of financial statements of listed entity, the auditor has obtained or expects to obtain other information. In both the situation, you will include other information paragraph. But in case of audit of unlisted entities, auditor has obtained some or all of the other information. Only then you will include other information paragraph. Okay, only if you have obtained the other information, only then you will include. Okay, based on your expectation, you will not include other information paragraph in the audit report. In case of unlisted entities. Next, just a second. Next, when the auditor's report is required to include other information, then in this other information section, what auditor will mention? See, following points auditor will mention. What are they? What happened to this? Okay, see, a statement that management is responsible for the preparation of other information. See, auditor will not prepare the other information. Okay, in fact, auditor is also not having any responsibility to give opinion on the other information. Okay, he is just reading the other information in order to ensure that there is no inconsistency between financial statements and other information. That's it. He will not give any opinion on the other information also. So he needs to clearly mention that it is a responsibility of the management to prepare this other information. Okay, next, an identification of other information, if any, obtained by the auditor prior to the date of audit report. Okay, in case of listed entity, in case of unlisted entity, if at all prior to the date of audit report, if he has obtained any other information, he needs to identify that he has obtained this other information, and the other information that he expects to obtain after the date of audit report, that also you need to, okay, that also in case of listed entity, information that is expected to be obtained after the date of audit report. Okay, that also you need to refer in the other information paragraph. Next, statement that auditor's opinion does not cover this other information. This is important. Okay, auditor's opinion does not cover this other information. Auditor will never give his opinion on the other information. Next, a description of auditor's responsibilities relating to the reading, considering and reporting of the other information. Okay, auditor is having responsibility of what? To read this other information. The same he needs to communicate. Next, okay, next, when other information has been obtained prior to the date of auditor's report, then you need to include a statement that auditor has nothing to report, or if he has found out any misstatement, then he needs to include that misstatement in the other information, in the other information paragraph. Okay, if the auditor finds out any misstatement, we have seen first auditor will identify the inconsistency. Based on the inconsistency, auditor if identifies misstatement in the other information, then such misstatement has to be communicated where? In the audit report, in other information paragraph. Okay, hope this is clear. So by this we have completed the discussion of SS 720 also, and so by this the entire 700 series gets completed. Okay, in this chapter still we are having Caro and reporting under Companies Act. Now I wanted to keep this video exclusively for standards on auditing, so I have stopped this discussion till 700 series standard. We will discuss Caro in a separate video. Okay, in such a separate video where I discuss Caro, I will also discuss about reporting responsibilities under Companies Act. Okay, so in the other video where I discuss Caro, in the same video I will also be discussing about the reporting responsibilities under Companies Act. So this entire video we have completed discussion of SS 700 series standard, right? So before winding up the class, a small announcement. We have launched Lecturepedia app. On this Lecturepedia app, you can practice MCQs for free of cost, and apart from these, you can also buy courses of various topmost faculties. Okay, almost all the faculties are available on Lecturepedia app and the website. Okay, you can download Lecturepedia app from the Play Store. Okay, I will be winding up this video. We'll meet in the next video. Until then, take care. Bye bye. See you.
Now we will see the standards with respect to risk of material misstatement, that is SA 315 and also SA 330. After auditor assess the risk of material misstatement, what responses auditor will design, and also SA 450 evaluation of misstatements identified during the audit, right? Along with these three, we will also discuss SA 320 materiality. Okay, these four standards we will cover in this video. Along with this, for SA 265 also will cover a small standard. Okay, so these are the 5 standards that we are going to revise in this video. Okay, let's start. So if you see in our audit concise, we have covered these standards under 4th chapter. The name of the chapter is materiality, which is dealt by SA 320 risk assessment and internal control, which is dealt by SA 315, 330, 450, right? Now, yeah, if you see the standards that we are going to cover, SA 315, which is identifying and assessing risk of material misstatement through understanding the entity and its environment. If you see the auditor, he will not conduct the audit just like that. Okay, before starting the audit, auditor will assess the risk of material misstatement. Based on the risk of material misstatement, auditor will determine the audit procedures that has to be performed. That is SA 330, auditor's responses to assessed risk. Okay, as per SA 315, auditor will assess the risk. Okay, how much risk is there in each area and how much risk is there at overall financial statements level. Based on the risk, auditor will design his responses. Okay, auditor's responses are nothing but audit procedures. The further audit procedures, we'll call them as auditors responses. Okay, further audit procedures, you will again divide them into test of controls and test of details, right? All that we will discuss next. Now, during the audit, you would have found certain misstatements. How you will evaluate those misstatements, that will be dealt by SA 450, evaluation of misstatements identified during the audit. Okay, next. Now, auditor is concerned only with material misstatements. Okay, he is not concerned with all the misstatements. So what is materiality? That will be dealt by SA 320. Okay, materiality in planning and performing the audit. And finally, okay, these are the 4 standards that deal with materiality, risk assessment and audit procedures. And we will also cover SA 265, communicating significant deficiencies in internal control to those charged with governance. Okay, now before starting, we have to understand a particular term, assertion. Now, what is meant by assertion? See, assertion means statements made by the management stating that they are true. Okay, now let's say, for example, the financial statements will be prepared by the management, and management, after preparing these financial statements, they will give these financial statements to the auditor for the purpose of audit. That means management is making a assertion that in the financial statements, in the balance sheet, there will be assets, right? So all those assets which are present in the balance sheet belongs to management. Okay, this assertion, belongs to company. Okay, this assertion is being made by the management to the auditor. In the same way, there will be sales in the profit and loss account, right? Now the sales amount is the correct amount of sales that has occurred during the year. This is the assertion that the management is making to the auditor. Okay, so assertions means facts or statements that the management makes to the auditor. Now, after management makes the assertion, the duty of the auditor is to verify whether those assertions are correct or not. Okay, how auditor will verify? By performing audit. Auditor will verify whether assertions made by the management are correct or not. See, assertions are the representations made by the management, either explicit or otherwise, that are embodied in the financial statements. Hope that is clear. Hope you understood what is meant by assertion. Now, there are various categories of assertion. See, management will make assertions with respect to 3 categories. See,
Firstly, assertion with respect to class of transactions and events. That means assertions with respect to profit and loss statement. Okay, where transactions will be shown in the profit and loss statement. Next, assertions with respect to account balances. That means assertions with respect to balance sheet. So, where the account balances will be reflected in the balance sheet. Next, assertions with respect to presentation and disclosure. Okay, with respect to these three categories, management will make assertions. Now we will see the assertions of each of this category one by one. See, assertions about class of events and transactions. There will be 5 assertions that the management can make with respect to class of transactions and events, that is with respect to profit and loss statement. So what are those assertions? First one, occurrence. That means whatever the transactions that have been shown in the profit and loss statement have actually occurred, that is known as occurrence assertion. See, whenever management is giving the profit and loss statement to the auditor, it means that management is making an assertion to the auditor that all the transactions shown in the profit and loss statement have actually occurred. That is the first assertion. Next, accuracy. Okay, whatever the amount of transaction that has been shown in the profit and loss statement is calculated accurately. Okay, that is all. That is the second assertion that the management will make to the auditor with respect to the profit and loss statement. Next, completeness. Okay, whatever the transactions have occurred, all the transactions we have reflected in the profit and loss statement. Okay, we haven't missed any transaction. That means complete transactions have been reflected. That is the third assertion. Next, cut-off procedures. Now, profit and loss statement will be prepared for a particular period. Let's say from 1st April 2024 to 31st March 2025. That means in the profit and loss statement, you have to reflect only those transactions that have occurred between this period, right? That is known as cut-off assertion. Okay, we have not considered any transactions that have occurred before 1st April 2024 or that have occurred after 31st March 2025. We have considered only those transactions that have occurred in this period. That is known as cut-off assertion that the management will make. Next, classification. We have properly classified the transactions. That means revenue transactions has to be properly classified. Direct expenses has to be properly classified. Indirect expenses has to be properly classified, right? So classification has been done properly. This is the fifth assertion that the management will make with respect to transactions and events. Next, assertion with respect to account balances. There will be 4 assertions with respect to account balances. Let us see. First one, existence. Now, account balance means you have to remember balance sheet. Now, in the balance sheet, there will be assets. Now, when management is giving balance sheet to the auditor, management is making an assertion that whatever the assets are shown in the balance sheet, they are actually present. Okay, they are actually in existence. Okay, that is the assertion that the management is making. And liabilities, whatever liabilities is shown in the balance sheet, they are actually in existence. That is the existence assertion. Next, completeness. Same, complete assets have been shown, complete liabilities have been shown. Rights and obligations. See, whatever the assets are shown in the balance sheet, on those assets the company is having right over the asset, and the company is having obligation to discharge the liabilities that have been shown in the balance sheet, right? That is the assertion with respect to rights and obligation. Next, valuation and allocation. See, in order to value a particular asset, there will be certain procedures that has to be followed. So whatever the amount that is shown in the balance sheet as value of asset has been valued properly after considering depreciation, and if it is inventory, you have to value the inventory as a cost or NRV, whichever is lower. So you, as per the standards, as per the requirement, we have properly valued and allocated assets and liabilities. Okay, Those are the assertions with respect to account balances. Next, assertions with respect to presentation and disclosure. Again, occurrence, whatever the disclosure of events that have been made in the financial statements, they have actually occurred. Okay. Next, completeness, complete disclosures have been made. This completeness and occurrence or assertions that will be present for all the three categories. Next, classification and understandability. So whatever the disclosures that you make in the financial statements, they have to be understandable by the users, right? So understandability is the assertion. Okay, the disclosures that we have made in the financial statements will be understood by the users. Okay, that is the assertion that the management will make to the auditor. Finally, accuracy and valuation. Okay, if the disclosure is with respect to any transaction, then that amount should be accurate. If disclosure is with respect to any liability or asset, it has to be properly valued. Okay, so these are the assertions that the management will make to the auditor, right? Next, audit risk. Now what is this audit risk? Audit risk is the risk that auditor will give inappropriate audit opinion. Okay, this can be of two types. Inappropriate audit opinion is of two types. First situation, there are no misstatements in the financial statements, but auditor inappropriately gives the opinion that there are misstatements in the financial statements, right? This is audit risk. When there are no misstatements in the financial statements, auditor gives the opinion that there are misstatements in the financial statements. Now this type of audit risk will affect the efficiency of the auditor. Now, what is meant by efficiency? Efficiency means achieving the objective with as much as minimum resources as possible. That is known as efficient. Okay, if you have achieved the objective with lesser resources, it will be said that you have done the work efficiently, right? Now, in the inappropriate opinion, the first type of opinion, there are no misstatements in the financial statements, but auditor gave a opinion or auditor concluded that there are misstatements. Now, in order to identify the actual position or in order to identify the actual truth that there are no misstatements in the financial statements, auditor has to spend further more time. Auditor has to allot some more resources to do the audit again, because auditor has arrived at wrong opinion, right? There are no misstatements, but auditor arrived that there are misstatements. So in order to find out the actual position, auditor has to spend some more resources. Here, since some more resources has to be spent, the efficiency is being affected, right? See, financial statements does not have any material misstatement, but auditor gives opinion that financial statements are materially misstated. This will affect efficiency of the audit. This is the first type. Second type, there are misstatements in the financial statements, but auditor gives an opinion that there are no misstatements in the financial statements. Now this will affect the effectiveness of the audit. Now what is meant by effectiveness? See, achieving your objective is known as effectiveness. Okay, if you achieve your objective, then it will be said that you have worked effectively. Now what is the objective of the auditor? Objective of the auditor is to find out whether there are any material misstatements in the financial statements, right? Now in this situation, what happened? There are material misstatement, but auditor saying there are no material misstatement. That means he has failed to achieve his objective of finding material misstatements. So this will affect the audit effectiveness. Hope that is clear. So these are the two types of inappropriate audit opinions that the auditor can give. This is known as audit risk. See, financial statements has material misstatements, but the auditor gives opinion that there are no material misstatements. This will affect the effectiveness of audit, right? Now I have told that The objective of the auditor is to identify whether there are any material misstatements. Now, these material misstatements can occur either due to error or due to fraud. I think you already know what is meant by misstatement. I need not explain you what is meant by misstatement, I guess, but again I'll just repeat. Amount to classification, presentation, disclosure that has been made by the management is not as per the amount to classification, presentation, disclosure that is required as per the applicable financial reporting framework, then it is known as a misstatement. Okay, you can simply call it as ACPD that is made by the management is not as per the ACPD that is required as per the financial reporting framework, then it is known as misstatement. ACPD means amount to classification, presentation, disclosure. Right? We have discussed the same thing in our regular class. Right? This is known as a misstatement. Now, this misstatement can occur either due to fraud or due to error. Now, what is difference between fraud and error? Error is unintentional, whereas fraud is intentionally you are committing a mistake. That is error and fraud. So, misstatement can occur either due to error or due to fraud. Next, components of audit risk. Now, we have discussed that audit risk means the risk that auditor might give inappropriate audit opinion. Now, this audit risk is a combination of three types of risks. What are those three types of risks? You'll call them as components of audit risk. Firstly, inherent risk. Inherent risk means the risk that is present by birth is known as inherent. Okay, inherently there is that risk. For example, cash. The inherent risk for cash is theft, right? The nature of cash itself is such that it can be easily taken over by any thieves, right? So inherent risk with the cash is theft. That is an example for inherent risk. In the same way, let's say there are diamonds, right? The inherent risk for high value items is that it might be thefted, right? Someone might take over it. So inherent risk is the risk that is present by birth with it is known as inherent risk. If you see here, I have given the example of Tom and Jerry. The inherent risk is that when Tom finds Jerry, it will try to catch the Jerry and kill it. So the inherent risk for Jerry is with Tom. Okay, inherently by birth they are like that. Okay, Tom and Jerry, they are by birth they are like that, right? So that is known as the inherent risk. Next, control risk. Now, in order to reduce the inherent risk, controls will be implemented, right? Now, the control risk is the risk that controls might fail to detect, prevent, correct misstatements is known as control risk. Okay. Finally, detection risk. Auditor or the detection risk is the risk that auditor might not able to identify the misstatements during the audit. Okay, the combination of these three is audit risk. Now, inherent risk, I have already explained you what is meant by inherent risk. The example also I have given you. Next, control risk, I have explained you what is meant by control risk. Okay, the risk that controls might fail to detect, correct, or prevent misstatements is known as control risk. Examples: CC cameras are not working properly, or collusion where segregation of duties is implemented. That is control risk. Next, detection risk. Detection risk is a risk that auditor might not be able to identify the misstatements during the audit. That is known as a detection risk. Now, let us understand the formula of this audit risk. Just a second. Yes, now if you see, audit risk is equal to inherent risk multiplied by control risk multiplied by detection risk. Okay, combination of these three is audit risk. Now let's say for example cash. Now in the cash, the inherent risk of theft is, let's say, 50%. Okay, inherent risk is equal to 50%. That means the chances that cash will be subjected to theft if there are no controls is 50%. See, inherent risk is calculated when there is no controls. Okay, if there is no controls, then what is the probability for the cash to be subjected to theft is known as inherent risk of cash. Now let's say inherent risk of cash is 50%. That means there are 50% chances that if you keep the cash in your company without any controls, cash might be subjected to theft. There is 50% chances. Okay, now the objective is to reduce this risk as much lower as possible, right? Now in order to reduce this risk, what the management will do? Management will implement controls, right? Example of controls, they will maintain cash register, they will implement CC cameras. Okay, and whenever you are issuing cash for any payments, proper authorization is required. These are the controls, right? Now it is not possible that controls will reduce the risk completely. No, controls might not reduce the risk completely, they can reduce the risk to certain extent. So there is a possibility that controls might fail. So control risk, okay, control risk is 25%. That means the risk that controls might not able to prevent the misstatement, or in our example the risk that controls might not able to prevent the theft of the cash is 25%. That means of the total 50% risk, controls will reduce 75% risk of these 50%. Remaining 25% of 50%, even controls also cannot reduce. So here this is known as risk of material misstatement. See, inherent risk is 50%, right? So this 50% inherent risk is reduced by 70%. That means balance 25% is still risk is there. Okay, 75% of 50% inherent risk is removed with the help of controls, but still 25% of that 50% is still there, right? So here the control risk 25% means 25% of inherent risk. Okay, you should not take 25% of 100%. Okay, you are applying controls in order to reduce the inherent risk, right? So by applying controls you have reduced 75%, still balance 25% still is there, right? So 75% of 50% is removed, still 25% of 50% is there. That means 25% of 50% is 12, it will be 12.5, right? 25% of 50% is 12.5. Let's take it as 13%. So still 13% risk is there. You will call this as risk of material misstatement. Okay, why this is called as risk of material misstatement? Because it is not in the hands of the auditor. See, inherent risk, whether auditor can reduce that inherent risk? No, because it is present inherently. So inherent risk is not in the hands of auditor. Control risk, whether auditor can reduce control risk? No, because controls will be implemented by the management. So control risk is in the hands of management. So control risk is also not in the hands of auditor. Since control risk and inherent risk is not in the hands of auditor, and risk of material misstatement is obtained by multiplying inherent risk and control risk, risk of material misstatement is also not in the hands of auditor. Okay, since it is not in the hands of auditor, we are calling it as risk of material misstatement. Okay, to whom it is risk? It is risk to the auditor. Okay, now what the auditor will do is, auditor, by performing audit procedures, he will try to reduce this risk of material misstatement to as much as lower as possible. Okay, if let's say in our example, risk of material misstatement is 13% only, but let's say risk of material misstatement is 75%. Okay, by calculating this formula, we have got risk of material misstatement as 75%. That means a huge risk of material misstatement. Since risk of material misstatement is very huge, auditor will keep detection risk very low. Okay, if risk of material misstatement is very low, then auditor will keep detection risk very high. This risk of material misstatement and detection risk are inversely proportionate. Okay, now in our situation, the risk of material misstatement is 13%. Right, now auditor wants to keep audit risk as only 2%. Okay, or let's say only 1%, in order to make the calculation easy. Auditor wants to maintain audit risk as only 1%. Now audit risk is a combination of risk of material misstatement, which is 13%, multiplied by detection risk. See, this is how practically auditor will calculate. So how much detection risk auditor has to keep in order to make entire audit risk as 1%. Now how to calculate this? Detection risk is equal to 1 divided by 13, right? That means 1 by 13 is like, I guess I need to have a calculator. So detection risk is somewhere around 7%. Okay, 13 multiplied by 7% is equal to 0.91. Okay, around 8% you can take. That means that if detection risk is 8%, then overall audit risk will be reduced to 1%. Okay, so detection risk means the risk that audit procedures will not identify the material misstatements is known as detection risk. See, this detection risk, this percentage you will apply on risk of material misstatement. Hope you are understanding. So if detection risk is 8%, then entire audit risk will be 1%. If let's say for example we have got the risk of material misstatement as 75%, or let's not say, just a second, let me keep this as it is. I just want to explain you how this is inversely proportionate. 13%, right? Let's say the risk of material misstatement, we have got it as some 30%. Okay, risk of material misstatement, we have got it as 30%. Now we need to identify the detection risk, and auditor wants to keep the overall audit risk as 1% only. Now what will be detection risk here? If you calculate 1 divided by 30 into 100, it would be 3%. 3.33 it is showing, 3.3%. So detection risk has to be 3.3%. Now if you see, if let me change the color. Okay, let me keep this only. See, if the risk of material misstatement is 13%, detection risk was 8%. Now if you increase the risk of material misstatement to 30%, detection risk reduces to 3.3%. So that is why I told both are inversely proportional. Okay, if risk of material misstatement increases, auditor tries to keep detection risk lower. If risk of material decreases, auditor will accept high detection risk. Hope you understood. Okay, now so the formula of risk, I have already told you. Audit risk is multiplication of inherent risk, control risk and detection risk, and risk of material misstatement is multiplication of inherent risk and control risk. Why we are calling multiplication of inherent risk and control risk as risk of material misstatement? Because it is not in the hands of auditor, whereas detection risk is in the hands of auditor. Okay, so audit risk is finally risk of material misstatement multiplied by detection risk. I have also explained this with the help of numbers, okay, in order to make you understand it practically. Next, objective of audit is to reduce the risk to an acceptable lower level. Right. This point also we have discussed. Next, now you already know this point. Auditor will always conduct risk-based audit. Auditor cannot verify each and every transaction. No, it is highly impossible. Okay, so what the auditor will do? Auditor will do risk-based audit. That means if the risk of any area is high, auditor will deeply verify that area. If risk of any area is less, auditor will not verify that area much. Right, the audit procedures that the auditor will determine for that particular area will not be much. So auditor will always do a risk-based audit. Right, that is known as risk-based audit. Risk-based audit means nothing but, first of all, before starting the audit, you will identify risk of material misstatement. Based on risk of material misstatement, you will design the audit procedures. That is known as risk-based audit. So here what you will do, first of all, you will do risk assessment, that is identifying risk of material misstatement. Next, what you will do, risk responses, designing your audit procedures relevant to the risk. Next, you will report. These are the three stages of risk-based audit. Next, risk assessment. See, auditor, he has to identify and assess risk of material misstatement at financial statement level as well as at each assertion level. See, financial statement means at overall financial statement level, what is the risk? Let's say, for example, management, the history of the management is that they have involved in frauds, they are involved in money laundering, right? So the history of the integrity of the management is not good. So here, because of this, there is a risk at the entire financial statement level, because management might commit risk, management might commit fraud or misstatement at any item of the financial statement. So this point is risk at the entire financial statement level. Okay, next, at assertion level, let's say, for example, the valuation of fixed assets, is not done properly. So this is risk at a particular assertion level. What assertion? Valuation assertion. Okay, fixed assets are inexistent, right? Fixed assets are there, but the valuation of the fixed asset is not done properly. So there is a risk at a assertion level. What is that assertion? Valuation. Okay, so auditor has to determine risk at the entire financial statements level as well as at the assertion level. Okay, next example. Top accountant is not competent enough for the assigned task. It is quite possible that errors could occur in the financial statements, just like the example I told you. Next, at the assertion level, see the example. For valuation assertion, the auditor could assess the risk of error in payables as low. However, for inventory where obsolescence is a factor, the auditor would assess valuation risk as high, right? For trade payables, the valuation risk will be low because whatever the amount for which you have sold, that will be the trade payable. But inventory is not like that. For inventory, you need to calculate the market value, net realizable value, and you also have to include cost. Okay, cost or NRV, whichever is lower. Since calculation is involved, the valuation risk of the inventory will be high, right? So this is risk, calculating the risk at the assertion level. Hope you understood risk at assertion level and risk at entire financial statements level. Now steps in risk assessment. See, you have to assess the risk at each and every point of the audit. Okay, it is not that just while starting the audit you will assess the risk and you will leave it. No, at each and every point you have to assess the risk. See, just a second. Client acceptance and continuance procedures. If you see in SA 220 and SQC1, we have discussed while accepting the client, you will determine integrity of the client. So that is also one of the risk assessment procedure. Okay, you are determining whether there will be any risk because of accepting the client. So at client acceptance and continuance procedure, you have to determine the risk. Next, at planning overall engagement, also you have to determine the risk. Next, performing risk assessment procedures. See, what are the risk assessment procedures? Generally, inquiry, observation, and analytical procedures. These are the three risk assessment procedures that you will do. Okay, you have to do these risk assessment procedures. Next, identifying relevant internal control procedures and assessing their design and implementation. See, after you have identified the inherent risk, you should also verify the controls. Why you have to verify the controls? In order to determine control risk, right? Communicating material weakness in inter-control to management and those charged with governance. See, there is no obligation on the auditor to audit the internal controls and to communicate the weakness in internal control to the management. Auditor, for the purpose of his audit, he is verifying the internal control. See, in order to make his work easy, he is verifying the internal controls, but auditor is not having any obligation to verify the internal controls. You have to remember this. So since he verified the internal controls, if in case he finds any weaknesses, he has to communicate the same to management and those charged with governance. But internal auditor is having obligation to verify the internal controls. Statutory auditor is not having obligation to verify the internal controls, but he verifies the internal controls in order to make his duty easy. Since he verifies the internal controls, he has to communicate weaknesses to management and those charged with governance. Hope you understood. Next, identify significant risk that requires special audit considerations. There are 6 significant risks that requires special audit considerations. We will see those 6 significant risks in the next slide. Next, assess the risk of material misstatement in the financial statements, making informed assessment of risk of material misstatement at financial statement level and assertion level. Okay, you have to make informed decision. Informed decision means nothing but you have to properly design the audit procedures based on the risk of material misstatement that you have identified at the financial statement level and assertion level. Hope that is clear. Now the risks that require special audit consideration. I have told you there are 6 risks that require special audit consideration. These are significant risks. Significant means most important risks. Why they are most important risks? Because those are risks whether involving fraud. Okay, if that the risk require sorry, if that risk is risk of fraud, then it will require special audit consideration. Why? Because it will be treated as very much important, significant risk, right? If there is fraud, fraud means a serious issue, so that risk becomes, the risk of fraud becomes a significant risk, and since it is a significant risk, it requires special audit consideration. Next is risk related to recent economic accounting or other developments. Okay, if the risk is related to recent developments, let's say recently a new standard has been introduced. Now, since it is recently introduced, the management will not be having any idea of how to implement it. So the risk that management will not properly follow that new standard is very high. So the risk related to recent developments is also a significant risk. Next, complexity of transactions. Okay, if the transaction is very complex, then the risk in that area is also significant, that requires special considerations. Next, significant transactions with related party. See, wherever the related party is involved, then there is a chance that a fraud might occur. So transaction with related party is also a significant risk. Next, degree of subjectivity in measurement. Subjectivity means, see, there is two terms: subjectivity, objectivity. Objectivity is based on facts, subjectivity is based on emotions. So if the measurement involves any subjectivity, then also significant audit consider, then also that risk is a significant risk and it requires special audit consideration. Next, significant transactions outside the normal course of a business. See, those transactions that are outside the normal course of business, like acquiring a new company, right? Acquiring a subsidiary. So these are transactions that are outside the normal course. You will not regularly acquire subsidiaries or acquire businesses. So these transactions also involve high risk and they will require special audit consideration. Okay, these are the 6 significant risks that require special audit considerations. I hope that is clear. Next, risk response. See, once the auditor determines the risk of material misstatement, the next step is to respond to that risk. How the auditor will respond? By designing audit procedures. See, auditor responds to risk by performing further audit procedures. Now, first of all, these audit procedures, they can be classified broadly into 2: risk assessment procedures, further audit procedures. Risk assessment procedure means those procedures that you will perform in order to identify risk of material misstatement. Examples: observation, inquiry with the management, analytical procedures. Now, this analytical procedures is there na, that can be used as both risk assessment procedure as well as further audit procedures. I will give you an example how the analytical procedure can be used as risk assessment procedure as well as further audit procedure. But before that, I'll explain you what is analytical procedure. Okay, now it will come, I'll explain you. So broadly, audit procedures are RAPS, FAPS. RAPS means risk assessment procedure, FAPS means further audit procedure. Now, further audit procedure can be again bifurcated into test of controls and substantive procedure. Test of controls means those audit procedures that you will use for the purpose of testing the controls. The name itself you can identify, right? Testing the controls. For the purpose of testing the control, whatever procedure that you perform is known as test of controls. Okay. Next, substantive procedure. Substantive procedure, they can be again further divided into 2. They are test of details and analytical procedures. See, substantive, analytical procedure. Now, test of details. What are test of details? Example: watching. Watching is one of the test of detail. Next, obtaining external confirmation is test of detail. Now here, test of detail means you are detailedly verifying. Watching means each transaction you will verify. you're obtaining balance confirmation. That means with respect to valuation and existence, you are detailedly verifying. That is known as test of details. And substantive analytical procedure. See, analytical procedure, I have told you, you can use it as both substantive, the further audit procedure, as well as risk assessment procedure. How? Let me tell you. First of all, what is an analytical procedure? See, let's say for example, in the profit and loss statement, there is salaries. Okay, salaries figure is being shown as 1 crore rupees. Now the auditor has to verify this 1 crore rupees. One way to verify the salaries is auditor can take the bank statement, and every month while you pay salaries to the employees, there will be voucher, right? So every month you can match the voucher with the amount shown in the bank statement. Like this you can verify. That is the one of the way. That is known as test of detail, right? In that way you will verify the salaries. That is one way. Another way is by performing analytical procedure. How auditor will perform analytical procedure? Let me tell you. Now what auditor will do is, how many employees are there in the company in total? Auditor will take that figure. Let's say 100 employees. Okay, number of employees is equal to 100. Okay, that is number of employees 100. Now average salary paid to each employee is, let's say, 10,000 rupees. Okay, 10,000 rupees is the average salary. Okay, now per month, now 100 into 10,000 is 10 lakh per month. So salary expense per month is 10 lakh. Now per year it is 1.2 crore. This is a salary expense per year, but in the profit and loss statement it is being shown as 1 crore. Now auditor will analyze why there is a difference. Let's say for example, some of the employees, they have joined some 4 months back only. That means they have worked for only 4 months. For 6 months they are not there. So that amount, there will be a difference. And some employees, they have worked for 9 months. Okay, for the first 9 months, and they have left the organization, right? So here also in the closing employees, there are 100 employees, but in these 100 employees, the people who left in the middle of the year, they are not counted. So auditor will count them also now, and he will again recalculate this salary figure. So like that he will identify the difference and he will come to a conclusion. So this is a analytical procedure. Here you have not verified the transaction by transaction, but what you have done, you have taken non-financial figure, that is number of employees, and you have taken financial figure, that is average salary. With the help of this, you have performed analytical procedure and you have compared it with the amount that is shown in the profit and loss statement. This is an example of analytical procedure, okay, that the auditor can use. So here if you see in this example, auditor has used analytical procedure as substantive audit procedure. Okay, okay, here auditor has used the analytical procedure as substantive audit procedure. Now these analytical procedures, they are of various types. Trend analysis, okay, you can compare the trend, that is also one of the analytical procedure. Ratio analysis you can do, that is also one of the analytical procedure. Okay, now I'll give you an example for using analytical procedure as risk assessment procedure. Let's say for example, the company sales have been decreasing drastically for the past 5 years. Okay, let's say our company is in car manufacturing business. The same example I have given you in regular class also. So the company is in car manufacturing business, its sales are dropping for the past 5 years, and the company is also a listed company, its shares are listed in the stock market. Now other companies who are in the same business, okay, other companies who are also in car manufacturing business, their sales have been increasing drastically for the past 5 years. Now, since our company's sales are decreasing, the share price of our company is falling, whereas share price of other companies is rising. Now, there will be lot of pressure on the management of our company, right? Because it is a listed entity, always the shareholders, they wanted the share price of the company to be high, they wanted the company to make profits, but our company is not making profits and its shares are drastically falling down. So this will build up a pressure on the management, and because of this pressure, there is a possibility that management might involve in fraudulent financial reporting. So here there is a risk of fraudulent financial reporting. It is not that because of this management they will 100% perform fraud. No, there is a chance, there is a risk, right? So auditor, he has identified this risk by performing analytical procedure as a risk assessment procedure. Okay, he has analyzed the trend of sales of our company and the trend of sales of other companies, and from this he has identified the risk, right? So this is how you can use risk, you can use analytical procedure as risk assessment procedure. Hope that is clear. Okay, now designing the, hope you got a clarity regarding this audit procedure, right? Now designing further audit procedure, how you will design the further audit procedure? Further audit procedure means this one only we have discussed in a test of details, substantive analytical procedure. How you will design this? You will design this based on risk of material misstatement, okay, based on inherent risk and the control risk. You will design the audit procedures. See, consider reasons for assessment given to risk of material misstatement at the assertion level for each item, including inherent risk and control risk. Okay, based on these risks, you will design your further audit procedure. Okay, if the risk of material misstatement is very much low, then you will mostly depend on analytical procedures. If the risk of material misstatement is very high, then you will perform test of details. Detailedly you will verify the transaction, right? So based on the risk of material misstatement, you will plan your audit procedures, you will design your audit procedures, right? Next, and higher the audit risk, more pervasive audit evidence has to be obtained. This you already know. Next, matters to be considered in planning audit procedures. So what matters has to be considered? First of all, assertions that cannot be addressed by substantive procedures alone. Okay, what are the assertions which cannot be which cannot be addressed only by substantive procedure? Okay, for those types of assertion, you should also test the controls. Next, existence of internal control, whether there is internal control or not. This also you have to consider before designing the audit procedures, before planning the audit procedures. Next, potential for substantive analytical procedure that would reduce the need for other types of procedure. Okay, whether by performing analytical procedure can you reduce the requirement of performing other audit procedures. You should see this. Next, need to incorporate an element of unpredictability. See, unpredictability means the employees of the organization, the management, they should not know what transaction will be verified by you. So whether there is any requirement to implement that unpredictability in the audit. So based on that also, if there is a requirement to implement the unpredictability, then based on that your audit procedure will change. This also you should consider. Next, need to perform further audit procedure to address the potential for management override of controls. Need to perform specific procedure to address significant risk. We have seen that those 6 significant risks. So for those significant risks, whether any specific procedure has to be performed, you have to see. All these you need to consider while planning audit procedures. And finally, it is reporting. The reporting phase we have already discussed, right? The entire 700 series speaks about reporting, right? Next, now coming to materiality. You already know that auditor is concerned only with those misstatements that are material. Now what is meant by material? Any misstatement that will affect the decision making of the users, then that misstatement will be known as material. Hope that is clear. Now, auditor has to determine which is material and which is not material based on his professional judgment. And also, before starting the audit, auditor will calculate materiality level. How the auditor will calculate materiality level? Auditor will first of all take a benchmark, okay, and for that benchmark he will apply a percentage, and by that he will calculate materiality. I'll explain you that, you need not worry. See, misstatements are considered material if they influence economic decisions of the users of the financial statements. Materiality is a matter of professional judgment, right? Professional judgment of the auditor is involved in determining whether a matter is a material or not. Next, auditor applies materiality in both planning and performing the audit, right? See, auditor, he will apply this materiality in both planning the audit and performing the audit. It is not that only while planning the audit auditor will determine the materiality and he will leave it. No, auditor will determine the materiality even during performance of the audit also. If he determines any new items, or if he comes, or if any new scenario comes to his knowledge, then based on that he will also change the materiality. Okay, it is not that once you determine the materiality it is final. No, materiality can be changed. Next, materiality is determined by applying percentage to a benchmark. What is the benchmark? You can select any benchmark like sales or net profit or gross profit, or if the company is like a banking company, in case of banking company you can select loans given as benchmark. So based on the type of company you will select a particular item as a benchmark. Let's say for example the company is a trading company. So for trading company you will select a benchmark as sales. Let's say total sales of the company is 2 crore rupees. Now on this 2 crore rupees you will apply a certain percentage. Let's say you have applied 2%. See, the percentage that you will apply for materiality is always below 10% only, right? Not even below 5% only. Okay, so 2 crore multiplied by 2% is 2 lakhs. Yes, 2 lakhs. So you have determined materiality as 2 lakhs. So any misstatement that exceeds 2 lakhs, then auditor will consider that misstatement as material and it will have impact on the auditor's opinion. Okay, now here if you see, I have told you that materiality involves professional judgment. Why I am telling that materiality involves professional judgment? If you see the way how you derive at the materiality, two items are involved. First one is benchmark. Now benchmark means either sales or gross profit or net profit or advances. Auditor has to select any one of the item as benchmark. Now which item has to be selected as a benchmark? Professional judgment of auditor is involved. He can select whatever the item as benchmark, right? So here, but in selecting benchmark there is a professional judgment involved. Next, a percentage has to be applied. How much percentage has to be applied? It can be 1%, it can be 2%, it can be 3%, it can be 4%. So whatever the percentage it might be, so how much percentage has to be applied? So based on the circumstances the auditor has to determine which percentage has to be applied. So here also professional judgment is involved. So materiality involves professional judgment. Hope you understood it. Next, these are examples of benchmark: revenue, gross profit, advances. All those are examples of benchmark. Now, while selecting the benchmark, there are certain factors. Okay, what factors has to be considered in determining the benchmark? See, factors considered in determining the benchmark. Okay, while selecting the benchmark, what factors you have to consider? First of all, elements of financial statements. Okay, what are there in the financial statements? Sales, advances, assets, liabilities, gross profit, net profit, right? So you need to consider the elements of financial statements. Next, items on which attention of users tends to be focused. Okay, on which item the user focuses more. In case of bank, user focuses more on loans. He focuses more on NPAs. In case of a trading company, user focuses more on sales. User focuses more on profit. In case of a manufacturing company, user focuses more on raw material utilized, right? So on which item user focuses more, that also should be considered before determining materiality. Next, nature of entity, what type of entity it is, ownership structure and the way it is financed. Ownership structure means how much share capital is there, how much debt is there, in that debt also how much is borrowed from bank, how much is borrowed from directors, how much is borrowed from third parties, how much preference share capital is there, how much debentures is there, how much private placement is there. So capital structure should also be considered. Next, relative volatility of benchmark. See, the benchmark that you select should not be volatile. Volatile means it should not be up and down. Okay, there should be a particular flow. Let's say, for example, the sales of the company in the first year is 5 crore. In the next year, it has dropped to 1 crore. In the third year, again, it has went to 10 crore. In the fourth year, it has come to 5 crore. So if you see here in the sales figure, there is a volatility. Now you should not select the element which is more volatile. Okay, you should select the element which is not much volatile. Just a second. I just plugged in the charger now. So you have to ensure that the volatility is very less for the item that you select as the benchmark. Okay. Next, performance materiality. Now what is this performance materiality? See, auditor has kept the materiality, and in our example the materiality is 2 lakh rupees. Now if the misstatements approaches 2 lakh rupees, see, 2 lakh is the materiality. Until and unless materiality crosses 2 lakhs, auditor will not consider that. But there is a probability that auditor has identified misstatements of 1,60,000. Okay, and there could be some unidentified misstatements, right? Now there is a chance that identified misstatements together with unidentified misstatements crossing the materiality level, right? Let's say unidentified misstatements might be some 50,000. Now 1,60,000 plus 50,000, it is 2,10,000, right? So it is crossing the materiality, but because of the fact that auditor has not identified these misstatements, auditor is leaving this 1,60,000 also. So in order to avoid this type of scenario, what the auditor will do is, auditor will also keep a performance materiality. Now what is this performance materiality? Performance materiality is percentage of materiality. See, now our materiality is 2 lakhs. Oh, sorry, just a second. Yeah, our materiality is 2 lakhs. Now on materiality, auditor will apply a percentage. Generally this percentage will be very high, like 80%, 90%, like this the auditor will keep. Let's say 70% auditor has decided. That means 70% of 2 lakh will be some 1,40,000. So now the performance materiality is 1,40,000. That means once the misstatement reaches performance materiality, auditor becomes alert. Okay, auditor starts taking these misstatements serious, because there is a chance that this detected misstatement plus undetected misstatement crossing the materiality level. So once the misstatement reaches performance materiality, auditor considers them, auditor takes serious. Okay, auditor becomes serious about those misstatements once they reach performance materiality. Hope that is clear. Now, amount set by the auditor at less than the materiality. See, always performance materiality will be less than the materiality level. Okay. Now, another thing that you have to remember is materiality is percentage of benchmark. Performance materiality is percentage of materiality. Okay. For the financial statements as a whole, to reduce to an appropriate low level, the probability that the aggregate of uncorrected and undetected misstatements exceeds the materiality for the financial statements as a whole. Hope you understood performance materiality. Now, revision of materiality as the audit progress. Whether it is possible to revise the materiality as the audit progress? Yes, of course. You can revise the materiality as the audit progress. Now, moving to internal control system. What is this internal control system? Internal control system is a process that is designed, implemented and maintained by who? By management and those charged with governance. Why? In order to achieve entities objectives regarding reliability of financial reporting, effectiveness and efficiency of operations, and safeguarding of assets and compliance with laws and regulations. This internal control system will be implemented, maintained and designed by management and those charged with governance for the purpose of achieving objectives with respect to financial reporting, okay, and safeguarding of assets, compliance with laws and regulation, effectiveness and efficiency of operations. In order to achieve objectives with respect to these aspects, internal controls will be implemented. Okay. Now, scope of internal control. Basically, you can bifurcate these internal controls into accounting controls and administrative controls. See, accounting controls. Example, performing of reconciliations or authorization of a transaction or segregation of duties. These are accounting controls. Those controls that are implemented with respect to the accounting in order to ensure proper accounting takes place. Next, administrative controls. These controls are implemented in order to ensure proper functioning of day-to-day business of the organization, like SOP for employee onboarding. SOP means standard operating procedures for hiring new employees. Compliance monitoring of various health and safety laws, performance review of employees. These are administrative controls. Now, if you see, auditor mostly concerned with accounting controls and auditor is concerned with those administrative controls that will have effect on the financial statements. Okay, the same point you can find it here. Next, objectives of internal control system. What are the objectives of internal control system? See, the internal control system ensures that all the transactions are executed through proper authorization. Okay, only after proper officer has authorized, the transaction has been executed. Next, all transactions are promptly recorded in an appropriate manner to permit preparation of financial statements. Okay, internal control system ensures that all the transactions are recorded properly in the books of accounts so as to enable proper preparation of financial statements. Next, assets and records are safeguarded from unauthorized use. Internal control system ensures that the assets of the organization will not be used by unauthorized people. Next, assets are verified at reasonable intervals and appropriate action is taken with regard to the discrepancies. These are the objectives of internal control system. And basic accounting control objectives. With respect to accounting software that you implement, what are the basic control objectives that has to be there? Let's see. They have to ensure that all the transactions are properly recorded and those transactions are real and they are valued properly, recorded on a timely basis, properly posted, properly classified and disclosed, properly summarized. These are the basic accounting control objectives. Next, now the internal controls, I have already told you the control risk. If you have implemented the controls, it doesn't mean that the controls will identify the misstatements. Even though controls are implemented, there is a chance that those controls might fail because of limitations of internal control system. So what are the limitations of internal control system? Let's see. Management's consideration that cost of implementing the internal control system might override the benefit that they receive. Let's say the cost of implementing an internal control system is 1 crore rupees. Okay, for implementing the entire internal control system in the organization, it is 1 crore rupees. But by implementing that internal control, you will get a benefit of only 10 lakh rupees. Now, if you see cost benefit analysis, management might decide not to implement the internal control because the cost of implementing it is 1 crore, but the benefit they will get is only 10 lakh. So this is one of the limitation of internal control. Next, most internal control do not tend to be directed to the transactions of unusual nature. Okay, most of the internal controls are implemented to detect normal transactions, but they are not directed towards unusual transactions. Next, potential for human error. Even though internal controls are implemented, if manual controls are implemented, there is a possibility for human error, right? This is also one of the limitation of internal control system. Next, circumvention of internal control through collusion, right? Employees, by colluding among themselves, they can override the internal control. Person responsible for exercising internal control could abuse that responsibility. Manipulation by management, right? These are various limitations of internal control. We have discussed all these points with examples in our regular class, if you remember, right? Next, components of internal controls. Now, if you see, the internal control system is having 5 components. For example, a vehicle. Let's take a vehicle. Now, for the vehicle to work properly, there will be various components. There will be wheels, right? There will be gear, there will be steering, there will be brakes. So all these components should work properly for the entire car to work properly, right? In the same way, for the internal control system to work properly, there are certain 5 components. So only when these 5 components are proper, the internal control system will work properly. So what are those 5 components? First one is control environment. Let us see what is meant by control environment. See, the environment in the organization should be conducive for implementing the internal controls. Next, entities risk assessment process. See, entities risk assessment process is different from auditor's risk assessment process. Auditor, during his audit, he will assess the risk. Before auditor assess the risk, management has to assess the risk of material misstatement. Okay, why management has to assess risk? Because management has to implement controls. In order to implement controls, first of all, management should know in which areas there is a risk of material misstatement, right? So first of all, management has to perform risk assessment. So entities risk assessment process is second component of proper internal control system. Next, control activities. Control activity is the actual control that has been implemented, like implementing CC camera or implementing segregation of duty. That is actual control activity. Next, information system and communication. Okay, there should be proper information system and there should be proper communication for internal control system to work properly, and all these must be monitored on a periodic basis to ensure that the objective of the internal control system is achieved and the internal control system is working as required. If at all there is any loopholes in the internal control system, you have to fix them on a periodic basis based on the results of monitoring of the controls. Now let's see. Control environment. See, the control environment has the following elements: communication and enforcement of integrity and ethical values. See, the environment in the organization should be in such a way that integrity and ethical values should be promoted. See, if all the employees are ethical, then no one will perform fraud. right? So the environment itself, it should be in such a way that it is ethical in nature. Next, participation by those charged with governance. See, if you want the lower employees to comply with internal controls, participation should be from top management, right? Those charged with governance, there should be positive participation from those charged with governance for the internal control system to work properly, right? So the control environment should be in such a way that the top level management should involve. Next, management philosophy and operating style is also very much important. Okay, it should be the management operating style should be encourage you for implementation of internal control. The environment should be in such a way. Organizational structure, human resource policies and practices. Okay, the company should show importance for hiring those people who are ethical in nature, and assignment of authority and responsibility. All these are the elements of control environment. Next, entities risk assessment process. See, entities risk assessment process is different from auditors risk assessment process. The risk can change or arise due to the following circumstances. What are they? Change in operating environment, hiring of new personnel, new or revamped information system, corporate restructuring, expanded foreign operations, new technology. Okay, because of all these, the risk can change. It can either increase or decrease. So management has to, on a periodical basis, should perform assessment of risk. Next, component 3 is the actual control activity. See, control activities are the actual controls that are implemented. They can be categorized into policies and procedures pertaining to the following. What are they? Performance review. Performance review of whom? Performance review of employees. See, review and analysis of actual performance versus budget prior period performance. Okay, next, information system controls, application controls and general IT controls. See, there are two types of information system controls. One is application control, which is specific to the particular application. General IT controls are general for entire organization. Okay, next, physical controls. Physical controls is a implementation of controls physically, like access to the office will be allowed only if you show your ID card or if you swipe your ID card. That is physical control. Next, segregation of duties. So you can categorize the control activities into following categories. Next, information system and communication. See, information system and communication consists of infrastructure. Infrastructure means hardware, software, people, procedure and data. These are the 5 components of information system and communication. See, information system related to financial reporting has to identify and record all valid transaction, describe the transaction in sufficient detail to permit proper classification of transaction. See, the information system that you are maintaining for recording of the transaction should have all these features. It should measure the value of transaction, determine time period in which the transaction or occurred, present properly the transactions and related disclosures in the financial statements. Okay, you can check whether all these features are present in your accounting software or not. So the information system and communication is also very much important for the purpose of internal control system to work properly. This is also one of the component. And the last component is monitoring. You have to continuously monitor all these activities. See what happened. Yeah, you have to continuously monitor these controls. See, controls have to be monitored by management, internal auditors, personnel performing similar functions. Now, monitoring includes considering whether controls are operating as intended and are modified as appropriate for changes. Okay, in monitoring the controls, you have to check whether controls are working as intended and whether any amendments or whether any improvements has to be made to the controls. Examples of monitoring controls include management review of whether bank reconciliation statement are prepared on a timely basis. Okay, that is one of the example for monitoring the control. Okay, management has to check whether on a timely basis BRS is prepared or not. So these are the 5 components of internal control system which have to work properly for the internal control system to work properly. Okay, now let us move to the book. Yeah, if you see, we have discussed this internal control, right? Internal control system. All this it is done. Control activity. Yeah, you have to review the internal controls on a timely basis. Techniques for evaluation of internal control. Basically, we are having 3 techniques for evaluating the internal controls. One is internal control questionnaire. This will contain various questions with respect to the internal control. So with the help of this internal control questionnaire, you have to evaluate on a timely basis whether internal controls is working properly or not. Next, checklist and flow chart. See, questionnaire is a set of questions framed in an organization about each functional area which has the purpose of evaluation of effectiveness of control and detection of its weakness. And answers to this questionnaire will be mostly in yes, no, or not applicable. Next, checklist. Checklist is a series of instructions or questions on internal control which the auditor must follow or answer when a particular instruction is carried out. Okay, checklist involves instructions to the auditor on how to verify a particular internal control, right? That is checklist. Next, flow chart. Basically, flow chart is a graphical or diagrammatical representation of internal control that is present in the organization. With the help of this flow chart, you can identify what are the loopholes in the internal control system of the organization and you can fix it. Basically, you cannot use this flow chart alone. You have to use a flow chart along with the checklist or the questionnaire. See, it is a graphical presentation of internal control in the organization and is normally drawn up to show the controls in each section or subsection. A flowchart can provide you a visual picture of at what point a document is raised, number of copies it raised, the intermediate stages, distribution, authorization, matching, filing of documents, and final disposal. I have told you now, you have to use flowchart along with the internal control questionnaire. Only then you can get proper benefits of flowchart. And here is an example for flowchart. Certain 3 examples we have discussed these 3 examples in our regular class, right? I have explained you how to draw these flowchart. You can just go through those through the book. Next, reporting on internal control weakness. Now this is known as letter of weakness. Auditor, while he is reviewing internal controls, if he finds any weaknesses in the internal control, auditor will communicate the same to the management through letter of weakness. Okay, see, during the course of audit work, auditor may notice material weaknesses in the internal control system. Auditor should communicate such material weakness to management or the audit committee. How he will communicate? In writing through letter of weakness. Okay. Next, there are certain frameworks for internal control. See, I have already explained what is meant by a framework. Framework is a benchmark as per which we have to establish internal controls in the organization. Let's take for example, financial reporting framework. We are having Ind AS and accounting standards. They are financial reporting framework. As per Ind AS or accounting standards, you have to prepare financial statements in the organization. So Ind AS and AS, they are frameworks. That means they are benchmarks. You have to follow them for preparing financial statements in organization. In the same way, for implementing internal controls in the organization, there are certain frameworks, certain benchmarks. Let us see what are those frameworks. See, what is meant by internal control framework? It is a benchmark. There are various such frameworks. One is COSO framework, which is an integrated framework issued by Committee of Sponsoring Organization of the Tradeway Commission. Next, COCO, even that is also one of the framework related to internal control. See, criteria of control published by Canadian Institute of Chartered Accountants. Next, COBIT. COBIT is quite popular, framework with respect to the area of information technology. Okay, with respect to information technology, what controls has to be implemented, that will be said by COBIT. See, control objectives for information and related technology. Okay, if you wanted to implement controls with respect to information technology, you have to specifically follow COBIT. Next, internal control guidance for directors on combined code published by the Institute of Chartered Accountants in England and Wales. Sarbanes Oxley Act. You call it as SOX Act. Basically, SOX Act is famous in US. Okay, United States. The same, each framework has been explained here. You can go through those frameworks. Those are easily understandable. You can just read them. Now, moving to essay 450, evaluation of misstatements identified during the audit. Now, as per essay 315, you have identified risk of material misstatement, right? It is only risk, not actual misstatements. And as per essay 330, you have designed audit procedures and you have performed audit procedures and identified the actual misstatements. Now, how you will evaluate these misstatements that you have identified during the audit will be dealt in essay 450. Here are some definitions which you already know. Misstatement, uncorrected misstatement. Uncorrected misstatements means those misstatements which are not corrected by management. Factual misstatements means actual misstatements. Judgmental misstatements means misstatements with respect to judgment. Projected misstatements means this is generally applicable in case of sample. Now you will take a sample and you will perform audit procedures on sample and you will find some misstatements. Now these misstatements which you have found in the sample, you will project them to the population. So that is known as projected misstatements. Next, clearly trivial. Clearly trivial means clearly insignificant. Okay, those are those misstatements that need not be considered by the auditor are known as clearly trivial. They are minute misstatements. Okay, so auditor should also determine a level below which that misstatements will be treated as a clearly trivial misstatement. Trivial means those need not be considered by the auditor. Okay, misstatements which need not be considered by the auditor for the purpose of his opinion are known as clearly trivial. Okay, trivial means very minute, minor. Okay, see, matters that are clearly trivial will be of wholly different order of magnitude than materiality determined in accordance with 320, and will be matters that are clearly inconsequential, whether taken individual or in aggregate. Trivial is not another expression for not material. Okay, you should not consider that if the misstatement is trivial, it doesn't mean it is not material. Okay, in some situations, a misstatement might not be material, but it is trivial. Okay, you can't say that if a misstatement is trivial, it is not material. No, sometimes misstatement might not be material, at the same time it is also not trivial. Okay, see, trivial means, for example, rounding off. Now in the financial statements you will round off, right? Now in the assets side and in the liability side there is a difference of some 10 rupees. That difference has arisen because of rounding off. Now this is trivial misstatement, very minute misstatement which need not be considered by the auditor. Okay. Now, consideration of identified misstatements as the audit progress. See, whenever you identify the misstatements on a timely basis, you have to communicate the same to the management. See, the auditor shall determine whether overall audit strategy and audit plan need to be revised if nature of identified misstatements and circumstances of their occurrence indicate that other misstatements may exist. Consideration of identified misstatements as the audit progresses. See, as the audit progresses, auditor has to check because of these identified misstatements whether he has to change his overall audit strategy and audit plan. See, whether the overall audit strategy and audit plan need to be revised if the nature of identified misstatements and the circumstances of their occurrence indicate that other misstatements might exist that the auditor has not yet found out, or the aggregate of misstatements accumulated during the audit approaches materiality determined under SA 320. If auditor feels that apart from the misstatements that I have identified, if there is a probability of having some other misstatements in the financial statements, or the misstatements that he had identified along with the misstatements that he has not yet identified crosses the materiality level as per SA 320. In this situation, auditor has to decide whether he has to revise overall audit strategy and overall audit plan. Okay. And if management has corrected the misstatements, then auditor has to check. See, auditor shall perform additional audit procedures to determine whether misstatements still remain or not. Next, communication and correction of misstatements. See, whenever auditor identifies the misstatements, he has to communicate them to the management on a timely basis. To whom? To management, asking them to correct those misstatements. If management refuses to correct the misstatements, then auditor should ask why management you are refusing to correct the misstatements. What are the reasons? Okay, you have to ask for management's reasons for not making the corrections, and you have to evaluate whether financial statements as a whole are free from material misstatement or not. Okay. Okay, I have found out this misstatement and management is refusing to correct these misstatements. Like these, whether there are some other misstatements in the financial statements, auditor should consider this. Okay. Next, evaluating the effect of uncorrected misstatements. Okay, auditor has identified some misstatements and he has communicated those misstatements to management, asking them to correct those misstatements. Management have corrected some misstatements and have not agreed to correct some other misstatements. So what is the effect of those uncorrected misstatements? See, prior to evaluation, auditor shall reassess materiality determined in accordance with SA 320. Okay, prior auditor evaluates the effect of uncorrected misstatements. Once he has to check whether the materiality level that I have determined as per SA 320 is valid now also or not, whether I have to revise this materiality also. Once you have to reassess this. Next, in determining whether uncorrected misstatements are material individually or in aggregate, auditor shall consider. See, even though they are uncorrected misstatements, auditor will be concerned with them only if they are material, right? So in evaluating materiality of uncorrected misstatements, auditor should consider size and nature of those misstatements. Okay, what is the size and nature of that particular misstatement, particular circumstances of their occurrence. Okay, in which circumstance those misstatements have occurred and management is refusing to correct them, and the effect of uncorrected misstatements related to prior period. Okay, whether these uncorrected misstatements are related to prior period. Okay, all these factors auditor needs to consider while evaluating effect of uncorrected misstatements. And auditor has to communicate to those charged with governance all uncorrected misstatements and their effect on the opinion. See, auditor has asked the management to correct the misstatements, but management has not corrected them. Then what the auditor will do? Auditor will communicate to those charged with governance, the higher authority than management, stating that management has not corrected these misstatements and what effect this will have on my opinion. You have to communicate it. Next, auditor's communication shall identify material uncorrected misstatements individually. Okay, individually you need to communicate. This is material misstatement not corrected. This is another material misstatement not corrected. Like this, individually you need to communicate to those charged with governance. Next, effect of uncorrected misstatement related to prior period you need to communicate. The auditor shall request uncorrected misstatements to be corrected. Okay, however management is not correcting them, at least you correct them so that I will not consider them in my opinion. Okay, next you should ask a written representation from management and where appropriate with those charged with governance regarding what, whether they believe effects of uncorrected misstatements are immaterial. Okay, if management says that we will not correct these misstatements because they are immaterial, okay, if management gives this reason, then auditor should not sit silent. Okay management, you are saying they are immaterial, yeah? You give me that in writing, that you feel that those misstatements are immaterial, you give me it in a written representation. Okay, you have to ask for a written representation with respect to this. And documentation, see, auditor has to document the following aspects. The amount below which misstatement would be regarded as clearly trivial. Okay, what is the amount that the auditor has determined below which the misstatement will be treated as clearly trivial. Clearly trivial means clearly negligible. Next, all misstatements accumulated during the audit and whether they have been corrected. The auditor's conclusion as to whether uncorrected misstatements are material individually or in aggregate, and the basis for that conclusion. Okay, whether all the misstatements have been corrected or not, you need to document. Okay, all the misstatements that you have identified, and of those misstatements which are corrected, which are uncorrected. If they are uncorrected, whether you feel them material or not, you need to document this. Okay, next, communicating deficiencies. Essay 265. See, till now we have completed all the 4 standards: Essay 315, Essay 320, Essay 330, Essay 450, related to risk of material misstatement, audit procedures, and materiality. Now we'll see communication of deficiencies in the internal control system to those charged with governance and management. See, you will not communicate all the deficiencies, only significant deficiencies in the internal control you will communicate. See, deficiency in the internal control. This exists when control is designed, implemented, or operated in such a way that it is unable to prevent, detect, correct misstatement in the financial statement on a timely basis. Okay, you have implemented a control, but that control is not working properly. It is not able to detect the misstatements. Then you will call that there is a deficiency in the control. Or in order to detect a misstatement, a control has to be present, but that control is not there, then also you will say that there is deficiency in control. Okay, this is known as deficiency in internal control. Now what is meant by significant deficiency in the internal control? Those deficiencies in the internal control which the auditor feels that they have to be, or they are worth communicating to those charged with governance, they are known as significant deficiencies. Okay, if the auditor feels that this deficiency is worth communicating, or this deficiency is worth taking to the attention of those charged with governance, then such deficiency will be known as significant deficiency. Significant means important. Next, factors to be considered in determining whether a deficiency constitutes a significant deficiency or not. See, you will not communicate all the deficiencies to internal to those charged with governance. Only significant deficiencies you will communicate. Now, how to determine which deficiency is a significant deficiency? See, following factors you need to consider: the likelihood of deficiencies leading to material misstatements in the financial statements. Okay, if the deficiency in the internal control leads to material misstatements in the financial statement, then such a deficiency can be treated as significant deficiency. Okay, if there is no CC cameras in the organization, then the cash will be taken over by some third party. This is because of deficiency in the internal control, misstatement or theft is being occurring. So you can call this deficiency as significant deficiency. Hope you understood. Next, susceptibility to loss or fraud of related asset or liability. Okay, if the internal control is not there, the asset or liability will be lost. Then also that deficiency will be known as significant deficiency, the example that I have told you. Subjectivity and complexity of determining estimated amounts such as fair value accounting estimates. If subjectivity is involved, then also that will be significant. Financial statement amounts exposed to deficiencies. Okay, because of deficiency in the internal control, it is directly affecting the amounts in the financial statements. Then also such deficiency will be significant deficiency. Volume of activity that has occurred or could occur in account balance or class of transaction exposed to deficiency. Okay, now huge volume of transactions are occurring in a particular area where there is no internal control, then the deficiency in the internal control with respect to such area will become a significant deficiency. Why? Because huge volume of transactions are occurring in that area and there is no internal control, so it becomes significant deficiency. Okay, because it is affecting lot of transactions. Next, the interaction of deficiency with other deficiencies in the internal control. Okay, so all these factors you need to consider before determining whether a deficiency in the internal control becomes a significant deficiency or not. Next, communication process. See, the auditor has to determine whether on the basis of audit work performed, the auditor has identified one or more deficiencies in the internal control. Okay, during the audit work, auditor, whether he has identified any deficiencies or not, he has to see. Now, of these deficiencies, which deficiencies are significant deficiencies he needs to identify. Okay, identify significant deficiencies. After identifying significant deficiencies, auditor shall communicate in writing significant deficiencies to whom? To those charged with governance on a timely basis. And auditor should also communicate to management at an appropriate level of responsibility on a timely basis in writing significant deficiencies in internal control that the auditor has communicated or intends to communicate to those charged with governance, and other deficiencies in the internal control identified during the audit that have not been communicated to management by other parties. Okay, not only to those charged with governance, auditor should also communicate those significant deficiencies to management of appropriate authority also. Okay, next, contents of this written communication. Now you will communicate the significant deficiencies in internal control to those charged with governance through a written letter. Okay, we will call this as a letter of weakness. Now what should be the contents of this letter of weakness or this written communication? See, description of deficiencies and an explanation of their potential effect. You need to clearly describe how there is a deficiency in the internal control, and because of this deficiency what could occur wrong in the financial statements. You need to clearly explain, and sufficient information to enable those charged with governance and management to understand the context of communication. See, you have to mention in the written communication that your objective is identify that there are no material misstatements in the financial statements. In order to achieve that objective, you are verifying the internal controls. Okay, to make your audit work easy, you are verifying the internal controls. Your actual objective is not to verify the internal controls, and since you have however verified the internal controls and you have identified weaknesses, you are communicating them to the management or those charged with governance, but there is no responsibility on you to communicate these deficiencies. Since you have verified the internal controls for the purpose of your audit, you have identified the deficiencies. Since these deficiencies, they will be useful to the management if they have been communicated to the management or those charged with governance, I am communicating. Okay, these points needs to be mentioned. See, the purpose of audit was for the auditor to express opinion on the financial statement. This was the purpose of the audit, but the audit included consideration of internal control relevant to preparation of financial statements in order to design the audit procedure. Okay, our audit included consideration of internal control for the purpose of designing audit procedures. Okay, but our main objective was not to audit the internal controls. Our objective was to provide opinion. For the purpose of providing the opinion, we have to verify the internal controls. Why? Because based on internal controls we will design our audit procedures. So because of that we have verified the internal controls, and the matters being reported are limited to those deficiencies that the auditor has identified during the audit. See, whatever I am communicating to you as weakness in the internal control, they are limited to whatever the area of internal control that I have verified. Okay, Apart from these deficiencies that I am communicating, there can be other deficiencies also in the internal control, but I have not verified all the internal controls, because I will verify only those internal controls that are necessary for my work, and whatever the weaknesses that I have identified in those internal controls, I'm communicating to you. Okay, you don't consider that these are the only deficiencies in the internal controls. Apart from this, there can be some other deficiencies also. Okay, so this should be communicated in the written communication. Hope that is clear. By this, essay 265 also gets completed, right? So all the 5 standards we have revised in this class. In the next class, we'll revise the 5th chapter. I will be winding up this class. Before winding up, we have launched Lecturepedia app. On this app, you can practice MCQs for free of cost. Not only the MCQs of audit, you can practice MCQs of all the subjects of CA final, CA intern, CA foundation, and you can purchase classes of topmost faculties. Okay, in the industry, all the faculties in the industry, they are available on Lecturepedia app. You can download Lecturepedia app from Play Store. Okay, so with this, I am winding up this video. We'll meet in the next class. Until then, take care. Bye bye. See you. Now, in the today's class, we will be covering the standards with respect to audit evidence. What are those standards? SA 500, SA 501, SA 505, SA 510, and SA 530. Okay, these 5 standards we will be revising in the today's class. Starting with SA 500, audit evidence. Now, what is this audit evidence? Audit, the auditor will give his opinion based on the audit evidence. Basically, we have seen that before starting the audit, auditor will plan his audit. After planning the audit, auditor will perform risk assessment procedures, further audit procedures, right? After performing procedures, auditor will give his opinion. Now, if someone asks the auditor, how did you arrived at this opinion? Then in such a situation, auditor should have audit evidence to show them that based on this, I have arrived at this opinion, right? So auditor will obtain this audit evidence by performing audit procedures, right? We have discussed auditor will perform risk assessment procedure, auditor will perform further audit procedures. Why auditor is performing those procedures? In order to obtain the audit evidence, auditor is performing those procedures, right? We have discussed in SA 330 auditor's responses to assess the risk of material misstatement. What are auditor's responses? Audit procedures are the auditor's responses. Now, why those audit procedures are performed? In order to obtain audit evidence. Hope that is clear. Now, what is the objective of SA 500? See, the objective of SA 500 is design and perform audit procedures that will enable the auditor to obtain sufficient and appropriate audit evidence. Okay, the objective of SA 500 is to enable the auditor to obtain sufficient and appropriate audit evidence. Now, what is meant by sufficiency? What is meant by appropriateness? We will discuss them. These are the 2 characteristics of audit evidence. Okay, the audit evidence that the auditor obtains must be sufficient and appropriate. Okay, what is sufficient, what is appropriate, we'll discuss. Next, audit evidence. What is the audit evidence? I have already told you. Information used by the auditor in arriving at the conclusion on which auditor's opinion is based, right? That is known as audit evidence. Okay, based on the audit evidence only, auditor will give his opinion. Now, how to obtain audit evidence? I have already told you, by performing audit procedures, auditor will obtain audit evidence. See, by performing risk assessment procedure and further audit procedures. Now, what are some of the audit procedures? Some examples of the audit procedures. See, these are some examples of audit procedures. Inspection. Okay, inspection means examining of records, documents, and some assets is known as inspection. Next, external confirmation, you already know, you will send balance confirmation request to third party, that is known as external confirmation. Observation, okay, you will observe the procedures that the management is performing. Recalculation, okay, you will recalculate the calculations that have already been done by management. Reperformance, same. Analytical procedures, we have already discussed. I have explained analytical procedure with the example in previous revision class only, right? While discussing essay 330, I have explained analytical procedure, how we can use analytical procedure as risk assessment procedure, how we can use analytical procedure as further audit procedure. We have the substantive procedure we have discussed. Next, inquiry. Inquiry means asking questions to the management or some third party and getting answers or getting audit evidences, right? These are some of the audit procedures. See, these are some just examples of some audit procedures. By performing these audit procedures, auditor will obtain audit evidence. Okay, basically if you see this standard, it is very simple standard. Now, characteristics of audit evidence. What are the characteristics of audit evidence? I have already told you. There are two characteristics. One is sufficiency and another one is appropriateness. What is meant by sufficiency? Sufficiency deals with quantity of audit evidence. Quantity means how much audit evidence has to be obtained. This much or this much or this much. How much? It depends on the risk of material misstatement and the quality of audit evidence. Okay, based on the quality and the risk of material misstatement, the sufficiency will depend, right? If the risk of material misstatement is very high, then more number of audit evidence has to be obtained. If risk of material misstatement is very less, then small number of audit evidence has to be obtained, right? If the quality of audit evidence is high, that means high quality in the audit evidence is there, then low quantity is sufficient. If quality is less, high quantity is required. Okay, so the quantity, the sufficiency of audit evidence depends on risk of material misstatement and quality of audit evidence. What is meant by sufficiency? Sufficiency is a measure of quantity of audit evidence. Now, this quality is there na. Quality of audit evidence is nothing but appropriateness. Okay, appropriateness is measure of quality of audit evidence. Now, appropriateness deals with relevance and its reliability in providing support for auditor's conclusion. Now, what is meant by relevance? What is meant by reliability? We'll discuss. See, relevance means the audit evidence that you are obtaining must be relevant for the purpose of the audit. Okay, let's say for example, you wanted to verify whether the fixed assets are there or not. Okay, you wanted to verify this, whether organization is actually having this fixed asset that is being shown in the balance sheet or not. Now, for this purpose, what is the audit procedure that you have to perform? You have to physically visit the location and you have to take photocopies of the fixed asset, right? That is the audit evidence that you have to obtain. But what you have done is, you have sent a request to the person who is in charge of maintaining those fixed assets, asking to confirm whether the fixed asset is actually there or not. Now, this is irrelevant, right? Sending a confirmation with respect to fixed asset is irrelevant audit procedure, right? That becomes an irrelevant audit evidence, right? You have to use a confirmation request in case of bank balance or trade payable balance or any other balances, not with respect to asset, right? With respect to asset, the proper audit evidence, the relevant audit evidence will be to physically visit and obtain the audit evidence, right? So that is known as relevance. Okay, and reliability. Basically, reliability depends on the source and circumstances in which audit evidence is obtained. We will discuss that. But appropriateness deals with relevance and reliability. Okay. Now, What is meant by relevance? See, relevance deals with logical connection between the purpose of audit procedure and the assertion under consideration. Okay, see, you cannot hit a lion with this small stone, right? For killing a lion, you need huge equipment or huge knives, right? So there should be relevant audit procedure or relevant audit evidence that you have to obtain. Okay. Next, reliability. See, the reliability of audit evidence increases. First of all, reliability is influenced by the source from which it is obtained, the nature and circumstances under which it is obtained. Now, if you see, audit evidence that is obtained from independent outside sources is more reliable than the audit evidence that is obtained from internal people, right? If you obtain audit evidence from outside people, outside independent people, then that is more reliable. You can more rely on that audit evidence than the audit evidence that you have obtained internally, right? And evidence that is generated internally is also more reliable if related controls are effective, right? Next, audit evidence that the auditor obtains directly is more reliable than the audit evidence that is given to the auditor by some other people, right? Next, audit evidence that is obtained in documentary form is more reliable than the audit evidence that is obtained in oral form. Next, audit evidence provided in original documents is more reliable than Xerox copies or photocopies, right? So the source from which audit evidence is obtained will impact its reliability. Okay. Next, using work of management experts. See, sometimes what will happen is let's say for example gratuity calculation. Now, for calculation of gratuity, for providing correct provision with respect to gratuity, management might use some external expert who is expert in calculating gratuity provision. Now, that person will be known as management expert. Now, he has performed a calculation and based on that calculation, provision has been made in the books of accounts. Now, here the audit evidence is the calculation that has been done by the management expert. So when auditor uses the evidence that is prepared by management's expert, then what precautions has to be taken by auditor? Okay, how you have to verify such evidence? Let's see. When information to be used as audit evidence has been prepared using the work of management expert, then auditor has to evaluate the competence, capability and objectivity of that expert. That means that expert whom the management has hired, the auditor has to evaluate his capability, like what are his qualifications. If auditor has previous experience with that expert, then auditor will come to know the capability of that expert. If auditor is not having previous experience, auditor can discuss with those persons who have experience with the work of that expert. Next, auditor can directly discuss with that expert, right? By talking, by discussing with the expert, you will come to know about the level of knowledge of that expert. And you can also read the books, documents, papers that have been presented and written by that expert, right? By doing this, you will evaluate the capability and competence of that particular expert. So now you have evaluated the expert. Next, you will understand the work that has been done by the expert. See, obtain an understanding of the work that the expert has done. How you will obtain how you will understand the work of that expert? Whether there are any standards that are there with respect to the area of work that the expert has done. For example, for audit there are auditing standards, for accounting there are accounting standards. In the same way, whether there are any standards applicable to the work of that expert, and that expert has done the work as per that standards. Okay. Next, whether that expert has taken any assumptions. Okay, if yes, you have to understand the assumptions that the expert has taken, and what is a relevant field of that expertise. So by understanding this, you will understand the work of that expert. After that, you will evaluate appropriateness of that expert's work. See, you have you have evaluated capability of the expert, you have understood the work that done by the expert. Now you will see whether that work is relevant for our purpose or not. So how you will see whether that work is relevant for our purpose or not? You will check relevance and reasonableness of conclusions that has been made by the expert. You will check relevance and reasonableness of assumptions that has been made by the expert. You will see relevance, completeness and accuracy of the source data that has been used by that expert. So by doing this, you will evaluate appropriateness of experts' work. Okay, so this is essay 500. Now we will move to essay 501. Let me open that PPT. This is a very simple standard, right? Moving to essay 501, that is, see, essay 501 also deals with audit evidence only, but with respect to certain selected items. Okay, it deals with specific consideration for selected items. What are those selected items? There are 3 selected items that will be dealt by essay 501. Let us see. Objective as per essay 501. Yeah, see, essay 501 deals with obtaining sufficient and appropriate audit evidence regarding the following assertion with respect to this specific item. See, with respect to existence and condition of inventory. Next, completeness of litigation and claims, presentation and disclosure of segment information. Okay, with respect to these 3 selected items, how to obtain audit evidence, that will be dealt by essay 501. So what are those 3 selected items? One is inventory. With respect to inventory, which assertion we will be dealing with? Completeness, existence and condition of inventory. Second item is litigation and claims. In this regard, which assertion? Completeness of litigation and claims. That means whether all the litigations and claims have been properly disclosed or properly considered in the financial statements or not. Whether there are any litigations and claims that have been hidden, you will find out that, right, how to perform audit procedures and how to obtain audit evidence with respect to that. And finally, the third selected item is segment reporting. Okay, presentation and disclosure with respect to segment reporting. We will see these 3 items. Firstly, if you see here in this standard, inventory aspect is very important. The remaining 2 items are not that much important. Yeah, starting with inventory, existence and condition of inventory. Now just think, in order to obtain audit evidence with respect to inventory, what audit procedure you will perform? You will physically verify the inventory, right? You will visit physical verification of inventory. The same is suggested by standard also. See, obtain sufficient appropriate audit evidence regarding existence and conditions of the inventory by attendance at the physical inventory count. Now, by attending at the physical inventory count, what should you do? You have to evaluate the management's instructions and procedures for inventory counting. Now, for counting the inventory, management would have been following certain procedure and policy. So you have to evaluate whether that procedure that is being followed by the management for counting the inventory is correct or not. Okay, for this purpose, you will attend the inventory counting. Next, you have to observe performance of count procedures. Now the staff of the management will be performing inventory counting. You have to stand and observe whether they are properly conducting inventory counting or not. Next, you have to do inspection of the inventory. Okay, you should also inspect. Let's say there are boxes. In the boxes there are some 10 products. Okay, each box will be having 10 products. So the management's staff, they are counting the boxes. Now you have to check whether in that box actually the products are there or not. That is known as inspection. Next, perform test counts. You also from your side have to perform some of the test counts. Okay, by attending at the physical inventory counting, you have to do following things. Okay, these things you have to do. Next, there are certain special situations. Okay, inventory verification in certain special situations. How to deal with those special situations? Let us see. See, situation number 1. Inventory counting is done at a date other than date of financial statements. See, financial statements will be prepared as on 31st March of so and so year. Let's say 2025. Now, on 31st March 2025, this much amount of inventory is there. Right, now auditor has to obtain audit evidence with respect to this inventory, right, that is present as on 31st March 2025. So inventory counting has to be done as on financial statement date, but entities, they will do it on 29th March or 30th March or 31st March. In these 3 days, any of one day they will do. Right, now let's say if the inventory counting is not done on date of financial statement, let's say due to some reason the management have done inventory counting on 20 March 2025 only, that means before date of financial statements, or they have done inventory counting after date of financial statements like 15th April 2025. So in this situation, management has conducted physical inventory counting. Okay, physical inventory counting is done, but it is not done on the date of financial statement, right, it is done on some other date. In such a situation, what the auditor do, what the auditor has to do, because auditor has to obtain audit evidence with respect to inventory as on the date of financial statements, right, but it is done on some other date. So in this situation, auditor has to perform audit evidence on the changes that has taken place in the inventory in this period. Okay, between the date of financial statement and between the inventory counting date, in this period some changes would have taken place. Auditor has to do audit procedures on those changes, right, some sale of inventory might have taken place, some purchase of inventory has taken place. So you have to audit whether those transactions have been recorded properly or not, and you have to do backward calculation to arrive at whether the inventory as on this date is showing properly or not. See, perform procedures to obtain sufficient appropriate audit evidence that changes in inventory between count date and date of financial statements are appropriately recorded or not. Okay, next situation, auditor unable to attend due to unforeseen circumstances. See, management, they have conducted inventory on financial statements date only. Okay, on 31st March they have conducted physical inventory counting, but auditor, due to some reason, he was not able to attend the inventory counting. In this situation, what the auditor has to do? Auditor has to conduct inventory counting on some other date and do audit procedures on intervening transactions. Okay, since auditor was not able to attend the inventory counting that is conducted by the management on financial statements date, auditor, he will conduct the inventory counting on some other date like 5th April or 10th April or 15th April, and he will do audit procedures on intervening transactions, right. See, observe some physical counts on alternative date and perform audit procedures on intervening transactions. Simple. Next, attendance at inventory counting is impracticable. Let's say in some situations, let's say inventory is present in ocean, like for some oil mining companies, oil extraction companies, their inventory will be in ocean. From ocean they will extract the oil, right, they will be having some lease with the government to extract the oil. So now inventory is present in the under the ocean, so auditor cannot visit physically and verify the inventory in the ocean, right. So in that impracticable situations, how should the auditor perform inventory counting? In this situation, auditor has to check whether he can obtain audit evidence by some alternative means. Okay, instead of physically visiting there, is there any alternative means for me to calculate the inventory? If yes, you have to obtain audit evidence by performing such alternative audit procedures. If you are not able to obtain audit evidence by alternative procedures, then you have to modify your audit opinion. Okay, alternate procedures, if not possible, modify the opinion. These are certain special cases with respect to inventory. Okay, so now there is another situation with respect to inventory only. If let's say inventory is under the custody of third party, okay, the company has sent the inventory on a consignment basis to its branch or to its franchisee, or entity has sent goods on sale or return basis. So here the inventory is under the custody of a third party, but that ownership belongs to belongs to company only. In this situation, auditor has to send confirmation request to that third party whether inventory is actually present with him or not. See, if it is material to financial statements, then request confirmation from third party, perform inspection or other appropriate audit procedure. Now, if auditor is not having confidence, or auditor doesn't believe the third party's confirmation request, okay, auditor is having some doubt over integrity of the third party. In such a situation, what the auditor has to do? See, if there is doubt about integrity, objectivity of third party, and because of that auditor is not able to believe the confirmation request that is sent by the third party, in such a situation, auditor he himself can attend that place and verify the inventory, or on behalf of auditor he can send some other person to that location and verify whether inventory is there or not. Okay, see, attending or arranging another auditor to attend inventory verification, or the auditor of such third party would have verified the physical inventory that is available with that party. Right, now you can obtain a report of that auditor who have verified. See, obtain another auditors or service auditors report. Next, inspecting documentation regarding inventory held by third parties. Okay, if you are having doubt over the confirmation request sent by the third party, you can perform these procedures. Okay, by this the specific consideration with respect to selected item, that is existence of inventory, is completed. Next, moving to second selected item, which is litigation and claims, that is completeness of litigation and claims. Now see, litigation and claims means, in these litigation and claims what will happen is, some third party might have filed a case against the company, and that case is still under dispute in the court. Okay, company has not accepted its obligation. If court decides that or if court decides the case against the company, then company might have to pay huge penalty to that third party. Right, some outflow of cash will happen if the case is decided against the company. So in this litigation and claims, what the company will do is, company will try to hide these litigation and claims, okay, from the auditor. So auditor has to check whether complete list of litigation and claims is shown or disclosed in the financial statements or not. So for this purpose, what audit procedure has to be performed? Okay, what audit procedures has to be performed? Let's see. Litigation and claims procedure to identify litigation and claims, inquire management and others within the entity. See, the first procedure is, he will inquire the management, because management can give you the first hand information of all litigation claims that are having against the company, because they will be with the company for 24 hours, 24/7 they will be with the company. They are engaged in day-to-day aspects of the company, so they are having complete information with respect to all the litigation and claims against the company. So you will first of all inquire with the management, please give us a complete list of litigations and claims against the company. That is the first audit procedure that you will perform. Next, you will read the minutes, review minutes of meetings of those charged with governance, correspondence with legal counsel. Now there is possibility that management might not give you complete list of litigation claims. So what you will do is, you will take minutes of meetings of those charged with governance and management. Now in those meetings, they would have discussed about some litigations, right? If they have discussed about some litigations, that will be entered in the minutes, right? So by reading the minutes, you might come to know about some new litigation and claims against the company, and you will also consult with the entity's legal counsel. Okay, entity might have engaged some advocate to fight those legal cases. So you will contact the advocate and ask the advocate whether this is a complete list of litigation, or apart from this, whether any other litigations are there. Next, you will verify legal expenses account. By seeing legal expenses account also, you can come to know whether there are any litigations and claims against the company, because in the legal expenses, you will pay amount or fee to the lawyers and some other expenses to deal with these litigations. You will pay amounts to amounts, right? Expenditure, that expenditure you will debit to legal expense account. So if you check legal expense account, you will come to know about litigation and claims that are against the company. So these procedures you will perform. Next, if the auditor assesses a risk of material misstatement regarding litigation or claim and seek direct communication with the entity's external counsel. Okay, auditor wanted to communicate with the external counsel, but management is not allowing to communicate with the external counsel. Management refuses to communicate with the external counsel. Then auditor has to see whether he can obtain audit evidence from alternate audit procedures. If he is not able to obtain audit evidence from alternate audit procedures, then auditor has to modify the opinion. Auditor is unable to obtain sufficient appropriate audit evidence by performing alternate audit procedure, then auditor shall modify the opinion. Hope that is clear. And another important point, whenever you are communicating with external legal counsel, you have to send such a communication on the letterhead of the management. You should not use letterhead of the auditor, because that legal counsel is unknown to you. Okay, legal counsel doesn't know you. Legal counsel is hired or employed by management. So legal counsel will respond if the request is sent on the letterhead of the management instead of letterhead of the auditor. Simple. Okay, so you have to use letterhead of the management for communicating with legal counsel. Coming to the last specific item, which is segment reporting, right? Presentation and disclosure of segment information. Basically, companies, if they are having a lot of businesses, they will bifurcate their businesses into segments, right? Let's say company is into business of car manufacturing, into business of motorcycle manufacturing, into business of bus manufacturing. Now these three can be bifurcated as segments, and it can present as segment reporting. Or the company is doing business in India, in South Africa, in America. Now all these geographical regions can be separate segments, right? So segmentation can be done product wise, segmentation can be done geography wise. Okay, so now whether this segment information has been properly disclosed and presented or not, that you have to see. Basically there will be applicable standard. I don't exactly remember the accounting standard or Indian accounting standard number for this segment information, but there is a standard that deals with segment information. So you have to disclose this segment information as per that standard. So auditor has to verify whether the disclosure that is made in the financial statements is as per that particular standard or not. Obtain sufficient appropriate audit evidence regarding presentation and disclosure of the segment information by management. How you will do? You will understand the methods that are used by the management. Okay, which methods the management has used for segment information, and whether that method is as per the requirement of applicable financial reporting framework or not. See whether such method results in disclosure as per applicable financial reporting framework or not. Next, you will test the application of such method. Okay, now management, by applying a particular method, they have arrived at particular disclosure, particular amounts. Now auditor, he will also apply that method and he will see whether the same amounts are being arrived or not. Okay, you will apply that method that the management has used. You will test application. Next, perform analytical procedures and other procedures. So by doing these things, you will check whether segment information has been properly presented and disclosed. Okay, so by this we have completed the revision of essay 501. Now we'll open the PPT of essay 505, external confirmation. Moving to the next standard, essay 505, which deals with external confirmation, a quite easy standard. You already know what is meant by external confirmation, right? In order to confirm the balances, auditor will send external confirmation, right? This external confirmation, it can be used with respect to trade payables, debtors, or you can use with respect to investments, bank balances, right? So with respect to confirmation of any balances or any information, you can send external confirmation to the third party. Now let us see the actual definition of external confirmation. See, external confirmation is one type of audit evidence that is obtained as a direct written response. See, external confirmation will always be in a written form. Okay, written response to the auditor from a third party in paper form or by electronic or other medium. Okay, now types of confirmation requests. There are basically two types of confirmation request. One is positive confirmation request and another one is the negative confirmation request. Now what is this positive confirmation request? See, in case of a positive confirmation request, if auditor sends positive confirmation request to a particular debtor, let's say, then that particular debtor has to respond in both the situations, that is whether he agrees with the balance or he doesn't agree with the balance. In both the situations, the debtor has to respond to the auditor. That is known as positive confirmation request. Negative confirmation request. In case of a negative confirmation request, the debtor or the respective third party will respond only if he doesn't agree with the information that is present in the confirmation request. Okay, if he agrees with the information that is present in the confirmation request, then the third party, he will not respond in case of a negative confirmation request. Okay, that is the difference between positive confirmation request and negative confirmation request. Next, there is also another type of confirmation request which is known as blank confirmation request. Basically, in case of a blank confirmation request, auditor will not exactly mention the amount. He will just mention that, let's say for example, in the books of accounts of the client, the debtor balance of particular debtor is 1 crore rupees. Now auditor will send a request, a blank confirmation request to that particular debtor, saying that debtor, your account is being shown in the books of accounts of so and so company as debtor. Can you please send us the amount that you have to pay to this company? Now here in this blank, the respective debtor has to fill the amount that is due by him to the company. Hope that is clear. That is known as blank confirmation request, in which auditor will not mention the amount. Okay. Next, controls over external confirmation procedure. Basically, auditor, he himself has to decide which amount has to be confirmed and to which debtor or to which person the request has to be sent, the format of a confirmation request. Okay, with respect to all these aspects, auditor, he himself should have the control. See, auditor shall maintain control over determining the information to be confirmed. Okay, he has to select which information has to be confirmed and also to which person the request has to be sent. See, select the confirming party. Okay, you should not ask the management, to whom should I send the external confirmation request? No, auditor, he himself should select the person or debtor or creditor or to whomever the confirmation request has to be sent. Designing confirmation request. Okay, auditor, he himself has to design the confirmation request and he himself has to send the request and follow up request. Okay, he has to maintain control over all these aspects. He cannot assign these duties to other people. Hope that is clear. He cannot delegate those activities. Next, factors to be considered when designing confirmation request. Okay, when you design the confirmation request that has to be sent to the third party, what factors has to be taken into account? First of all, assertions addressed. Okay, which assertions you want to address? If you are sending confirmation request to your debtor, you wanted to address existence assertion, you wanted to address the valuation assertion, right? So like this, which type of assertion you wanted to address, you need to consider this in designing the confirmation request. Next, you should also consider identified risk of material misstatement, whether there is any risk of material misstatement in that area. If yes, then you should be very careful in designing the confirmation request. Next, you should also consider layout and presentation, and you should also consider prior experience with respect to that third party, and also method of communication, how you are communicating, whether you are sending it through post or mail or you are physically visiting and giving the confirmation request. Okay, what is the method of communication, that also you should consider in designing the confirmation request. And management's authorization, whether management is authorizing you to send the confirmation request, and ability of intended confirming party. You should also consider whether the person to whom you are addressing the confirmation request is having capability, is having capacity to provide the information that has been asked by you. That means you should also consider the ability of the confirming party. All these you need to consider while designing the confirmation request. Next, there are certain special cases with respect to external confirmation. Let us see those special cases. See, if auditor is having doubt about the reliability of response, okay, auditor has sent external confirmation request, he has received the response, but auditor is having doubt about reliability of this response. In such a situation, obtain further audit evidence to resolve the doubt. Okay, you have obtained one of the audit evidence, that is external confirmation. You are having doubt about reliability of this evidence, then you can obtain some other audit evidence. Okay, you can perform further audit procedures and you can obtain further audit evidence to confirm this external confirmation. Next, if confirmation that response is not reliable, okay, in the first situation you just have a doubt that response might not be reliable. In second situation, you have got a confirmation that yes, the response that is given by this third party is not correct. In such a situation, evaluate impact on the assessment of risk of material misstatement. Okay, you have to consider the risk of material misstatement. Already you have determined a risk of material misstatement, right? Based on that, you have sent a external confirmation request. Now that confirmation that you have received is wrong. Now because of this situation, there is a possibility that the risk of material misstatement in this area might be even higher. So you have to again recalculate the risk of material misstatement, taking this into account. Next, no response. If you have not received any response, perform alternate audit procedures to obtain audit evidence. Next, exceptions identified. Exceptions identified means in the external confirmation request, the third party, the debtor, told that he has to pay only 50 lakhs to the entity, but in the books of accounts of the entity, it is showing that 1 lakh has to be received from that particular debtor. Now there is a exception, right? Now in this, if the exception is identified, investigate exceptions to determine whether they are indicative of misstatement. You have to investigate this exception. and determine whether this is a misstatement. Because just because of the fact that the confirmation request is not matching with the amount, it need not be misstatement. Might be the debtor himself might have sent a wrong amount, right? So you have to investigate whether the amount shown in our books is wrong or the amount confirmed by the debtor is wrong. Which is wrong? You need to identify and you need to determine whether it is a misstatement. Some exceptions do not represent misstatement. I have already told you now, all exceptions need not be misstatement. There is a possibility that even debtor might have sent a wrong figure by mistake or due to various reasons. Okay, these are certain special cases. Next, management's refusal to allow auditor to send external confirmation request. Now auditor wanted to send external confirmation request to a particular debtor whose worth is some 2 crore rupees. Now management is saying that auditor, you please don't send external confirmation to the debtor because there is a case going on in the court. There is a dispute with respect to this amount, so there is a case going on. Now in this situation, if management refuses you to send external confirmation request, you should first of all ask the management, why I should not send the external confirmation request, what is the reason? Then management will tell their reasons, whatever the reasons they might tell. One of the example is there might be some dispute going on, so because of that dispute in the case, management is asking not to send external confirmation request, because if you send external confirmation request, then that request will act as a evidence for that third party in the court of law. So or some other reason might be given by management. Now auditor has to evaluate whether this reason is correct. Okay, and auditor should try to obtain audit evidence by some alternate audit procedures. If auditor is not able to obtain audit evidence through alternate audit evidence, then he needs to obviously determine impact on his opinion. He needs to modify the opinion. See, inquire reasons for management's refusal, evaluate implication or risk of material misjudgment, perform alternate procedure to obtain audit evidence. If auditor concludes that management reason is unreasonable and not able to obtain audit evidence from alternate procedure, communicate with those charged with governance and determine implications on auditor's opinion. Right. Next, negative confirmation request shall not be used as sole substantive audit procedures unless, okay, you can use negative confirmation request only in the following situations. Okay, apart from the following situations, you should not use negative confirmation request as sole sole audit procedure. What are they? Risk of material misstatement is low and controls relating to assertions operating effectively. Okay, if risk of material misstatement is low, then you can send a negative confirmation request. Negative confirmation request means the confirming party will respond only if he doesn't agree with the information. Okay, you can use that negative confirmation request if risk of material misstatement is low and the controls that are operating in that area are effective. Okay, in that situation you can use negative confirmation request. Or population consists of large number of small homogeneous items. Homogeneous items means, let's say for example, there are 1000 debtor balances and the balance of these 1000 debtors is like this: 100 rupees, 50 rupees, 60 rupees, 80 rupees. Okay, like this small balances. So these are large number of small homogeneous amounts. So for these types also you can send negative confirmation request. Next, low exception rate is expected. Low exception rate is expected means the deviation between the confirmation request and the amount is not expected. That means there will not be deviation between the confirmation amount and the balance that is shown in the books of accounts. Okay, 99.99% cases there will not be any deviation. That means low exception rate is expected. In such a situation also you can use negative confirmation request. Next, auditor not aware of circumstances that causes the confirming party to disregard the request. Okay, auditor doesn't believe that the confirming party will not care the confirm, external confirmation. Okay, auditor believes that the confirming party will take these request serious and he will respond if there is any difference. Okay, if auditor is sure that the confirming party will not neglect the request, that means he will not disregard the request, the confirming party will not disregard the request. Disregard means he will not neglect the request. In such a situation, auditor can use negative confirmation request. Okay, so this is SA 505, external confirmation. Now we will discuss the next standard, that is SA 510. Let me open that PPT. Moving to next standard, SA 510, which is initial audit engagements. The two in initial audit engagements, audit evidence with respect to opening balances. Right, you will carry forward closing balance of previous year as opening balance of current year. Right, so in that opening balances, whether there are any misstatements and whether accounting policies have been followed consistently or not, with respect to this you have to obtain audit evidence. Okay, so before that, what is an initial audit engagement? See, if you are auditing the financial statements of the entity for the first time, that means either the financial statements of the entity for previous year are not at all audited, or the financial statements of the entity for previous year are audited by predecessor auditor, and you are auditing the financial statements of the entity in the current year, then for you this current year engagement will be known as initial audit engagement. Why? Because you are auditing the entity for the first time. Hope that is clear. This can occur in two situations: either financials of previous year are not audited, or financials of previous year are audited by predecessor auditor. Hope that is clear. In those two situations, the current year's audit engagement that you are auditing will be known as initial audit engagement. Okay, now in this initial audit engagement, the audit evidence that you have to obtain with respect to opening balance will be dealt by SA 510. See, initial audit engagement, an engagement where financial statements of previous period were not at all audited or audited by predecessor auditor, and this is first time you are auditing the financial statements of the entity, then it will be known as initial audit engagement. Predecessor auditor means the auditor from a different audit firm. Right, you already know the meaning of predecessor auditor. Next, objective of auditor with respect to opening balances. What is the objective of auditor with respect to opening balances? He has to ensure that there are no misstatements in the opening balances, and accounting policies that are reflected in the closing balance have been consistently followed in the current year also, and if there is any deviation in the accounting policy, the same has been properly accounted for. Right, this has to be ensured. This is the objective of the auditor with respect to opening balances. See, obtain sufficient appropriate audit evidence whether opening balance contain misstatement that affect the current period financial statements, and accounting policies reflected in opening balances consistently applied in the current period financial statements also, or changes thereto are properly accounted. Okay, the accounting policies that are reflected in the opening balance should be consistently applied in the current period also. Okay, there should not be difference in the accounting policy. If at all there is a deviation, then the same has to be properly accounted. Okay, next, what are the audit procedures with respect to opening balances? See, auditor will read the most recent financial statements and predecessor audit report, if any. Okay, since
you are conducting audit of opening balances. Opening balances are brought forward from the previous year's financial statements. You will read the most recent financial statements and also predecessor audit report if available, and you will determine whether closing balances are correctly brought forward, right? Since opening balance is nothing but closing balance of previous year, you will once check, you will take the financial statements of previous year and you will take the trial balance of the current year. In the trial balance there will be opening balances, so you will check whether closing balance is correctly brought forward, closing balance is correctly brought forward or not. Okay, this you will see. Next, determine whether any adjustment disclosed as a prior period item. Okay, you have to verify basically if in the previous year's financial statements any item has been missed, then the same item will be accounted in the current period, but it will be shown in the profit and loss statement as prior period item. Whether there are any such prior period items, you need to verify. Next, determine whether opening balance reflect appropriate accounting policies. Okay, the accounting policies that are reflected in the opening balances has to be consistently followed in current period also, that is okay. But whether accounting policies reflected in opening balance are correct or not, you have to see that also. Okay, if the accounting policies that are reflected in opening balances are wrong, okay, the inventory has to be valued at cost or NRV, whichever is lower, but they have valued at cost only. So here the accounting policy that is reflected in the opening balance itself is wrong, right? So you have to check whether the accounting policy reflected in opening balance is appropriate or not. If it is appropriate, then you have to ensure the same accounting policy has been consistently followed in the current year also or not. Okay, next, if prior period financial statements are audited, peruse the copies. Okay, if the prior period financial statements are audited by predecessor auditor, you can just take those audited financial statements and you can just go through them. Okay, evaluate whether current period audit procedures provide evidence relevant to the opening balances. Okay, in some situations what will happen is the current period audit procedures that you will perform on the current period financial statements, they will provide audit evidence with respect to the opening balances. Let's say for example, there is a debtor balance value 1 crore rupees. Okay, Mr. A has to give 1 crore rupees. This balance is existing as on date of balance sheet date. Okay, 31st March 2025. That is closing balance. The same has been brought forward to current period 1st April 2025. Now on 30th May 2025, that particular Mr. A has repaid 1 crore rupees. Now, while auditing this transaction of repayment, you will get audit evidence with respect to such opening balance, right? In the opening balance, there is 1 crore receivable from Mr. A. So, he repaid it on 5th May, 5th May, 1 crore rupees. So, you got evidence regarding the opening balance. So you need to see this also, whether audit procedures that you perform on the current period will provide you audit evidence with respect to the opening balance. Okay, next, perform specific audit procedures. Okay, if at all for any specific scenario any special audit procedures are required, you have to perform those specific audit procedures. Okay, next, consistency of accounting policies. See, you have to obtain audit evidence that accounting policies reflected in opening balances are consistently applied in current year also. If at all there is any change in the accounting policy, you have to ensure that the change has been properly accounted for in the current period also. Okay, if the accounting policy is not applied consistently or the change has been not properly accounted, then auditor will give either qualified opinion or adverse opinion based on pervasiveness of the matter, because here you are having evidence that accounting policies are not followed consistently. If there is evidence, you cannot give disclaimer of opinion. Okay, disclaimer is given when there is no evidence and the misstatements are material and pervasive. So since there is evidence, you will give either qualified or adverse. So of these two, which one to give? If the misstatement is both material and pervasive, then you will give adverse. If misstatement is only material, then you will give qualified. So based on pervasiveness of the matter, you will give either qualified opinion or adverse opinion. Hope that is clear. See, all this you will understand if you are clear
with 700 series, that too is a 705 modification of opinion. That's why I have covered that 700 series first. Even in our regular classes also I will cover the 700 series first, okay, before discussing all these standards of 500 series, 600 series and 200 series and 300 series. I will cover 700 series because that aspect is very important. Okay, which type of opinion has to be given in which scenario. Only if you understand that standard, you will be able to understand the remaining all other standards. Okay, next, audit reporting. In which type of scenario, which type of opinion will be given? See, if auditor is unable to obtain sufficient appropriate audit evidence regarding opening balances. See, you observe, you are not able to obtain audit evidence. That means audit evidence not there. If audit evidence is not there, you will give either qualified opinion or disclaimer of opinion. You cannot give adverse opinion, because to give adverse opinion, audit evidence should be there and misstatement should be material and pervasive. Since audit evidence itself is not there, you will give either qualified or disclaimer, right? So qualified or disclaimer of opinion. Next, concludes that opening balance contains misstatement. Now you got a audit evidence, you concluded that opening balances contain misstatement, that material effect current period financial statements effect is not properly accounted. So now you got a evidence. If there is a evidence, you will give either qualified or adverse. Since evidence is there, based on the pervasiveness of the matter, you will go either for qualified or for adverse opinion. Since you don't know pervasiveness of the matter, you will give either qualified or adverse opinion. You cannot give disclaimer, because disclaimer is given only when there is audit evidence not available. Okay, next, predecessor auditor's opinion includes modification. See, audit report of predecessor auditor includes modification, and it remains material to current period financial statements also. Since it is material to current period financial statements and predecessor audit report includes a modified opinion, the auditor on the current period financial statements will also give modified opinion. See, shall modify current period opinion. Hope that is clear. So by this, essay 510 also completed. Now we'll discuss essay 530. Essay 520 we will discuss in another class. Okay, now we'll cover essay 530 and we'll wind up the class. Let me open PPT of essay 530. Now moving to the next standard, essay 530, audit sampling. Now audit sample, you already know, auditor, he cannot perform audit procedures on the entire population, right? Because it will take a lot of time. So what auditor will do? Auditor will select the sample and he will perform audit procedures on that sample, right? So sample will be selected from the population, right? So what is meant by a sample? Sample is representation of the population. Why sample will be selected? Because auditor cannot test all the items. Just like in case of blood test, if you wanted to test the blood, sample of your blood will be taken and a test will be performed on that, right? They will not perform test on your entire blood, right? Just like that, auditor will take sample from the population and he will perform audit procedures on the sample. See, audit sampling means application of audit procedures to less than 100% of the items. Okay, 100% of the items is the population. You are applying audit procedures to less than 100% of the items within a population, such that all sampling units have chance of selection in order to provide the auditor with reasonable basis on which to draw the conclusion about the entire population. Okay, based on the results of sampling, auditor will draw conclusion on the entire population. Okay, next, sampling risk. Obviously, since you are not performing audit procedures on entire population, there will be risk, right? There will be risk. That risk will be known as sampling risk, right? If you have audited entire population, you would have found out misstatements in the entire population. Since you are not auditing the entire population, you are only taking the sample, and on that sample you are performing audit procedures and you are finding misstatements and you are projecting these misstatements to entire population. Obviously this projection of misstatements might not be entirely correct. You might miss out some of the misstatements, right? So there is always sampling risk will be present if you use audit sampling. See, risk that auditor's conclusion based on a sample may be different from the conclusion if entire population were subjected to the same audit procedure, right? Let's say for example, there are 1,000 debtors. Of those 1,000 debtors, you have taken a sample of 100 debtors and you have sent external confirmation to 100 debtors. Of that sample, you have found that there is only misstatement in one debtor balance. So of 100 items, there is one misstatement. You will project this to entire population. There is 1,000 debtors. So if there is one misstatement in 100 items, there will be 10 misstatements in entire population, right? So based on this, you will give your opinion. But there might be 50 misstatements in the entire population. Who knows? You have not audited entire population, right? So this is sampling risk, the risk that you will provide different audit opinion based on your audit procedures on sample. If you have applied the same audit procedures on entire population, might be your opinion might be different, right? This is known as a sampling risk. So in case of test of controls, you might say that controls are operating effectively. See, controls are more effective than they actually are. This will affect efficiency of the audit. Sorry, this will affect effectiveness of the audit. See, this will affect the effectiveness of the audit. Actually, controls are not working effectively, but you are saying controls are working effectively. So you are giving a wrong opinion. You are not achieving your objective, so effectiveness will be affected. I have already told you what is effectiveness, what is efficiency while discussing essay 315. Okay, while discussing audit risk, the same diagram I have told you, but with respect to test of details, I have told you, right? See, controls are less effective than they actually are. Okay, controls are very much working effectively in actual, but you are saying that controls are not working effectively. This will affect the efficiency of the auditor. Next, in case of test of details, there are material misstatements do not exist when in fact they exist. Okay, actually there are material misstatements in the financial statements, but you are saying that there are no material misstatements because you have audited only sample. Based on the results of the sample, you concluded that there are no material misstatements, but there are material misstatements. This will again affect effectiveness of the audit because you are not achieving your objective, right? Effectiveness is affected. Next type of risk is there are no material misstatements present in the financial statements, but you are telling that material misstatements exist, okay, when in fact they don't exist. This will affect the efficiency. Why? Because to prove that no material misstatements exist, you have to apply more time. Okay, you have to spend more time, you have to utilize more resources. Okay, since more resources are being utilized, it will affect the efficiency of the audit. This will be clear to you if you have properly listened the essay 315 class. There I have clearly told you what is efficiency, what is effectiveness, what is inappropriate opinion, what are the scenarios, all that I have told you. The same chart, okay, this chart, if you remember, we have discussed in essay 315 also. Okay, next, sampling methods. Basically there are, broadly speaking, two sampling methods. One is statistical sampling, one is non-statistical sampling. Okay, in statistical sampling there are further methods, in non-statistical sampling there are further methods. Okay, basically statistical sampling means nothing but it is a scientific method of sampling. The probability theory will be involved and randomness will be involved in case of statistical sampling. See, random selection and use of probability theory. Okay, statistical sampling is more scientific method of sampling, and another one is non-statistical sampling. Okay, this non-statistical sampling is not a scientific method. Okay, you'll just select the sample based on your judgment, that means your experience or haphazardly. Okay, just like that you will select the sample, just like Mr. Bean is selecting the sample, like that you will select. That is non-statistical sampling. If you see, in statistical sampling we are having random sampling. Random sampling means you will select a sample based on random number table generators. Okay, if you go and search in the Google random number generators, there will be various tools wherein if you just refresh, it will keep on generating random numbers. So with the help of that tool you will select the sample. Okay, you will click refresh. If it shows 10, the 10th item you will select as sample. Next you will click again refresh. If it shows 18th item you select as the sample, right? With the help of random number selectors you will select the sample. That is known as random sampling. Okay, next, stratified random sampling. So in case of this stratified random sampling, what you will do is the entire population you will divide it into strata. Strata means all the items which are having same characteristics will be kept under one strata. Okay, let's say for example you are auditing debtors balance. Okay, now you have divided the entire debtors into following stratas. The debtor value less than 1 lakh rupees is one strata. Okay, next, debtor value 1 lakh to some 10 lakh, another strata. Like this you have divided entire debtors into stratas. Okay, so the debtors of, so the the items in the strata will have similar characteristics. So now you have divided entire population into strata. Now from these stratas randomly you will select some of the samples. Okay, again you can apply random number tables, and from this strata you can generate random items for sampling basis. That is stratified random sampling. Okay, you have first of all divided the population into stratas, then from that strata randomly you are selecting the sample. Next, cluster sampling. Now in this cluster sampling, entire population you are dividing them into clusters. Now clusters need not have same characteristics. Okay, all the items in the cluster will not have same characteristics. Okay, you will just to group some of the items into clusters. Okay, there will not be any rule like stratas, there will not be any rule for dividing the items into clusters. Okay, just like that you will make some clusters, and from these clusters you will randomly select the clusters for sampling. Okay, you will not select items in the clusters randomly. Okay, let's say there are 10 clusters. Okay, in each cluster there are some items. Now you will randomly select the entire clusters, 5th cluster, 7th cluster, 10th cluster. Like this the entire cluster you will select, and all the items of the cluster will be subjected to sampling. Okay, whereas in case of strata, from the strata itself you are again selecting, but here in case of cluster the entire cluster you are selecting as sample. There is a difference. Okay, that is a cluster sampling. Next, systematic sampling. In case of systematic sampling you will follow a systematic method. Like let's say there is 1000 items in population. Now you wanted to select 50 items as sample. Now what you will do is 1000 divided by 50. What did you get?
1000 divided by 50 is like yeah, 20, right? 20 or 200? Sorry, 50, 50, 50, right? So you will get 50, not 20, 50, right? Now, is it 50? Sorry, 20 only, not 50, 20. Sorry. So you got 20. Now, each 20th item will be selected as sample. Okay. See, sometimes what will happen is you will confuse even with small calculations, right? Yeah, it is 20 only. So it happens. So now in the entire population, the 20th item, so from 1 to 20, the 20th item selected as sample. Next from 20 to again 20th item, that is 40th item selected as sample. Next 40 to again 20th item, 60th item selected as sample. So this is systematic selection. Next, monetary unit sampling. In this monetary unit sampling, what will happen is for each item you will assign a weight, okay, based on monetary value of the item. You will assign a weight, okay. If let's say there are debtors, now the weight that you will assign to debtor whose balance is 1 crore will be high, whereas weight that you will assign to a debtor whose balance is 10,000 will be less. So based on weights that you have assigned, the probability of that debtor being selected into the sampling will increase. Okay, that is monetary unit sampling, which is a weighted value based sampling. Okay, see, assigning weights is simple. First of all, what you will do is you will take total value of debtors. Let's say total value of debtors is 1 crore rupees. Total value of debtors. Now, from this you have to assign the weights. The value of debtor of a particular person, Mr. A, is 20 lakh rupees. Now, the weight that you will assign to that person is 20% is the weight that you have assigned. If the value of debt of another debtor is, let's say, 1 lakh rupees, the weight that you will assign is 1%. Like this, based on the debt amount you will assign the weights, and then you will apply the sampling. So if the debtor who is having highest weight is having high probability of being selected into the sample. Okay, that is monetary unit sampling. Next, in non-statistical sampling, you have block selection. See, block selection is simple. Let's say there are invoices, 1000 invoices. Now you will select a particular block of invoice, like sale invoice of November and December. That block you have selected. So you have excluded the invoices of all remaining months. You have just selected a particular block of invoices. That is known as block selection. This is not a scientific method. Next, haphazard selection. Haphazard means just like that. Okay, just like Mr. Bean is selecting here, like that haphazardly you will select without following any structure technique. Next, judgmental sampling. In case of judgmental sampling, auditor will use his past experience. Okay, based on his judgment, based on his past experience, auditor will select the sample. That is judgmental sampling. Okay, these are different methods of sampling. You can find the same. Okay, the explanation of all these samples I have given here. I have explained you all of them, right? Next, non-statistical sampling. These also I have explained you. See, this is important. Of all these sampling methods, the principal methods of sampling. Okay, what are the principal methods of sampling? There are 5 principal methods of sampling as per SA 530. First one is random sampling, systematic sampling, monetary unit sampling, haphazard sampling, block selection. Okay, of all these methods, these 5 methods are recognized as principal methods of sampling as per SA 530. See,
They might ask you a question in the examination. Explain principal methods of sampling. Then you have to explain these 5 sampling methods. Okay, these are 5 principal methods of sampling. Next, steps in audit sampling. See, there are 5 steps in audit sampling. Just basically what you will do is, the first step is you will select the sample. That is first step. Second step is you will apply audit procedures to the sample. That is second step. After applying audit procedures, you will get misstatements, right? So you will evaluate those misstatements. That is the third step. Now these misstatements, you will project them to the entire population. That is projection of misstatements is fourth step. And fifth step is you will evaluate whether sampling is has worked properly to you or not. That is evaluation. These are the 5 steps in audit sampling. Let's see. We will see step by step. Okay, step by step I have prepared a separate slide. See, step number 1. What is step number 1? Determining sample design, sample size and sample selection. See, sample design. Sample design means which items has to be included into the sample. For this purpose, consider purpose of audit procedure and characteristics of population. Based on that, you will design the sample. Next, sample size. Okay, how many items have to be included into the sample? Determine a sample size sufficient to reduce sampling risk to an acceptable level or acceptably lower level. Okay, you have to include that many number of items into the sample so as to reduce sample risk to a acceptably lower level. Okay, so here judgment of the auditor will be involved. Next, sample selection. Each unit in the population shall have equal chance of being selected. Okay, so this way you have selected the sample. After selecting the sample, step 2 is to perform audit procedures, right? Perform audit procedures on what? On sample that you have selected. See, perform audit procedures appropriate to the purpose. If audit procedure is not applicable to selected item, the auditor shall perform audit procedure on replaceable item. What is this replacement item? Let's say, for example, you are auditing or you are performing audit procedure on payments. Okay, you are verifying whether all the payments that has happened through the check have been authorized by proper officer or not. For that, what you will do? You will take all these checks and you will verify whether they have been properly authorized or not. So you have, see, there are some 10,000 checks. Okay, you cannot verify all 10,000 checks. So what you will do? You will randomly select some, randomly or by applying any method, you will select a sample of checks. Okay, you have selected some 100 checks, and on these 100 checks you will apply audit procedures. Now in these sample checks, one of the check is cancelled. Okay, so on cancelled check you cannot perform audit procedure, right? So this becomes a replacement item. Okay, you have to replace this cancelled check with another check. Okay, you have to take this cancelled check out of the sample and include another check from the population into the sample and perform audit procedure on that replacement item. That is known as replacement item. So whenever audit procedure is not applicable to selected item, okay, for this cancelled check the audit procedure is not applicable. Why it is not applicable? Because cancelled check, it will not be authorized by anyone, right? So you have to perform audit procedure on replacement item. Next, if auditor is unable to apply designed audit procedure or suitable alternate procedure to a selected item, treat that item as deviation or misstatement. If let's say auditor is not able to apply audit procedure on the selected item, okay, on one of the sample item auditor is not able to apply audit procedure, it is not that audit procedure is not applicable to that item. Okay, audit procedure is applicable to that item. Okay, if audit procedure is not applicable to that item, then that becomes a replacement item. But in this situation, audit procedure is applicable to that item, but auditor is not able to apply the procedure on that item. In such a situation, you have to treat it as deviation or misstatement. Okay, deviation in case of control, misstatement in case of amount or item. Hope that is clear. So you have performed audit procedure. Next step number 3. What is step number 3? Nature and cause of deviation. You have to evaluate the deviation or misstatement. Why this deviation has occurred? What is the cause of this deviation? What is the nature of this deviation? See, investigate the nature and cause of any deviation or misstatement, identify and evaluate their possible effect. Okay, why this deviation has occurred? If there is this much deviation, how much deviation will be there in the entire population? You need to see that. Okay, you need to evaluate the cause and nature. If deviation or misstatement is anomaly, what is meant by anomaly? Anomaly means rare. That means, see, in the sample that you have selected, there is a misstatement, and this misstatement is anomaly. That means this misstatement is rare. It is present just in the sample. Auditor is sure that this type of misstatement will not be present anywhere in the population. It has just occurred in this sample only. Okay, it will for sure 100% it will not be there in the sample. Okay, it has this misstatement just has occurred in this sample that I have selected only. Then such a misstatement will be known as anomaly. Okay, you cannot project this anomaly to entire population because this misstatement will not be there in entire population. It has just occurred in the sample only. Okay, that is known as anomaly. So if deviation or misstatement is an anomaly, perform audit procedure to obtain high degree of certainty that it is not representative of the population. Okay, if auditor feels that this misstatement is a anomaly, then auditor has to obtain high degree of confidence that this misstatement is 100% anomaly only. It is not present in the entire population. Okay, that confidence auditor has to obtain if he feels that the misstatement is an anomaly. Hope that is clear. See, anomaly, a misstatement or deviation that is demonstrably not representative of misstatement or deviation in the population. Hope you understood. Next, step 4 is you will project the misstatement to the entire population. See, projecting misstatement. In case of test of details, auditor shall project misstatement found in the sample to the population. I have told you na, in a sample of 100 items, there is 10 misstatements. Then in the entire population of 1000 items, how many misstatements will be there? 100 misstatements will be there. That is projecting misstatements to the population. Okay, such projection can be made in case of misstatement in amounts or items, right? But in case of deviation in the control, you cannot project because the deviation will be measured in percentage terms. Okay, misstatement will be measured in number terms. Okay, there is 1 misstatement, 2 misstatement, 3 misstatement, 10 misstatements, like this. In number terms you will measure misstatements, so you can project misstatements to entire population. But deviation in control is measured in percentage terms. If let's say there is a 10% deviation in the controls, in the sample of controls that you have tested, then if you project this 10% to entire population of controls, then also it will be 10% only, because it is the rate of deviation, right? You are measuring the deviation in controls in percentage terms. So even if you project this deviation rate to the entire population, the rate will not change, the percentage will remain same. Okay, so for test of controls, need not project the deviation rate, because deviation rate will be same for the entire population also. Okay, if for the sample of controls deviation rate is 10%, means for population also the deviation rate will be 10% only. Hope that is clear. Note, if misstatement has been established as anomaly, exclude it when projecting misstatement to population. this I have already told you. Okay, if auditor feels that misstatement is an anomaly, you should not project that anomaly to entire population, because anomaly itself means that it will not be present in the entire population. This type of misstatement will not be present in the entire population, so you should not project this misstatement to entire population. Okay, so you have projected the misstatement. Next, step number 5, you will evaluate the sample results. See, evaluating the results of audit sampling. Evaluate whether use of audit sampling has provided reasonable basis for a conclusion about the population that has been tested. Okay, you will evaluate whether the use of a sample is useful to the auditor. Okay, whether the audit procedures that has been performed on the audit sample has provided true picture of entire population or not. Okay, you have to evaluate the results of audit sampling. That is the 5th step. If you feel that the results of audit sampling are not representative of entire population, then you will select some more sample from the population, or you will choose to perform audit procedures on the entire population. Okay, that decision you will take based on evaluation of results of audit sampling. Hope that is clear. This is the 5th step. By this, we have completed revision of essay 530, and we have also completed the revision of this entire standards of this chapter, right? We will meet in the next class. Before that, a small announcement. We have launched a Lecturepedia app, and on this Lecturepedia app you can practice MCQs for free of cost, and you can also purchase classes of various faculties on Lecturepedia app. You can practice MCQs of not only audit subject but all the subjects of CA final level, inter level and foundation level. You can download this Lecturepedia app from the Play Store. Okay, I'll be winding up this class as of now. We'll meet in the next class. Until then, take care. Bye bye. See you. In today's class, we will be discussing essay 540, essay 550, essay 560, 570 and 580. All these 5 standards will be covering in today's class. Now basically, if you see, all these standards, they are related to certain areas where there will be significant risks. Now auditor, while identifying risk of material misstatement, the risk will occur because of these areas. If you see essay 540, there will be a significant risk that will arise because of estimates. Essay 540 deals with auditing accounting estimates, and in the same way there will also be a significant risk with because of related party transactions. In the same way, subsequent events, and with respect to going concern, essay 570. So all these areas, there will be significant risk that will be involved. So in these areas, since there is a significant risk, the institute has given separate standards covering each of this area. Okay, so from that series we will be covering essay 540 first, which deals with auditing accounting estimates and fair value accounting estimates. Now what is this accounting estimates? Before that, first of all, the objective of essay 540. What is the objective of essay 540? To enable the auditor to obtain sufficient appropriate audit evidence about what? About whether accounting estimates, including fair value accounting estimates, are reasonable. Now, who will make these accounting estimates and fair value accounting estimates? Management will make. Now, auditor has to evaluate whether these estimates that the management has made are reasonable or not, and related disclosures in the financial statements are adequate. Basically, with respect to this estimates, disclosures like assumptions used, data that has been used, okay, and the subjectivity involved, all these will be disclosed. So whether the disclosures that has been made with respect to the estimates is adequate for the purpose or not, even that auditor has to verify. Okay, so this is the objective as per essay 540. Now we will see what is meant by accounting estimate. See, the name itself suggests it is an estimation made by management. Now when will you make an estimate? When actual figures are not available, okay, you will make estimate. most of the times estimate will be with respect to future only. Best example for accounting estimate, provision for doubtful debts. This is the best example. Okay, you are having some debtors and you are expecting that some of the balance of the debtor will not be realized, so you have to make a provision for this doubtful debts, which is an estimate. You don't know how much will be the actual amount of default from the debtors. You have to estimate the default amount. So this is a accounting estimate. Let us see the actual definition. An approximation. Okay, accounting estimate will always be approximate only, it will not be accurate, of monetary amount in the absence of precise means of measurement. Since actual amount is not available, you are making a estimation, approximation of monetary amount. Hope that is clear. Next, fair value accounting estimate. See, fair value accounting estimate is also a type of accounting estimate, but see, it is a type of accounting estimate which involves estimating the price at which asset could be sold or liability could be settled in an ordinary transaction between market participants. Okay, if you take this asset and sell it in the market, actually how much you realize, that will be known as fair value accounting estimate. Okay, between actual market participants, what is the exchange value, that will become fair value accounting estimate. Now if you see in India, there are various items that require fair value accounting estimate. First of all, financial instruments, assets held for sale, and in case of business combination, you will take into the assets in your book at fair value, not only other assets, even also liabilities and share based payments. All these are examples for fair value accounting estimates. We will also see that in the next slide. See, certain examples for accounting estimates and fair value accounting estimates. Now if you see for accounting estimates, allowance for doubtful debts, warranty obligation, depreciation method or asset life, inventory obsolescence, outcome of long term contracts. All these are accounting estimates. Next, fair value accounting estimates, complex financial instruments, share based payments, assets acquired under business combination, property equipment held for disposal, transactions involving exchange of assets or liabilities. These are examples of fair value accounting estimates. Okay, so I hope now you understood what is accounting estimates, what is fair value accounting estimate. Now there is a concept of estimation uncertainty. This estimation uncertainty arises when you make accounting estimates. Now let me tell you what is this. You have estimated the provision for doubtful debt as 1 crore, but actually the debts that were not given by the debtors, okay, the actual debts that have been written off were, let's say, 1.5 crore. So now if you see, there is a difference between the estimate and the actual amount that has arisen. This difference is there na, it will be known as estimation uncertainty. Hope that is clear. And always estimation uncertainty will be there in case of accounting estimates or fair value accounting estimates. See, the susceptibility of an accounting estimate and related disclosure to an inherent lack of precision. Precision means accuracy. Okay, lack of accuracy in accounting estimates is known as estimation uncertainty. Okay, in its measurement. Next, degree of estimation uncertainty. Basically, if you see, there are various factors that will influence the degree of estimation uncertainty. Okay, how much estimation uncertainty will be there? Okay, whether estimation uncertainty will be high, low, medium. Okay, how much it will be there? That will be impacted by various factors. We will see that. Information available to management for making an accounting estimate varies widely. Okay, the information that is available to the management for making accounting estimates varies, and this affects the degree of estimation uncertainty, which in turn affects risk of material misstatement of accounting estimate. Okay, risk of material misstatement in accounting estimate means the risk that accounting estimate might turn to be wrong, might turn to be misstated. Okay, this risk in accounting estimate will increase because of degree of estimation uncertainty. Okay, if there is high degree of estimation uncertainty, then there is high risk of material misstatement in accounting estimate. Okay, hope you understood. Now, factors that will influence degree of estimation uncertainty. There are various factors that will influence the degree of estimation uncertainty. First of all, nature of accounting estimate. Okay, the type of accounting estimate that you are making. Let's say, for example, the accounting estimate that you are making is with respect to depreciation. Now, with respect to depreciation, you will mostly use the SLM or WDV, that is widely accepted method, and more or less the actual useful life or the actual amount of depreciation will also be more or less the same. Whereas if you are making estimation with respect to doubtful debts, in such a situation, in case of doubtful debts, you don't know, you might estimate that 1 crore might be the doubtful debt. Okay, 1 crore might be the loss that we might incur, so you will make a provision for 1 crore, but you don't know, actually even some more debtors are also not giving you the money. Here this estimation is dependent on external factor, so there will be high estimation uncertainty with respect to doubtful debts when compared to estimation uncertainty in depreciation. So nature of accounting estimate will influence the degree of estimation uncertainty. Next, sensitivity of estimate to changes in assumption. See, for making estimate, you will make various assumption. If slight change in assumption, if you make a slight change in assumption, how much change in estimation will occur? This aspect will also influence the degree of estimation uncertainty. Okay, the sensitivity of accounting estimate to the changes in assumption. Next, subjectivity of the assumptions used for making the accounting estimate. Subjectivity means, I have already explained you about this concept of subjectivity. Okay, subjectivity means one's emotions. Okay, if assumptions or involves subjective decisions, then there will be high estimation uncertainty. Like for example, I might think that this asset will be used for 5 years. Another person might think that this will be used on for 10 years. Another person might think that we will use this asset for 20 years. So if you see here in this estimation of depreciation, each person is thinking differently. That is known as subjectivity, which will vary from person to person. Next, availability of generally accepted method used for making the accounting estimate. Okay, if generally accepted method is available, then degree of estimation uncertainty will be less. Next, length of forecast period. Okay, for how much period you are estimating. If it is less period, then estimation uncertainty will be less. If it is much period, okay, longer period is covered, estimation uncertainty will be high. Okay. Next, examples of situation in which there will be low estimation uncertainty and high estimation uncertainty. See, low estimation uncertainty. If estimates are made frequently, then management will acquire experience, so estimation uncertainty will be less. Data is readily available. Method prescribed by applicable financial reporting framework is simple. Okay, if the method is simple, then estimation uncertainty will be less. Model used is well known for everyone. Okay, in these situations, the estimation uncertainty will be very much low. Next, high estimation uncertainty. If estimates that are highly dependent upon judgment, that is subjectivity. Next, estimates relating to outcome of a litigation, this involves high estimation uncertainty. Fair value accounting estimate, for which highly specialized entity developer model is used. Okay, complex model you are using, complex method you are using for making estimate, then also high estimation uncertainty. Fair value accounting estimate of financial instruments not publicly traded. Okay, unlisted entities, financial instruments you want to value. In such a situation also, the estimation uncertainty will be very high. Auditor shall determine whether in the auditor's judgment any of those accounting estimates having high estimation uncertainty give rise to significant risk. Okay, auditor needs to determine whether any of this leads to significant risk. Next, accounting estimates involving significant risks. If at all accounting estimates involve significant risk, then auditor for such significant risks, he should evaluate the following. What are they? Let's see. For accounting estimates involving significant risk, okay, if auditor feels that for any accounting estimate there is a significant, that means high risk involved, then he should evaluate how management considered alternate assumptions and why it has rejected them. Okay, whether management has considered alternate assumptions for making this estimate, and if they have rejected those assumptions, why they have rejected. Auditor needs to evaluate this, whether significant assumptions used by management are reasonable. Next, management's intent and ability to carry out specific action in order to reduce the estimation uncertainty, whether management has proposed any action to carry out. If yes, what is the management's intent and ability to carry out that particular action? Let's say, for example, management or the company is having debtors. There are 15 debtors. From these 15 debtors, from some 20 crore is receivable. Now, out of these 15 debtors, 10 debtors have become bankrupt. They are not giving money to the entity, and these 10 debtors own some 9 crore to the entity. Now, if you see here, 9 crore provision has to be made for doubtful debts, but management is saying that of these 10 debtors, we will make recovery actions very much with respect to 5 debtors, and we are having confidence that we can recover an amount of 5 crores out of these 9 crores from the debtors based on our actions that we will perform. Now, in this situation, management provided only 4 crore as provision. Now, here auditor has to verify what is the management's intent and ability to carry out the specific action that the management has proposed, whether management will be able to recover the 5 crores or not. Auditor needs to evaluate. Okay, next, risk assessment procedures with respect to accounting estimates. See, auditor shall perform certain risk assessment procedures. Basically, risk assessment procedure involves understanding the item and also inquiring with the management with respect to various aspects. If you see here, auditor shall obtain understanding of the following. What is the requirement of applicable financial reporting framework relevant to accounting estimate? Okay, how applicable financial reporting framework is asking to value the accounting estimate, whether it has given any method. Auditor needs to understand it, and how management identifies transactions and events that may give rise to the need for accounting estimates. Okay, how the management has identified that this transaction will require accounting estimate. Auditor needs to understand that, and changes in the circumstances may also give rise to the need for accounting estimate. Inquiries of management about changes in circumstances may include whether entity has engaged in new types of transactions. Okay, auditor needs to inquire with the management whether entity has entered into new transactions. If new transactions are entered, whether estimation is involved for such a new transaction. Okay, this is risk assessment procedure auditor is performing. Terms of transactions have changed. Okay, whether there have been any change in the terms of transaction. Accounting policy relating to accounting estimates have changed. Okay, whether the accounting policy that you have followed for accounting estimates have changed. Next, regulatory or other changes. Okay, whether there has been any change in regulatory or any other aspect. Next, new conditions or events that are requiring accounting estimate. So, auditor will ask the management whether any of these aspects has occurred. This is a risk assessment procedure that the auditor is performing. Now, how management makes accounting estimates. Auditor should also understand what procedure, what method the management is following for making accounting estimates, and from where it is taking the data required for accounting estimates, and the consistency and completeness of data, and the assumptions used by the management. All this auditor will understand. See, what method the management is using, relevant controls that the management has implemented, and assumptions underlying the accounting estimate, what assumptions the management is using, change in the method from previous period. Okay, whether there has been any change in the method that is followed by the management when compared to the prior period, how management has assessed the effect of estimation uncertainty, and whether management has used any expert for making the accounting estimate. All these auditor will understand, all these auditor will inquire from the management. So By doing all this, auditor will come to a conclusion with respect to the risk of material misstatement in accounting estimate. Now, after calculating the risk of material misstatement, auditor will design his audit procedures, right, with respect to accounting estimate. Now, here in this, auditor should also verify, auditor should also evaluate prior period accounting estimates. Why auditor should evaluate prior period accounting estimates? Because management, they would have made certain estimations even in the prior period also, and auditor is auditing current period. Now, from prior period to current period, those estimations, actual amounts would have occurred, right? With respect to some items, actual amounts would have occurred. Let's say, for example, in the prior period, management has made an estimation that for the next year, warranty claims would be some 50 lakh rupees, whereas auditor is auditing in the current year. Now, in the current year means the period has already completed, 1 year period completed. So, in that one year period, how much claims have occurred? 60 lakh claim have occurred, but management has estimated only 50 lakh. So, there is a 10 lakh additional claim. So, by this, auditor will obtain evidence with respect to the estimations that the management is making, whether management is making correct estimations or not, and whether there is estimation uncertainty in the estimations that the management is making. With respect to all this, auditor can obtain evidence, actual evidence, by evaluating the prior period accounting estimates and comparing those prior period accounting estimates with the actual figures that has occurred in the current year. Okay. Next, responses to assess the risk of material misstatement. So, what responses auditor will perform with respect to assess risk of material misstatement? Auditor shall determine whether management has appropriately applied the requirements of applicable financial reporting framework. Okay, the first procedure that the auditor will perform is he will see whether the requirements of applicable financial reporting framework has been actually properly applied by management or not. Next, methods have been applied consistently. Okay, the methods that the management is using for making accounting estimates are consistently applied from the previous year or not. Next, test check the data used. You have to once test check the data that has been used for making the accounting estimates. Next, events occurring up to the date of the auditor's report provide audit evidence regarding accounting estimate. You have to see that also. And consider the source, relevance, reliability, and completeness of external data. Okay, whether the data that is being used for the purpose of making accounting estimate is consistent, reliable, complete, and you should also see the source from which the data is obtained. And finally, if you want, you can also recalculate the accounting estimate. This is also one of the further audit procedure that you can perform with respect to the accounting estimate. So these are the responses that the auditor can design with respect to accounting estimates. Okay, these are nothing but procedures that the auditor will perform. Okay, so by this essay, revision of essay 540 is completed. Now we'll move to essay 550. Let me open that PPT. So now let us see essay 550. Essay 550, it deals with related parties. Now, even this related parties is also such an area where there will be significant risk. Now, this standard, it deal with how the auditor will perform risk assessment procedures with respect to related parties and the related party transactions, and after that how the auditor will design his further audit procedures based on his risk of material misstatement. That is what we will be discussing in this related parties essay 550. Okay, essay 550, related parties and related party transactions. So what is the objective of this standard? Objective of this standard is to obtain understanding of related party transactions and relationships. Firstly, to recognize fraud risk factors arising from such transactions. Okay, the first objective of this standard is to recognize the fraud risk factors arising from related party transactions and also conclude whether financial statements show a true and fair presentation of those relationships and transactions and obtain sufficient appropriate audit evidence about whether related party relationships and transactions have been appropriately identified, accounted for, and disclosed. Okay, these are the three objectives of this SA 550. First of all, to recognize fraud risk factor arising from related party relationships and transactions. Next, conclude whether financial statements show a true and fair picture of these related party transactions and relationships, and also obtain sufficient appropriate audit evidence about whether related party relationships and transactions have been appropriately identified and accounted for and disclosed properly in the financial statements or not. Now the question that arises here is, what is meant by related party? When will you call a particular party as a related party to the reporting entity? Now if applicable financial reporting framework has any definition for the related party, then you can follow such definition. If there is no definition for related party as per applicable financial reporting framework, then you have to follow the definition that is given as per the standard. See, a related party as defined under applicable financial reporting framework or the following definition. Let's say this is a reporting entity. Reporting entity means the entity for which the auditor is conducting the audit. Now there is A Limited, which is holding company of reporting entity. Okay, A Limited is either having control or significant influence. Control means more than 50%. Significant means 20% or more. Significant influence means, okay, if you are having control, that entity becomes subsidiary. If you are having significant influence, that entity becomes associate. So here in this situation, A Limited will become related party for the reporting entity. Or if reporting entity is having significant influence or control over B Limited, then B Limited also becomes a related party of reporting entity. And if there is common ownership or common key managerial personnel between A Limited and C Limited, then C Limited will also be related party for reporting entity. Okay, now if you enter in any transaction into with these related parties, such a transaction will be known as related party transaction. Hope that is clear. Next, what is the meaning of these terms control and significant influence? See, control means power to govern financial and operating policies of an entity so as to obtain benefits from its activities. Okay, control, it will be said that you are having control over the other entity if you are able to control or govern the financial and operating policies in that entity. Okay, whatever you say, that only will happen. Okay, you are having the ultimate power to control the activities in that entity, then it will be said that you are having control over that entity. Next, significant influence means you are not having ultimate control, but you are having power to participate in the decision making. See, power to participate in the financial and operating policy decisions of an entity, but is not control over those. You are not having ultimate control. Okay, if you are having 50 more than 50%, okay, 51% or more holding, then you will have control. But if you are just having more than 20% holding, then you will have significant influence. Okay, you can just participate in the decision making, but your word will not become the final. Next, risk assessment procedures. Now with respect to this related party transactions, auditor has to perform risk assessment procedures. What will be the risk assessment procedure that he will perform? Just like we discussed in SA 540, first of all he will understand, then he will inquire. Okay, see, engagement team shall discuss about suspectability of the financial statements to material misstatement due to fraud or error resulting from the entity's related party relationships and transactions. Okay, the engagement team, they have to discuss among themselves about the susceptibility of risk of material misstatement in the related party transactions. So in their discussions, they can discuss nature and extent of entities related party relationships, and also maintaining professional skepticism throughout the audit. This is very important. Auditor, while conducting the audit, okay, during the entire audit, he should be alert to any identification of related parties and related party transactions. Okay, he should be alert, he should have questioning mind to find out the related party transactions and relationships. So throughout the audit, he should maintain professional skepticism for identifying related party relationships and transactions. Next, circumstances or conditions that may indicate the existence of related party relationships or transactions that management has not identified or disclosed to the auditor. Okay, the engagement team should also discuss among themselves about those circumstances or conditions that may indicate existence of related party relationships or transactions that are not previously identified or communicated by the management. Next, records or documents that may indicate existence of related party transactions and relationships. Importance that management and those charged with governance attach to the appropriate accounting and disclosure of related party relationships and transactions. So all these aspects the engagement team shall discuss among itself. Next, after this, auditor he will inquire with the management regarding the following aspects: identity of entities, related party relationships. Okay, he will inquire what is the identity of all your related parties, give us the list. Next, nature of relationship between entity and that related party, you will inquire about the nature of relationship. Okay, how they have become the related party, whether entity entered into any transaction with them during the period. Okay, you'll also ask whether during the period have you entered into any transaction with them, and you will understand the established controls to identify, account for and disclose related party relationships and transactions, to authorize significant transactions with related party and transactions outside the normal course of business. See, transactions outside the normal course of business means these type of transactions you will not regularly enter in your business, but rarely you will enter into these type of transactions. They are known as transactions outside the normal course of business of the entity. You will also understand whether entity has entered into any of these transactions that are outside the normal course of entity's business. Okay, see, this is important. This point I have already discussed with you. During the audit, auditor shall remain alert for arrangements or other information that may indicate existence of related party relationships or transactions that management has not previously identified or disclosed. Okay, you should maintain professional skepticism throughout the audit to identify any related party relationships or transactions that the management has not yet communicated to you. Okay, see, what happens is generally management, they will first of all give the complete list of related parties and related party transactions that it has identified. Okay, the knowledge of which is having to the management, all that list it will give. So during the audit you should be very much attentive to identify the transactions and the related party relationships that the management has not yet communicated to you. Okay, now identification of previously unidentified or undisclosed related party relationships or transactions. Now if during the audit you have identified some related party relationships or transactions that have not been communicated to you by management, now in this situation what you do? See, if the auditor identifies related party relationships or significant related party transactions that management has not previously identified or disclosed to the auditor, then auditor shall first of all communicate about these transactions and relationships to the members of the engagement team. See, communicate to the other members of the engagement team. Next, request management to identify all transactions with the new related parties. Now, auditor has identified some new related party relationships. Now, auditor will ask the management, now tell me all the, or give me the list of all the transactions that you have entered into with these related party. Like this, you will ask for the list of transactions. Next, inquire as to why entities controls failed to identify the related party relationships or transactions. Now you will inquire the management, you have already established the controls for identifying related parties and related party transactions, but why this transaction has missed? Okay, why you haven't identified this relationship? You will inquire with the management. Next, you will perform appropriate substantive audit procedures on these new related party transactions and relationships. Okay, so this is what you will do if you have identified new related party relationships or transactions, still there is one more thing that you do, that is reconsider the risk that other related parties or transactions may exist that management has not previously identified or disclosed. Now you have identified one relationship or one related party transaction that the management has not communicated to you. You should reconsider the risk that there can be some other related party transactions or some other related party relationships that the management has not communicated. You should reconsider this risk and search for such other related party transactions or relationships. Okay, now if non-disclosure by management appears intentional, okay, if you find that management has intentionally hidden this relationship, hidden this related party transaction, then you should also evaluate the implication for the entire audit. Okay, if management has hidden this related party relationship, means still what could have been hidden by the management, whether we can place reliance on the evidences that the management has submitted previously. Okay, all these doubts will arise now because management has wantedly hidden one of the related party relationship from us. Okay, next, identification of significant related party transactions outside the entity's normal course of business. If you have identified, inspect underlying contracts or arrangements to evaluate whether business rationale of transaction indicates fraudulent financial reporting or concealed misappropriation of assets. Okay, if at all you have identified any significant related party transactions outside the normal course of business, then you have to evaluate the business rationale. Okay, whether this has been entered with the proper business purpose only, or the entity is occurring any loss in this transaction, or this transaction is prejudicial to the interest of the entity. You have to evaluate. Next, terms of the transaction are consistent with the management's explanation. You have to see that, and transactions have been appropriately accounted and disclosed. Okay, and this transaction is appropriately accounted and disclosed in the financial statement. You should see that. Next, auditor shall obtain audit evidence that the transaction have been appropriately authorized and approved. Okay. Next, you should obtain written representation from the management. What written representation you will obtain? They have disclosed to the auditor all related party relationships and transactions of which they are aware. Okay, like this you have to ask a written representation from the management, and also they have appropriately accounted for and disclosed all such transactions in the financial statements. Okay, with respect to these two, you have to obtain written representation from the management in relation to related party transactions and relationships. Okay, so this is SA 550. Now we will start the revision of SA 560. Let me open the PPT. So now I have opened the PPT of SA 560, subsequent events. Just a second. Now SA 560 deals with subsequent events, auditor's responsibility with respect to subsequent events. First of all, we will discuss what is the objective, or first of all we will discuss what is the meaning of the term subsequent event. Let us discuss this with the help of an example. Let's say this is the timeline. Now here on 31st March 2024, financial statements will be prepared. This will be the date of financial statements, and let's say on 15th April 2024, financial statements have been approved by management, and on 30 April 2024, auditor is giving his audit report. That is, date of audit report is 30 April 2024, and these audited financial statements, they are issued to the public on 15th May 2024. Now these are the dates. Now if you see the events that occur between date of financial statements and the date of approval of financial statements, these will be considered as subsequent events as per accounting standards and Indian accounting standards. This one just for the information I have told you. You have to remember the subsequent event definition as per auditing standard. Now as per auditing standards, the events that occur between date of financial statements and date of approval of financial statements, let us call them as subsequent event number 1. See, the auditing standard has not divided it into subsequent event 1, 2, 3, but for the purpose of easily understanding, I am dividing it into subsequent event 1. Next, those events that occur between date of approval of financial statements and date of auditor's report will be subsequent event 2. Okay, so all the events that occur between date of financial statements and date of auditor's report will be subsequent event 1. Okay, will be subsequent event 1 and subsequent event 2. Okay, both taken together. Next, the facts which are known to the auditor after the date of auditor's report, but they were existence or they were inexistent before the date of audit report, are known as subsequent event number 3. Okay, these subsequent event number 3 is there na. These events, they are present here only. Okay, but the fact about those events is known to the auditor in this period or in this period. Okay, we will call it as subsequent event number 3. Hope that is clear. Now, see, this entire portion is there na. If you see, this entire portion from here to here will be known as subsequent event for the purpose of SA 560, and for the purpose of proper reporting and properly understanding, I have divided it into 3 subsequent events. Okay, and you need to remember about subsequent event 3. Okay, this event has occurred in this period only, but the fact about that event is known to the auditor in this period. Okay, yes. Now, SA 560 deals with the following: audit procedures when there are events occurring between the date of financial statements and date of auditor's report, that is subsequent event 1 and subsequent event 2 occur. Okay, about those both it is speaking. Next, audit procedures when there are facts which become known to the auditor after the date of auditor's report but before the date financial statements are issued. This is subsequent event number 3. Next, audit procedures when there are facts which become known to the auditor after financial statements have been issued. Okay, that means those subsequent events which are known to the auditor in this period, okay, after financial statements have been issued. Hope that is clear. So SA 560 will deal with all these 3 aspects. So how the auditor has to deal with this aspect, that will be dealt by SA 560. Now, firstly, we will see audit procedures that the auditor has to perform with respect to subsequent event 1 and 2. That means events that are occurring between date of balance sheet and the date of auditor's report. See, audit procedures to obtain sufficient appropriate audit evidence that all events occurring between date of financial statements and date of audit report that require adjustment of or disclosure in the financial statements have been identified. Okay, with respect to this, what audit procedures auditor will perform? First of all, auditor will understand the procedures that the management has established to ensure that subsequent events are identified. Okay, to identify subsequent events, what procedures management has established, those procedures will be understood by the auditor. Next, he will inquire whether any subsequent events occurred which might affect the financial statements. Okay, he will also inquire with the management whether any subsequent events that affect the financial statements has occurred, and he will also read minutes of meeting and also entities latest subsequent interim financial statements. All these procedures he will perform with respect to identification of subsequent event 1 and 2. Next, this is subsequent event number 3. Facts which become known to the auditor after the date of auditor's report but before the date financial statements are issued. This will form, or this will form in subsequent event number 3, fall in subsequent event number 3. See, after the date of auditor's report but before the date financial statements are issued, fact becomes known to the auditor that had it been known to the auditor at the date of auditor's report may have caused the auditor to amend the auditor's report. Then auditor shall discuss the matter with management and determine whether the financial statements need amendment. Okay, now a fact has come, a fact has known to the auditor after the date of audit report, and that event has occurred before the date of audit report only. Now in this situation, if at all he would have known about that fact before issuing the audit report only, then he would have asked the management to adjust it in the financial statements, but it is known to the auditor after issue of, or not after issue of audit report. In this situation, auditor has to first of all discuss this matter with the management and determine whether there is any necessity to amend the financial statements and inquire how management intends to address this matter. Okay, how management is planning to address this matter. Auditor should ask this with the management. Next, para 12 of SA 560. This is very much important. Now, see, first of all, I'll read this paragraph, then I'll explain you. When law or applicable financial reporting framework does not prohibit management from restricting the amendment of financial statement to the effects of subsequent events or events causing that amendment, and those responsible for approving the financial statements are not prohibited from restricting their approval to the amendment, auditor is permitted to restrict the audit procedure on subsequent event required in paragraph to that amendment. In such cases, the auditor shall either amend the auditor's report to include additional date restricted to the amendment, we will be calling it as dual dating, or auditor can provide new or amended audit report including emphasis of matter or other matter paragraph. What is this all about? Now let me tell you. See, now let's say on 15th May 2025, auditor has issued audit report. This is the date of audit report. That means on this date, the financial statements would have adjusted all the subsequent events that have occurred from 31st March 2025 to 15th May 2025. All these subsequent events would have occurred. Now he has given his audit report on this date. Now on 6th June 2025, auditor has come to know about a particular fact which was present before the date of audit report only. Now because of this, the financial statements has to be amended. That means the audit report date will pass this date. Okay, if the management amends the financial statements, auditor, he has to give his audit report again on the amended financial statements. So auditor report, let's say for example, after the management has amended the financial statements, auditor has given his audit report on 10th June 2025. Now in this amended audit report, for the purpose of this amended audit report, subsequent events means the events that are occurring between date of balance sheet till the date of audit report. Now if you see, the date of new audit report is 10th June 2025. That means all the events that occurred between 15th May 2025 to 10th June 2025 will also become subsequent events as per the definition of subsequent event, right? But paragraph 12 says that if management restricts its amendment only for this fact, then auditor can also restrict his opinion only for this fact. He need not consider all these events that occur between these dates as subsequent events. He can restrict his opinion only for this fact. Hope you understood this. Okay, if management can restrict amendment of financial statements only to this particular fact, then auditor can also restrict his opinion only to that particular fact. He need not consider all the events that occurred between these two dates as subsequent events. Okay, because here you are providing amended audit report. You need not consider all these events that occur between 15th May 2025 to 10th June 2025 as subsequent events. Okay, only events that occurred between 31st March 2025 to 15th May 2025 can be considered as subsequent events. Okay, if management has restricted its amendment only to this particular fact. Hope you understood this. Okay, this is the meaning of that particular paragraph 12. Now, in this situation, what the auditor can do is, auditor, he can give dual dating in his audit report. That means for all the events that occurred till 15th May 2025, the date of audit report will be 15th May 2025. Okay, for all those subsequent events. But only for this particular fact, the date of audit report will be 10th June. Okay, so like this, he can give dual dating for the audit report, or if he wants, he can amend and give a new audit report as on this particular date. Hope you understood this. See, provide new or amended audit report including emphasis of matter or other matter paragraph. Next, reporting in case of subsequent event 3, that is facts which have known to the auditor after the financial statements or after the audit report has been issued. See, in such a situation, if management agrees to amend the financial statements, then and paragraph 12 is applicable. Paragraph 12 applicable means we have discussed that just now. Management has restricted the amendment only to that particular fact. In such a situation, auditor can amend auditor's report to include additional date restricted to that amendment, provide new or amended audit report including emphasis of matter or other paragraph. Okay, any of the two options is available to the auditor. If paragraph 12 is not applicable to the situation, then extend audit procedures till the date of new audit report and issue new audit report dating not earlier than the amended financial statements. Okay, if paragraph 12 is not applicable, then the events that occurred between date of old audit report and the date of new audit report will also be considered as subsequent events, and auditor has to consider them also. Okay, if paragraph 12 is not applicable. Next, if management doesn't agree to amend the financial statements, in such a situation, modify if report is not yet provided, or if report is provided, ask management not to issue further until amended. Okay, if you have not yet provided the audit report, then you will modify your opinion and you will give the audit report. If in case you have already provided the audit report, if report is provided, then you will ask the management not to issue this audit report until amended. Next, another situation, facts which become known to the auditor after financial statements have been issued. See, in the earlier situation we have discussed facts which have become known to the auditor after audit report is issued to the management. Still management has not issued the financial statements to public. In this situation, we are speaking about facts which become known to the auditor after management has issued the financial statements, audited financial statements to the public. In such a situation, the reporting will be just like similar to the previous one that we have discussed, but with a small change. See, after the financial statements have been issued, a fact becomes known to the auditor that had it been known to the auditor at the date of auditor's report, may have caused the auditor to amend the auditor's report. The auditor shall discuss the matter with management, determine whether the financial statements need amendment, same just like we have seen earlier, inquire how management intends to address the matter. Now going to the reporting part, see how you will report. If management takes steps to inform users and amend financial statements. Okay, if management takes steps to inform users that users, you don't rely on the financial statements that we have given you, we are going to amend it. If management amends the financial statements and paragraph 12 is applicable to the case, okay, paragraph 12 is applicable, then auditor will amend the auditor's report to include additional date restricted to the amendment, that is dual dating, or provide a new or amended audit report including emphasis of matter or other matter paragraph. If paragraph 12 is not applicable to the case, in such a situation, see, extend audit procedures till date of new audit report, and issue new audit report dating not earlier than the amended financial statements. Okay, you need to consider the events occurring between the old audit report date and the new audit report date also as subsequent events in your audit report. Next, if management refuses, see, if management doesn't take necessary steps and doesn't agree to amend the financial statements, in such a situation, notify management and those charged with governance that the auditor will seek to prevent a future reliance on the auditor's report. Okay, you need to notify the management and those charged with governance that auditor will take whatever the action that is necessary, or you should ask the management to please ask the users not to rely on the financial statements that you have issued. If management doesn't take any steps to prevent users from relying on the financial statements that it has issued, then auditor he himself will take the steps. See, despite of such notification, management takes no action, then auditor shall take action to prevent users from reliance on auditor's report. Okay, so this is SA 560 subsequent events. In the next class, we will see SA 570, which is going concern. Okay, not the next class. I'll open just now. Okay, I'll open the PPT. Let me open PPT of SA 570. Yes, now we'll be seeing SA 570, which deals with going concern. Now, if you see, the going concern assumption has to be made by the management before preparing the financial statements. It has to make an assessment of whether the entity will be able to continue as a going concern or not. Going concern means entity should be able to pay off its liabilities in the foreseeable future. See, let us see the definition. Assumption that entity will be able to continue its business for foreseeable future. And who is responsible for making this going concern assumption? Obviously, management is responsible. After management has made the going concern assessment, auditor he will evaluate whether the going concern as a going concern assessment made by the management is reasonable or not. Okay, that will be evaluated by the auditor. Next, so it is the responsibility of management. Now, objectives of auditor. What are the objectives of auditor as per this SA 570? To obtain sufficient appropriate audit evidence regarding appropriateness of management's use of going concern. Okay, just now I have told you this point. Next, assess whether material uncertainty exists related to events or conditions that may cast significant doubt on the entity's ability to continue as a going concern. Okay, what are these material uncertainty events or conditions? We will see. There are three types of such conditions. Okay, one is financial, operational, and other. We'll also see some of the examples for these conditions. See, events or conditions that may cast significant doubt on the entity's ability to continue as a going concern. They can be bifurcated into three. Firstly, financial events, operating events, and other events. Now, coming to the financial events, some of the examples of financial events. If you see, net liability position, the liabilities of the entity is more than the assets, then this will create a material uncertainty of the entity's ability to continue as a going concern. Okay, this is one of the event or condition that may indicate that entity may not be able to continue as a going concern. Just like that, fixed term borrowings approaching maturity without realistic prospectus of renewal. Okay, borrowings are approaching maturity and there is no possibility for renewal, or withdrawal of financial support by creditors. Creditors are not giving stock on credit basis. Negative operating cash flow. Operating cash flow is negative. Substantial operating losses. Adverse key financial ratios. Arrears or discontinuance of dividends. All these are some of the examples of events or transactions that may indicate entities that may indicate material uncertainty about entities' ability to continue as a going concern. Next, moving to operational events. Okay, still there is one more example, inability to pay creditors on due dates. Next, moving to operating events. Now, management's intention to liquidate the entity. Okay, management itself wanted to liquidate the entity, or loss of key management without replacement, labor difficulties. If you see in these events, no finance is involved. It is not related to monetary, it is related to operating activities. Next, loss of major markets, key customers, franchise license or principal supplier, shortage of important supplies. All these are some of the examples for operating events. See, emergence of highly successful competitor. Next, other events, non-compliance with other statutory or regulatory requirements, pending legal or regulatory proceedings against the entity, change in law, regulation or government policy, uninsured or underinsured catastrophes when they occur. If you see here in this, they are not related to operational uh, or administrative activities of the entity, nor they are related to financial activities. These will come under other events that may cause significant doubt or material uncertainty on the entity's ability to continue as a going concern. Next, evaluating management's assessment of going concern. Now, in the first slide itself, we have discussed that it is a responsibility of the management to assess whether entity can continue as a going concern or not. After that, auditor has to evaluate the assessment that is made by the management. Now, how the auditor will evaluate? Let us see. Determine whether management has already performed preliminary assessment of entity's ability to continue as a going concern. Okay, you have to determine whether management has actually performed its assessment or not. If management has performed, okay, if yes, discuss management's assessment and whether management has identified any conditions that may cast significant doubt on the entity's ability to continue as a going concern. Okay, you have to discuss with the management how they have conducted their assessment, and during their assessment whether they have found any events or conditions that may cast significant doubt on the entity's ability to continue as a going concern. If no, if management has not performed any such assessment, then discuss management's basis for intended use of going concern basis of accounting. Okay, management saying they have not performed going concern assessment, but they have prepared the financial statements as per going concern. So, what is the basis for their going concern basis of accounting? You should ask this with the management. Next, if management's assessment covers less than 12 months from the date of financial statements, auditor shall request management to extend its assessment for a period at least 12 months. See, management has to verify going concern assumption of the entity for a period of at least 12 months from the date of financial statements. Okay, if management has covered less than 12 months, then auditor should ask the management to cover its going concern assessment for at least 12 months. Okay, next, consider whether management's assessment includes all relevant information of which auditor is aware as a result of audit. Okay, whether management has considered all the information that the auditor has known with respect to going concern assessment. Next, inquire of management as to its knowledge of events or conditions beyond the period of management's assessment that may cast significant doubt on entity's ability to continue as a going concern. Now, management has made assessment of going concern up to certain period, let's say 12 months or 24 months. Now, you should also ask management whether management is having idea of any events or conditions that may occur after the period considered by the management, which may cast significant doubt on the entity's ability to continue as a going concern. Okay. Next, audit procedure when events or conditions are identified. See, if any of the events or conditions that may cast significant doubt on entity's ability to continue as a going concern is identified, then auditor shall, where management has not yet made an assessment of entity's ability to continue as a going concern, request management to make its assessment first. Okay, if auditor identifies any events or condition, he will ask the management, have you made your assessment? If management says no, we have not yet made the assessment, then auditor will say, you first of all make assessment of going concern from your side, then evaluate management's plans for future action. Now, what is the management plan for future action? Let's say the borrowings are approaching maturity and there is no possibility for renewal of borrowing. Now, in this situation, what is the future plan of action? How management will get money for their business? management is planning to invest its own money. So this is it's a future plan of action. So auditor should discuss this future plan of action with the management to overcome these material uncertainty. Next, analyzing the cash flow forecast of the entity. Any additional facts or information have become available, and requesting written representation from management and those charged with governance regarding their plans for future actions and their feasibility of these plans. Okay, here management has told that they are going to take certain actions, certain future actions. So auditor should ask for a written representation of those future plan of actions along with their feasibility. Okay, next coming to the final part, that is reporting in case of going concern. See, audit reporting. If use of going concern assumption is appropriate, okay, management has used going concern basis of assumption for preparing its financial statements, and such use of going concern assumption is appropriate, but a material uncertainty exists. If a material uncertainty is existed and use of going concern assumption is appropriate, then management has to disclose this in its financial statements properly. See, if adequate disclosure of material uncertainty is made in the financial statements, then auditor can give unmodified opinion with material uncertainty related to going concern paragraph. Okay, by including this material uncertainty related to going concern paragraph in the audit report, auditor can give unmodified opinion. In SA 700, while discussing the format of audit report, we have seen about material uncertainty related to going concern paragraph, which will be given as per SA 570. Right now, if management has not given adequate disclosure, see, adequate disclosure of material uncertainty is not made in the financial statements. In such a situation, what the auditor will do? Auditor will qualify or give adverse opinion based on pervasiveness of the misstatement. Okay. Next, use of going concern base of accounting is inappropriate. See, management should not use going concern base of accounting, but it has used going concern base of accounting. In such a situation, auditor will give adverse opinion because audit evidence is available and the misstatement is material. Okay, not using the going concern base of going concern basis of accounting appropriately, and it is also pervasive because it is affecting entire financial statements. So auditor will give adverse opinion. Next, if management is unwilling to make the assessment, okay, management is not willing to make the assessment, then auditor should consider the impact on his opinion. Okay, whether he has to give modified opinion, whether he has to give unmodified opinion, what is the impact of opinion that he needs to consider. Okay, so by this the revision of SA 570 gets completed. Let me open a book for SA 580. Just a second. So now moving to SA 580, which is written representation. This is a very small standard. First of all, what is meant by a written representation? As the name suggests, it is a written statement given by whom? By management, provided to whom? Provided to auditor regarding to confirm certain matters or support other audit evidence. Okay, this is known as a written representation, and written representation in this context do not include financial statements or other assertions that the management will provide in this context. Next, as per SA 580, written representation with respect to which aspect has to be provided. First of all, written representation by the management stating that it is the responsibility of the management for the preparation of financial statements as per the applicable financial reporting framework. Okay, with respect to that, written representation has to be given. Next, the auditor shall request management to provide written representation that it has applied the it has provided the auditor with all the relevant information and access as agreed in the terms of audit engagement, and all transactions have been recorded and reflected in the financial statements. Okay, management has provided the auditor all the access to the information that has been agreed as per the terms of engagement. With respect to this, a written representation has to be given, and as per other standards on auditing, if any other written representation is necessary, even those written representations should be given. And apart from that, if auditor feels that any other written representation is necessary in the context of audit, he can also ask for those written representations. Next, date of and period covered by written representation. This is important. Now, the date of written representation should not be beyond the date of audit report. Okay, the date of written representation should be before the date of auditor's report only, and written representation should cover all the periods that is covered by the audit report. Okay, next, doubt as to reliability of the written representation. If written representations are inconsistent with other audit evidence that the auditor has obtained, then auditor shall perform audit procedures to attempt to resolve the matter. If the matter remains unresolved, auditor should reconsider the competence, integrity, ethical values of management. Because written representations are given by the management itself and they are not matching with other evidence that the auditor has obtained, so now auditor has to doubt the management's integrity and ethics. If auditor concludes written representations are not reliable, then auditor shall take appropriate action, including determining a possible effect on the opinion. Now, if management doesn't provide the requested written representation, then discuss the matter with management, re-evaluate the integrity of management, and take appropriate action, including possible effect on the auditor's opinion. Now, impact on the opinion. What could be the impact of opinion? See, auditor shall disclaim an opinion on financial statements if auditor concludes that there is sufficient doubt about integrity of management. Now, auditor has concluded that there is doubt about the integrity of management. Management has lost its integrity. They are submitting fake information. They are committing frauds. Okay, they are not giving the written representation. In such a situation, the auditor can give disclaimer of opinion, and management doesn't provide the written representation as required. Okay, in these two situations, auditor can give disclaimer of opinion. So by this, essay 580 also got completed, right? So I'll be winding up this video as of now with all these standards, essay 540, 550, 560, 570, 580. 5 standards we have discussed in this class, right? We'll be meeting in the next class. Until then, take care. Bye bye. See you. Now, in the today's class, we will be revising 4 standards. Firstly, essay 240 related to fraud, essay 250 related to laws and regulations, essay 299 that is a joint audit, and essay 402 service audit, right? So these 4 standards we will be covering in the today's class. Firstly, we will start with essay 250, auditor's responsibility relating to fraud. Auditor's responsibility relating to fraud, essay 240. Now, if you see the discussion with respect to fraud, it is there in essay 240, and you can also find in Companies Act 2013, section number 143, subsection 12, and also clause 11 of CORO. Even clause 11 of CORO deals with fraud reporting. So, with respect to fraud, all these areas, in all these areas, the fraud related provisions are discussed. Now, we will be seeing essay 240. Now, if you see, auditors, what are the responsibilities of the auditor with respect to this fraud? Okay, what audit procedures he has to perform to identify frauds, and what is the reporting responsibility of auditor as per essay 240. All that aspects we will be seeing in essay 240. Okay, and various types of frauds we will be seeing. Now, first of all, you already know this statement. Misstatements in financial statements, they can occur either because of fraud or because of error. Now, what is difference between fraud and error? You already know. Fraud is intentional mistake, whereas error is unintentionally. If you commit any mistake, that becomes an error. We have discussed this point while discussing essay 315 only, right? So the same definition will be there here also. Fraud versus error. These images also you'll find in essay 315. So that is the difference between fraud and error. The only difference is fraud is intentional, whereas error is unintentional. Okay. Types of fraud. Basically, if you see, there are 2 types of fraud. One is fraudulent financial reporting, and another one is misappropriation of assets. Fraudulent financial reporting means in the financial statements you can commit a fraud by making wrong entries, by not presenting the items, right? So the fraudulent financial reporting can be done mostly by top management. Misappropriation of assets means stealing assets of the company or using assets of the company for personal use. This misappropriation of assets will be done mostly by lower level employees of the company. Okay. See, auditor is concerned with fraud that causes material misstatement in the financial statements. Okay, if fraud doesn't cause material misstatement in the financial statements, auditor is not concerned with those frauds. Okay, and one type of fraud is fraudulent financial reporting, and another one is misappropriation of assets. Okay, fraudulent financial reporting is with respect to frauds in financial statements. Okay, while preparing the financial statements you commit fraud, that is fraudulent financial reporting. Another one is misappropriation of assets, you will misutilize the assets of the company. These are two types of fraud. Now, how fraudulent financial reporting is done? Okay, how the fraudulent financial reporting is done? Basically, there are various ways to commit fraudulent financial reporting. First of all, you can include the fictitious journal entries in the books of accounts. That means you can pass fake journal entries in the books of accounts. That is one of fraudulent financial reporting. Next, you can alter records terms related to significant and unusual transaction. Okay, you can alter the terms related to significant and unusual transaction. Let's say, for example, you have taken a loan, the rate of interest of that loan is 12%, but you have changed the terms stating that the rate of interest is 14%, so that you can charge high interest in the financial statements and thereby profit will be reduced, thereby tax will be reduced. So here you have changed terms of significant transaction. Even this will also fall under fraudulent financial reporting. Next, omitting, advancing or delaying recognition of events and transactions in the financial statements. Okay, either you completely omit recognition of any transaction or you advance recognition of transaction. Let's say, for example, sale has occurred in the next year. Okay, on 1st April 2025 sale has occurred, but in order to increase the sales of 2024-2025, you have booked that 1st April 2025 sale on 31st March 2025 itself. That is, you have advanced the recognition of transaction, or you can delay the recognition of transaction. Okay, even this also will come under fraudulent financial reporting. Next, inappropriately adjusting assumptions and changing the judgments. Okay, management is inappropriately adjusting the assumptions, like the value of the fixed asset is 10 years, but in order to charge high depreciation, management has inappropriately assumed the life of the asset as 5 years only. That is inappropriate assumptions. Just a second. Oh, what happened to this? This is not working. Yeah, it's working. So inappropriately inappropriately adjusting assumptions and changing judgments. Next, concealing or not disclosing facts that could affect amounts recorded in the financial statements. Okay, you are hiding or not disclosing facts with respect to the transaction that will affect the financial statements. Next, engaging in complex transactions that are structured to misrepresent the financial position of the financial performance of the entity. Okay, you are entering into complex transaction so that you can hide the fraud in the financial statements. Even that is also fraudulent financial reporting. Okay, so in this manner you can do fraudulent financial reporting. Next, how you can do misappropriation of asset? Let's see. Misappropriation of assets, how it is done? You can do misappropriation of asset in the form of embezzling cash. That means you have taken over cash of the company, or stealing physical assets or intellectual property. Okay, you are stealing physical assets of the entity or intellectual property. That means the entity has developed a formula for for manufacturing a medicine. Now you have stolen that formula and you are selling it to some competitors. So you are stealing intellectual property or causing an entity to pay for goods and services not received. Okay, entity has not yet received any goods or services, but you are creating fictitious vendors and you are making payments to those fictitious vendors. Even this also becomes a misappropriation of assets. Next, using entities assets for personal use. Okay, there is a car of the entity. Now the employee is using that car for personal trip of his family. Okay, he went to some Goa for a family trip of 6 days. So he has taken over the car of the company and he went to Goa. So this is using assets of the company for personal use. Okay, this way you can misappropriate the assets. Next, responsibility for prevention and detection of fraud. Tell me, who is having responsibility to detect and prevent fraud? Whether it is auditor. Okay, is auditor having a responsibility to prevent and detect fraud? The answer is no. It is the primary responsibility of management and those charged with governance to prevent and detect fraud. However, even auditor is also having responsibility, but auditor, while doing the audit, if he finds any fraud, he has to report. Okay, auditor's responsibility is secondary responsibility, but the primary responsibility to prevent and detect fraud lies with management and those charged with governance. See, management and those charged with governance is having responsibility for prevention and detection of fraud. Next, responsibility of auditor. What is the responsibility of auditor? Let us see. The first responsibility of the auditor is to identify and assess risk of material misstatement due to fraud in the financial statements. Obviously, auditor will not directly identify the frauds. First of all, he will identify the risk of material misstatement due to fraud in the financial statements. Then obtain sufficient appropriate audit evidence about the assessed risk of material misstatement. Right, after you have assessed risk of material misstatement with respect to fraud, you will obtain sufficient appropriate audit evidence related to that risk. Then you will respond appropriately to identified or suspected fraud. How you will respond? By designing audit procedures. Okay, so first you will determine risk of material misstatement, then you will obtain sufficient appropriate audit evidence, then you will design your responses to that particular risk of fraud. Right, so this is a responsibility of auditor. Next, fraud risk factors. What are these fraud risk factors? Basically, there are 3 fraud risk factors. That means if these factors are there, then there is a high chance that fraud would be there in that area. Okay, so what are those factors? If these factors are present, then the risk of fraud is high. They are known as fraud risk factors. What are those 3 fraud risk factors? Incentive or pressure to commit fraud. Okay, the employees will get some benefit if they commit fraud, or the management is under pressure to commit fraud. Let's say, for example, the entity is a listed entity and the sales of the company is drastically dropping, so the share price is also dropping, whereas the other companies which are operating in the same industry, they are working well, their share price is going up. Now here the management of our company, they will be under peer pressure to increase the share price of the company. Under this pressure, they might commit fraud. Right, so this is one of the fraud risk factor. What is the first fraud risk factor? Incentive or pressure to commit the fraud. Next, perceived opportunity to commit the fraud. See, the person is not having any intention to commit the fraud, but there is an opportunity to commit the fraud. Okay, there are no controls in the organization, cash is left just like that. Okay, without any controls, cash is left like that. Then obviously the person will take over the cash because there is an opportunity to commit fraud. Right, so this is the second fraud risk factor. If there is an open opportunity to commit the fraud, then there is a high risk that fraud can occur in that area. Next, ability to rationalize the fraudulent action. See, the nature of the person itself is such that he don't feel for committing fraud. Okay, he has become accustomed for committing frauds. Okay, he takes frauds very lightly. Okay, he commits fraud and he doesn't feel for committing such fraud. Okay, he is okay with committing frauds. That means he is having a rationalized behavior towards the fraud. Okay, that means ability to rationalize the fraudulent action. So if at all the employee's character is such that they rationalize the act of committing fraud, then also the risk of fraud will be high. So these are fraud risk factors. How many fraud risk factors are there? 3 fraud risk factors are there. This is important. Okay, these fraud risk factors are important. First one is incentive or pressure to commit fraud, opportunity to commit fraud, and rationalization of act. Okay, next, how to identify and assess risk of material misstatement due to fraud. Now, auditor, he has to identify. We have seen how the auditor will respond. Okay, he will first of all identify the risk of material misstatement due to fraud. So how the auditor will identify that in this area there will be a fraud? See, first of all, the auditor should have the professional skepticism. That means throughout the audit, whatever he is auditing, he needs to continuously question whether there can be fraud in this area, whether there can be fraud in this area, whether there can be fraud in this area. That means he has to have a professional skepticism. Whatever the area he is auditing, he needs to question whether fraud can be present in this area. Okay, this way he can identify risk of material misstatement due to fraud. That is, maintain professional skepticism. Next, discussion among engagement team. Okay, you have to discuss among your engagement team. Okay, they will share their experiences. They would have conducted the audit na? During the audit, whether they have found out any frauds, you will discuss with your engagement team. Okay, during that discussion, some frauds, the risk of frauds can come out in the entity. And next, risk assessment procedure and related activities. Okay, and you will also perform some other risk assessment procedures. What are that other risk assessment procedures that you will perform? You will inquire with the management and those charged with governance whether they have identified any frauds. See, inquiries of management, those charged with governance, and others within the entity. Okay, you have to inquire with them whether they have found out any frauds during the year. Because see, I have already told you this while discussing components of internal control system. We have the second component is entities risk assessment process. Okay, in SA 315 we have discussed entities risk assessment process. Entity will also perform risk assessment process. Just like auditor performs risk assessment process, entity will also perform risk assessment process. Why entity will perform risk assessment process? In order to design controls, entity will perform risk assessment process. So while you have performed your risk assessment process, whether you have identified any risks of fraud, okay, auditor should ask this to the management. So in these inquiries, auditor will do that. Okay, in the next slide we will see what inquiries auditor will make with management or those charged with governance. We will see that. Okay, whether they have assessed risk of material misstatement, what process or procedure they have followed. Okay, these aspects auditor will inquire with management and those charged with governance and others within the entity. Next, evaluate whether unusual or unexpected relationships indicate risk of material misstatement due to fraud. That is analytical procedure. Okay, you have to perform analytical procedure to identify whether there are any any doubtful relationships that will indicate risk of material misstatement due to fraud. Next, evaluate whether information obtained from other risk assessment procedure indicate fraud risk factors. Okay, apart from the risk assessment procedures that you perform with respect to the fraud, you would have performed risk assessment procedures in some other areas also. So in that other risk assessment procedures, whether you identify any risk of fraud, that also you need to evaluate. Next, whether other information obtained indicates fraud risk factors. Okay, apart from the financial information, you would have also obtained other information, right? As per SA 720, we have seen what is meant by other information. So while reading that other information, whether any risk of fraud you have identified, you have to see. Okay, these are the risk assessment procedures and related activities that you will perform in order to identify risk of material misstatement due to fraud. Sorry. Next, how the auditor will inquire with the management. We have seen in the previous slide itself, auditor will inquire with the management for identifying and assessing risk of material misstatement due to fraud. So how he will inquire, what matters he will inquire with the management. See, inquiries of management and others within the entity. See, auditor shall make inquiries regarding management's assessment of risk due to fraud. I have already told you. Okay, management will also conduct risk assessment. So whether they have conducted such risk assessment. If yes, management's process for identifying and responding to risk of fraud. Okay, what process management is following? You need to understand the process of management for identifying the risk due to fraud and responding to the risk due to fraud. Okay, mostly how the management will respond to the risk is they will respond by implementing and designing internal controls, right? Next, management's communication, if any, with those charged with governance. See, management during the risk assessment, if they find out any frauds, they will have to communicate with those charged with governance. Whether such communications have been made. See, those charged with governance regarding its process for identifying and responding to risk of fraud, or to employees regarding its views on business practices and ethical behavior. Okay, if the management has made any communications to employees and those charged with governance, what communications you have made, like this the auditor will inquire with the management. Okay, so these are the inquiries that the auditor will make with the management. Both previous slide and this slide are interlinked. Next, responses to assessed risk of material misstatement due to fraud. Now, auditor, by performing risk assessment procedures, he has identified risk of material misstatement due to fraud. After identifying risk of material misstatement due to fraud, what is the next step? Designing responses to that risk of fraud. So what responses the auditor will design? See, assign and supervise additional personnel to high risk areas. See, if there is a high risk of fraud in a particular area, the first thing that the auditor has to do is he has to be careful in that area. He has to allocate more time to that area. He has to allocate more staff who are more qualified to that area. So that is what he has done. Okay, that is the first response of the auditor with respect to area where there is a high risk of material misstatement due to fraud. Next, evaluate whether the selection and application of accounting policies by the entity may be indicative of fraudulent financial reporting. Now, while basically accounting policies will be selected by whom? Management, right? So while selecting, the auditor has to see whether selection of accounting policies is in such a way that it is indicative of fraudulent financial reporting. Okay, you have to see that. Next, design and perform further audit procedures whose nature, timing, extent or response to assess the risk of material misstatement. Okay, you have to design and perform audit procedures as a response to that assessed risk of material misstatement due to fraud at the assertion level. Next, incorporate unpredictability in the selection of the nature, timing, extent of audit procedure. Okay, you have to incorporate unpredictability. Okay, your audit procedures should not be in such a way that they could be easily predicted by the employees or the management. Okay, you should incorporate unpredictability. Okay, the management and employees should not know when you will verify, what you will verify, how you will verify. Okay, completely it should be unpredictable. Next, management override of control. See, if auditor feels that there is a risk of management to override of controls. See, basically management is in such a position that they can override the controls, because in the entity, who will implement the controls? Management will implement the controls. So they are having complete authority. So if they want, they can override, they can surpass those controls, they can keep those controls aside. So management is in such a position that they can override the controls and commit the fraud. So if auditor feels or auditor has identified risk of management override of controls, then what responses auditor will design for that risk related to management override of control? First of all, he will test appropriateness of journal entries. Okay, in the fraudulent financial reporting, most of the cases, the fraudulent financial reporting can take place by way of passing fictitious journal entries, that means fake journal entries. So firstly, if the auditor has got a doubt with respect to management override of controls, what he will do is he will clearly verify the journal entries, whether all the journal entries are true or not. Next, review accounting estimates for biases. Next area where management can commit fraud is estimates. See, these estimates, they will involve subjective decision of the management, right? Let's say, for example, fixed asset, the actual useful life of the fixed asset is 10 years, but for quickly charging the depreciation, management can estimate that we will use this fixed asset in 2 years only. This is our estimate, because our factory will run for 24 hours. Due to such a constant use of that fixed asset, it will become obsolete soon. In 2 years only it will become obsolete. So this decision is a subjective decision, right? So there is a possibility that management can commit fraud in these estimates, because estimates are subjective decisions. So next, auditor will verify whether accounting estimates that the management has made, whether they are appropriate or not, or whether management has shown any biasedness in making these estimates. And finally, evaluate business rationale of transactions outside the normal course of business. Business rationale means, what is the business rationale? The business rationale is to make profits, right? Always business will be conducted to earn profits. So if the management has entered into any transaction outside the normal course of business, the auditor has to check business rationale behind that transaction. Business rationale means the purpose, okay, the intention of the management behind entering into the transaction. If it is a proper intention, if the intention is to make profits to the entity, then it is okay. But if the intention is to commit a fraud, then auditor needs to report it in the audit report. Okay, so these are the responses of the auditor if there is any risk related to management override of controls. Okay, what he will see, first of all he will see journal entries, then accounting estimates, then with respect to unusual transactions, whether you will evaluate the business rationale of unusual transactions outside the normal course of business. Next, auditor unable to continue the engagement. See, the misstatements due to fraud are in such a way that auditor is not able to continue the engagement. Even if he continues the engagement, he has to give disclaimer of opinion only. Okay, instead of giving disclaimer of opinion, let me withdraw from the engagement, like this the auditor is thinking. Okay, the frauds are to such an extent that the misstatements due to the fraud are very much severe. Okay, they are such severe that auditor wants to withdraw from the engagement. In this situation, before withdrawal, auditor has to determine whether there is any professional and legal responsibility on him to report the same to the appointing authority, that he is resigning from the audit because of so and so reasons. Okay, whether there is any such responsibility on him, that he has to see. Okay, before withdrawal. Next, Consider whether it is appropriate to withdraw from engagement. If yes, appropriate to withdraw from the engagement, basically sometimes what happens is law and regulation will not allow the auditor to withdraw from the engagement. For example, in case of listed entities, the SEBI regulations says that if the auditor has conducted the audit of first 3 quarters, basically not audit, review, okay, the limited review, basically in case of listed entity there is this concept of limited review, right? So if the auditor has conducted limited review of first 3 quarters, then if he wants to resign, he must give limited review report of 4th quarter and also the audit report of entire financial year. Only after that he can resign. So like this, there will be some responsibility on the auditor as per some law or regulation. He cannot just like that withdraw, right? So in that situation, he needs to consider whether it is appropriate for him to withdraw. If he feels that yes, it is appropriate to withdraw, discuss the reasons for his withdrawal with management and those charged with governance, and determine professional and legal responsibility to report the same to appointing person or any authority. Okay, so if he wants to withdraw, he needs to do this. Next, management representations. Auditor shall obtain written representation from management and those charged with governance. What written representations the auditor has to obtain? See, they acknowledge their responsibility for design, implementation and maintenance of internal control to prevent and detect fraud. See, it is the responsibility of the management to implement and design internal controls. You already know that. Auditor has to obtain a written representation from the management stating that it is responsibility of the management for such designing and implementation of internal control. Okay, that is the first written representation that the auditor has to obtain. Next, they have disclosed to the auditor results of management risk assessment of fraud. Okay, you should also obtain a written representation from the management stating that management have disclosed all the results of management's risk assessment and also their knowledge of fraud or suspected fraud affecting entity or financial statements. Okay, management have also disclosed their knowledge of all the frauds that will affect the financial statements. Okay, with respect to these aspects, auditor has to obtain written representation from the management. And next, finally, there is provision with respect to reporting. What is this? Let me tell you. Now, basically, as per Companies Act 2013, section number 143, subsection 12, during the audit, if auditor identifies any fraud on the company by employees or officers and the amount involved in that fraud is 1 crore or more, then the auditor has to immediately report the same to central government. If the amount involved in the fraud is less than 1 crore rupees, then the auditor has to report it immediately to audit committee. If audit committee is not there, to board of directors. Okay, this is the reporting responsibility with respect to fraud as per section number 140 subsection 12 of Companies Act. Next, coming to reporting responsibility as per Caro clause 11. Now, as per clause 11 of Caro, if auditor identifies any fraud on the company or by the company, okay, on employees or its officers, then auditor in his Caro report, he needs to report the nature of that fraud and the amount involved in that fraud and the people involved in that fraud if it is known to the auditor. Okay, so this is reporting responsibility with respect to fraud as per section 140 subsection 12 and also as per Caro. Okay, basically the difference is in section 140 subsection 12 only fraud on the company is reported, whereas in Caro fraud on the company as well as by the company will be reported. Okay, yes. So by this we have completed essay 240, right? Now I'll open the PPT related to essay 250. Okay, auditor's responsibility with respect to laws and regulations. Let me open the PPT. Yeah, now moving to next standard, which is essay 250. This essay 250 it deals with consideration of various laws and regulations. Basically, the responsibility of the
auditor with respect to various laws and regulations during the audit. See, SA 250. What happened? Yeah. SA 250, consideration of laws and regulations in an audit of financial statements. See, this is standard. SA 250 is applicable only with respect to audit of financial statements. Okay, if auditor is conducting audit of financial statements, during that audit, if any laws or and regulations are applicable, then how the auditor has to deal with them. Okay, only for this situation SA 250 is applicable. Let's say, for example, auditor has been exclusively appointed to verify the compliance of particular law or regulation. Like say, for example, Income Tax Act. Okay, auditor has been appointed to verify compliance with Income Tax Act. Okay, that is what we will call it as a tax audit. For that tax audit, SA 250 is not applicable. Okay, or GST audit, SA 250 is not applicable. See, I have given that point as note. This standard does not apply to engagements in which auditor is specifically engaged to test and report separately on compliance with a specific law or regulation. Okay, if auditor is conducting audit of historical financial statements, then during that audit, with respect to compliance with other laws and regulation, SA 250 is applicable. If the auditor has been specifically appointed to verify compliance with certain other laws or regulation like Income Tax Act or GST Act, then for that particular engagement, SA 250 is not applicable. Hope this is clear. Now, as per SA 250, there are two types of laws. Okay, types of laws. There are two types of laws. What are they? Laws that are having direct effect on the financial statements and other laws. Now, what is meant by laws that are having a direct effect on financial statements? Okay, these are those laws if the entity complies with these laws, then it will affect the financial statements. In the same way, if entity doesn't comply with these laws also, it will affect the financial statements. Okay, those types of laws are known as laws having direct effect on the financial statements. Okay, again, what are the laws that are having direct effect on financial statements? Okay, how to determine whether a law is having direct effect on financial statements? Okay, if compliance with that law affects the financial statements or non-compliance with that law also affects the financial statements, then you can say that that particular law is having direct effect on the financial statements. And other laws means if entity complies with that law, then there will not be any effect on financial statements. If entity doesn't comply with that law, then there will be effect on the financial statements. Let us understand this with an example. Let's say, for example, Income Tax Act. If entity complies with the Income Tax Act for calculating provision of income provision for income tax, then compliance of Income Tax Act is affecting the financial statements because it is affecting one particular figure which is provision for income tax. In the same way, if entity doesn't comply with Income Tax Act, then provision for income tax figure will get affected. So if entity doesn't comply with Income Tax Act, then also financial statements are affecting. So you can call Income Tax Act as a law that is having direct effect on financial statements. Hope that is clear. Now, example for other laws. Let's take, for example, Child Labor Act. Okay, Prevention of Child Labor Act. If entity complies with Prevention of Child Labor Act, that means entity has not employed any minors as laborers. In such a situation, it will not affect financial statements, right? How will it affect financial statements? Okay, whether entity is appointing a minor child, sorry, if entity doesn't appoint a minor child, how will it affect financial statements? It will not affect financial statements. So compliance with Prevention of Child Labor Act will not affect financial statements. Now let's say if entity doesn't comply with this particular
law, that is Prevention of Child Labor Act. That means entity has appointed child labor. In such a situation, if any authority, any officer identifies this, then he will impose penalty on the entity. So if entity pays the penalty, then it will affect financial statements, right? Cash is going out, that means expense is being incurred in the form of penalty. So non-compliance with Child Labor Act will affect the financial statements, whereas compliance with Child Labor Act will not affect the financial statements. So Child Labor Act is a other law. Hope that is clear. So you have to check like this. Okay, in order to determine whether a law is having direct effect on the financial statements or not, you have to check if compliance with that law affects the financial statements and non-compliance with that law also affects the financial statements, then it is a law having direct effect on financial statements. If non-compliance only affects the financial statements, compliance will not affect the financial statements, then it becomes other law. Okay, the same I have given here. See, laws having direct effect on financial statements. If complied with that law, it will affect financial statements. If doesn't comply with that law, it will affect financial statements. That is law having direct effect. Next, other laws. If complied, it doesn't affect financial statements. If doesn't complied, then it will affect financial statements. Okay, these are the two types of laws. Next, objectives of auditor. Now, what is the objective of the auditor with respect to this standard? Basically, auditor is having different types of objective for these two different types of laws. Okay, let's see. First of all, auditor needs to obtain sufficient appropriate audit evidence regarding compliance with laws and regulations having direct effect on financial statements. Okay, with respect to laws that are having direct effect on financial statements, auditor has to obtain sufficient and appropriate audit evidence that entity has complied with that law. Okay, auditor has to obtain evidence that entity complied with that law with respect to laws that are having direct effect on financial statements. Now, with respect to other laws, auditor need not obtain audit evidence regarding compliance of the law, but auditor needs to check whether there are any non-compliances. Okay, see, there is a difference. With respect to other laws, auditor need not check for the compliance. He needs to check whether there are any instances of non-compliances, because only if entity has not complied with the other law, the financial statements will be affected. So auditor needs to check whether entity has not complied with that law. The auditor need not check for compliance. Okay, auditor need not force the entity for compliance. Instead, auditor has to just check whether there are any non-compliances of that other law. See, that you will see here. Perform specific audit procedures to identify instances of non-compliance with other laws and regulations. Okay, with respect to laws having direct effect on financial statements, auditor has to obtain audit evidence regarding compliance of that law. Whereas with respect to other laws, auditor has to check for instances of non-compliances. Okay. Next, respond appropriately to instances of non-compliance. Okay, once you have identified instances of a non-compliance, you have to respond appropriately. Basically, how you will respond? In our example, Child Labor Act. Entity has not complied with Child Labor Act. That means entity has employed child labor. If entity employs child labor, then penalty will be imposed on the entity. So auditor should ask the entity to provide provision for the penalty. Okay, see, auditor need not ask the entity to remove the child labor. It is none of the business of the auditor to ensure that entity complies with other laws. No, auditor will just ask to provide for provision for the penalty that the entity has to pay. Okay, whereas in case of Income Tax Act, if the entity has not complied with Income Tax Act, then auditor should ask the entity to comply with Income Tax Act. Okay, auditor should force the entity to calculate provision for income tax as per the Income Tax Act. Okay, that is the difference between these two laws. Next, Management responsibility for compliance with laws and regulation. Obviously, it is responsibility of management to comply with laws and regulation. So how management has to discharge this responsibility? Management, it has to maintain a register of laws and regulations that are applicable to it, and it needs to comply with those laws. So maintaining register of all significant laws that are applicable to it. Next, while designing operating procedures, management has to design its operating procedures in such a way that automatically it will comply with those laws and regulations. See, design operating procedures to meet requirement of laws. Next, engage legal advisors. Okay, entity has to appoint legal advisors to advise the entity with respect to compliance with various laws and regulations. Next, appropriate system of internal controls. Okay, entity has to establish appropriate internal controls to ensure that it will comply with all laws and regulation. Next, it has to develop and publicize code of conduct. Basically, code of conduct will contain rules and regulations regarding how the employees have to behave so that they will comply with laws and regulation. Okay, the entity has to develop and publicize the code of conduct. Next, train employees to properly understand the code of conduct. See, just developing the code of conduct is not sufficient. The code of conduct has to be followed by the employees. If the employees has to follow the code of conduct, they have to understand the code of conduct. So you should train the employees with respect to code of conduct. And monitoring compliance with code of conduct, you have to check whether the code of conduct is being properly followed by all the employees or not. If anyone is not following, you have to take appropriate actions. Okay, that is responsibility of management with respect to compliance with laws and regulations. Next, what is the responsibility of auditor with respect to compliance with laws and regulations? The same responsibility that I have told you earlier. See, first of all, auditor needs to understand legal and regulatory framework, and with respect to laws and regulations that are having direct effect on the financial statements, auditor needs to obtain sufficient appropriate audit evidence that entity has complied with those laws and regulations. See, laws and regulations having direct effect, obtain sufficient appropriate audit evidence regarding compliance. And with respect to laws and regulations, with respect to other laws, auditor has to identify the instances of non-compliance. See, with respect to other laws, perform specific procedure to help identify instances of non-compliance, and auditor needs to perform some specified audit procedures such as inquiry with management, and where appropriate with those charged with governance, correspondence with the licensing or a regulatory authority. Still, there are some more responsibilities of auditor. Remain alert to possibility that other audit procedures applied may bring instances of non-compliance. During the audit, throughout the audit, while verifying each and every item, auditor should be alert to identify the instances of non-compliances of any law or regulation. Just like during the entire audit, auditor will be very alert to identify instances of fraud. In SA 240 we have discussed, auditor should maintain professional skepticism throughout the audit to identify areas of fraud, right? The risk of material misstatement due to fraud. Just like that, here also in SA 250, auditor has to maintain professional skepticism throughout the audit to identify the instances of non-compliance with laws and regulations. Okay, next, request management and where appropriate those charged with governance written representation that all known instances of non-compliances have been disclosed to the auditor. Okay, you have to get a written representation from the management that all the known instances of non-compliances by the management. Okay, see, management will be with the entity for 24/7, so management will know what laws and regulations have been not complied by the entity. So it becomes a duty of the management to communicate to the auditor that these laws have been not complied by the entity, right? So auditor has to obtain written representation from the management stating that the management has made all that communications to the auditor. Okay, all known instances of non-compliances have been communicated to the auditor. Okay, these are the responsibilities of the auditor with respect to laws and regulations. Next, indications of non-compliance with laws and regulations. See, if any of these situations are present, then there might be chance of non-compliance with law or regulation. What are they? Let's see. See, this is a very important question. Okay, even from the examination point of view, this is very important. Investigations by regulatory organization. Okay, if auditor finds that regulatory organizations like ED, Enforcement Directorate, or SFIO, Serious Fraud Investigation Office, or any other authority is conducting investigations against the entity. In such a situation, there is a high chance that entity might not have complied with law or regulation. Next, payment for unspecified services. Okay, entity is making some payments for unspecified services. Okay, entity is not disclosing for which service they are making the payment. Even in such a situation also, there is a possibility for a non-compliance with law or regulation. Next, unusual transactions with companies in tax havens like Cuba. Cuba is a tax haven where you need not pay the tax. So if you are entering into unusual transaction with entities registered in tax havens, then there is a chance of non-compliance with law or regulation. Next, purchasing at significantly above or below market price. Okay, you are purchasing some of the raw material at significantly below the market price. Okay, in the market you are getting that product at 50 rupees per kg, but you are purchasing that product at just 10 rupees per kg. Then there is a chance that there might be non-compliance. Okay, you might have evaded some of the duties, or something might have been wrong, because of which you are getting that product at lesser price, right? Next, payments without proper exchange control documentation, like foreign exchange. Okay, if you are making payments to entities registered outside the country, there should be proper foreign exchange documentation that has to be done. Okay, if you are making the payments without proper exchange documentation, then also there is a possibility of non-compliance with law or regulation. Next, you are having FEMA, Foreign Exchange Management Act, with respect to this. In SPOM Setia, we have discussed this chapter. Next, unusual payments towards legal and retainership fees. Okay, if you are making any unusual payments towards legal and retainership fees, then also there is possibility of non-compliance with laws and regulations. See, why will you pay to lawyers and advocates? Since you have not complied with any law or regulation, and to protect you from such non-compliance, you are making payment to law, to advocate or lawyer, right? Next, excessive sales commissions, you are giving more sales commission. Unusual payment in cash, adverse media comments, unauthorized or improperly recorded transaction, payment for goods or services made other than to the country from which they are originated. Okay, all these are the indications or instances of non-compliance with law or regulation. Okay, the existence of any of these situation will indicate that there might be non-compliance with any of the law or regulation. Okay, next, audit procedure when non-compliance is identified. See, if auditor identifies any non-compliance, then first of all, auditor has to understand the nature of act and circumstances in which it has occurred. Okay, what is the nature of act? Okay, whether it is a law that is having direct effect on the financial statements, or it is other law. Okay, and in which circumstance it has not been complied, you need to understand this. Next, obtain further information to evaluate possible effect on the financial statement. You have to obtain information to see what effect this non-compliance will have on the financial statements. Next, discuss the matter with management and those charged with governance. Okay, next you have to discuss with management. We found that this particular law is not complied by you. What is the reason? Provide some information, provide reasons why you have not complied. If management do not provide any information that they are in compliance with law and regulation, and in auditor's judgment effect of suspected non-compliance may be material, then consider need to obtain legal advice. Okay, if management is not providing any information with respect to the compliance of law, and auditor feels that such a compliance is very material, such non-compliance is very material, then auditor should consider consulting a advocate or a legal advisor, okay, to analyze this situation. And if even after consulting also, evaluate implications of non-compliance on other aspects of audit. And if auditor is not able to obtain sufficient or appropriate audit evidence with respect to suspected non-compliance, then he needs to consider his effect on the opinion. Okay, whether he has to provide a modified opinion. Okay, auditor needs to check this. So this is how auditor will react if there is any non-compliance that has been identified. Next, reporting suspected non-compliance. Okay, suspected non-compliance. If auditor suspects any non-compliance, then auditor has to report it to those charged with governance. when first of all auditor has to communicate it to management. If management is not responding, then communicate to those charged with governance. If those charged with governance is also not responding, then communicate to some higher authority. If higher authority is not there, then you will take legal advice. See, report to those charged with governance. If management or those charged with governance involved in non-compliance, report to next high level authority. If next high level authority is not there, okay, if does not exist, consider need to obtain legal advice. Next, reporting in auditor's report. See, if you have concluded that non-compliance is material and no adequate disclosure is made in the financial statements. See, you concluded that non-compliance with law or regulation is material. That means you are having a evidence. Only based on evidence you will conclude, and you found out that it is very much material for the financial statements, that non-compliance is very much material. So in this situation, you will give either qualified or adverse based on pervasiveness of the matter, but you cannot give disclaimer. So qualified opinion or adverse opinion if precluded by management to obtain sufficient appropriate audit evidence. See, you suspected that there is a non-compliance with law or regulation, but management is not allowing you to gather audit evidence. In such a situation, you are not having evidence, but you feel that it might be material or it might be pervasive, that non-compliance. So in this situation, you will give either qualified or disclaimer. You cannot give adverse, because you can give adverse only if there is audit evidence. Okay, so qualified or disclaimer of opinion. Next, determine whether there is any responsibility to report non-compliance to third parties. Okay, you have to check whether there is any responsibility to report this non-compliance of law or law or regulation to third party. Third party means government or the authority. In case of non-compliance with LODR regulations, you will have to report to SEBI. Like this, whether there is any responsibility to report to third parties, you should also check this. Okay, so these are the reporting responsibilities of the auditor with respect to non-compliance with laws and regulations. By this, we have completed a revision of SA 250. Now we will move to revision of SA 299. Let me open the chart, sorry, the PPT of 299. Moving to SA 299, joint audit of financial statements. A very easy standard basically. Yeah, SA 299, joint audit of financial statements. Now, what is meant by joint audit? If two or more auditors are appointed to audit single entity, then those auditors will be known as joint auditors, and such an audit is known as joint audit. Okay, see, a joint audit is an audit of financial statements of an entity by two or more auditors. In our example, CA Ram and CA Bhim has been appointed to audit one entity. So they will become joint auditors, and that audit is known as joint audit. Now, you should not confuse joint auditors with component auditor and principal auditor. Let's say, for example, the parent entity is audited by one auditor and subsidiary is audited by some other auditor. Now, you cannot call these two auditors as joint auditors, because the auditor of parent entity will be known as principal auditor and the auditor of the subsidiary will be known as component auditor. Okay, this relation of principal auditor and component auditor will be dealt by SA 600 using the work of other auditor. Okay. Next, audit planning and risk assessment. In case of joint audit, who will do audit planning and who will perform risk assessment? The joint auditors together will plan the audit. See, who will develop audit strategy and audit plan in case of joint audit? All joint auditors together will develop audit strategy and audit planning. Now, who will be involved in such a development process? See, who will be involved? Engagement partner and other key members of the engagement team will be involved in developing audit plan and audit strategy. Next, in planning the audit, what has to be considered? Let's see. In planning the audit of joint in planning the joint audit, the joint auditors shall ascertain reporting objectives of the engagement. Okay, what are the reporting objectives of the engagement? Whether there is CARO reporting, whether there is internal whether there is ICFR reporting. Okay, whether reporting has to be done as per section 143. So what are the reporting objectives of this joint audit? You need to ascertain. Next, consider factors significant in directing the engagement team efforts. Okay, in which area the efforts of the engagement team has to be directed. Okay, which factors are significant, which items are significant, that needs to be considered. Next, consider knowledge gained in other engagements. Okay, while planning the joint audit, you should also consider the knowledge that you have gained in other engagements. Next, ascertain nature, timing, extent of resources. Next, division of audit areas and common audit areas. Okay, basically whenever joint auditors are appointed, they will divide the work among themselves. See, the joint auditors are appointed in order to save the time. In case of large entities, if single auditor only audits the entire entity, it will take a lot of time. So in order to reduce the time, joint auditors will be appointed so that they can divide the work among themselves. So division of audit work has to be done, and which areas will be common responsibility of both the joint auditors, even that has to be discussed, that has to be considered while planning the audit. Division of work can be done on the following basis: on a mutual discussion. Okay, mutual discussion among the joint auditors. Okay, by mutual discussion among the joint auditors, they can divide the work among themselves, or the division of work can also be done on identifiable units basis, or asset or liability or income or expenditure basis. Okay, they can say that, the joint auditors can say that assets will be audited by the first auditor, liabilities will be audited by second auditor, income will be audited by first auditor, expenditure will be audited by second auditor. Okay, like this identifiable unit wise, they can bifurcate the work or divide the work, or they can say that first two branches will be audited by one auditor, next two branches will be audited by another auditor. Okay, like this also they can divide the work among themselves. Okay, so while preparing the audit plan, they should consider which areas are the common responsibility, which areas are individual responsibility. Okay, what are the division of work has to be considered. Next, work allocation document shall be signed by all the joint auditors. See, this is very important. The work allocation document, you have divided the work among you, na? So you have to document that division of work, and it has to be signed by all the joint auditors. This is very important in order to prevent disputes in future, and you should also communicate this division of work to management also, so that management will also have a clarity regarding which area will be audited by which auditor. Okay, next, responsibility of joint auditors. See, in case of works that are divided, only that respective individual joint auditor will be responsible for that work which is divided. In case of common areas, all the joint auditors jointly will be responsible. Okay, see, joint responsibility, individual responsibility. Individual responsibility only for the work allocated to each joint auditor. Okay, if branch 1 and branch 2 is allocated to joint auditor 1, then he is responsible only for those two branches audit. Okay, and joint responsibility in case of work that is not divided among themselves. Okay, in case of common areas, the auditors will be jointly liable. Next, all joint auditors jointly and severally responsible for, so what are the common areas? Okay, for which areas all the joint auditors will have the responsibility. That means in that area, if there is any misstatement and you have not identified that misstatement, then you will be responsible. Okay, so for which areas all the joint auditors will be responsible? Okay, commonly, see, work not divided among joint auditors. If work is not divided among the joint auditors, then obviously all the joint auditors will be responsible for that work. Let's say, for example, joint auditors have decided not to divide the work related to assets. That means assets will be audited by both the joint auditors. Since it is not divided, it is common area, all the joint auditors will be jointly and severally responsible for that area, since it is not divided. Simple, right? Next, decisions taken by all joint auditors in respect of common audit areas. Okay, in respect of common audit areas, if all the joint auditors have taken the decision together, then all the joint auditors will be responsible. Next, matters which are brought to the notice of the joint auditor. Now, income is assigned to Mr. A, one of the joint auditor. Expense is assigned to another joint auditor, Mr. B. Now, Mr. B, while auditing expenses, he is having doubt with respect to one particular area. So, he wanted opinion of Mr. A for that particular area. So, Mr. B approached Mr. A with respect to opinion on particular area in expense. Now here, for that area, since Mr. B approached Mr. A and both Mr. A and Mr. B have commonly by discussion among themselves decided, for that area both will be responsible, even though the work of expense is allotted to Mr. B. With respect to one particular item of expense, Mr. B has approached Mr. A and they both have discussed and arrived at a common decision. Therefore, both joint auditors will be responsible for such area. Okay, see, now you will understand. Matters which are brought to the notice of joint auditor. Next, examining that the financial statements comply with the requirements of relevant statute. Okay, whether the financial statements comply with the requirement of relevant laws and regulation. This is joint responsibility of all the auditors. You cannot divide this responsibility to check whether financial statements have been prepared as per law and regulation. Okay, this responsibility is with all the auditors. Next, presentation and disclosure as required by applicable financial reporting framework. This responsibility also. Okay, whether financial statements have been presented and disclosed as per the requirement of applicable financial reporting framework or not. This has to be checked by all the joint auditors. Next, this one also, ensuring that audit report complies with the requirements of relevant statutes. Okay, it is responsibility of the all joint auditors to ensure that audit report that they give will comply with auditing standards and all other relevant statutes. Okay, you cannot divide that responsibility with respect to audit report or with respect to compliance of financial statements with laws and regulation, or with respect to presentation and disclosure of financial statements as per applicable financial reporting framework. Okay, these three are in such a way that you cannot divide the responsibility. Okay, for these three, all the joint auditors are together responsible. Okay, next, some important points. Whether where a joint auditor comes across matter which are relevant to the areas of responsibility of other joint auditors, said joint auditor shall communicate the same to other joint auditors. Yeah, simple. Now, the same example, Mr. A is allocated income, Mr. B is allocated expense. Now, Mr. B is allocated expense. Now, while auditing expenses, he came across certain matters which are related to the income. Now, Mr. B has communicated those matters to Mr. A because he has came across certain matters which are relevant to the area that is allotted to Mr. A. Okay, hope this is clear. Next, joint auditor shall obtain common engagement letter and a common management representation letter. This is also important point. Okay, you need not take two engagement letters from the management. Since it is a joint audit, you can take single engagement letter, common engagement letter and common written representations from the management. Next, reporting in case of joint audit. See, if all the joint auditors have arrived at same opinion, then you can give single audit report. See, no disagreement among the joint auditors, then you can give issue common audit report, single audit report. If at all there is disagreement among the joint auditors, okay, one joint auditor says that I will give qualified opinion, other joint auditor says that I will give unmodified opinion. Now there is disagreement. If at all there is a disagreement, then you can give separate audit reports. Okay, in your audit report, Mr. A, in his audit report he can give qualified report, a qualified opinion, and Mr. B in his audit report he can give unmodified opinion. But Mr. B in his report he has to say that there is another joint auditor, in that joint auditor's report he has given qualified opinion. Okay, such reference has to be made. In the same way, Mr. A also in his audit report he has to mention that there is another joint auditor, Mr. B, in his audit report he has mentioned unmodified opinion. Okay, that reference has to be made. That reference obviously it will be made in other matter paragraph. Okay. If there is disagreement among joint auditors, then shall express their opinion in a separate audit report, and also make reference to separate audit report issued by other joint auditors. Such reference will be made in other matter paragraph. Another important point, a joint auditor is not bound by the views of majority of joint auditors. Okay, you need not get bound yourself to the views of majority joint auditors. Let's say there are 4 joint auditors. Of these 4 joint auditors, 3 joint auditors wanted to give qualified opinion, but one auditor wanted to give unmodified opinion. Now in this situation, this one auditor need not feel that since majority of auditors are giving qualified opinion, let me also give qualified opinion. No, you are not bound by the views of majority of auditors. Hope that is clear. Okay, by this revision of essay 299 also gets completed. Now we will discuss the last standard, that is essay 402. Let me open the PPT of 402. Now moving to next standard, which is essay 402. Now in this 400 series there are basically 2 standards. One is essay 450, which we have discussed while discussing 300 series. Now we'll discuss, now we'll revise essay 402, which deals with considerations of user auditor while using the services of service organization. Now what is this service organization? What is a user entity? All these terms we will discuss. Essay 402, which is audit considerations relating to entity using service organization. Now before starting the standard, we will first of all understand the context of the standard. See, understanding context of essay 402. Let's say there is an entity. Okay, now this entity has outsourced one of its activity, let's say payroll activity. That means activity with respect to calculation of salaries, calculation of PF, ESI, all employee benefits, tax deductions, and disbursal of salaries. Okay, all these activities with respect to payroll has been outsourced to a particular organization. Now we will call this first entity as user entity and the second entity as service organization or SO. Why? Because user entity is using the services of service organization, so we call that entity as user entity and this entity as service organization. Now for this user entity there will be a auditor, we call him as user auditor. Now this user auditor will audit financial statements of user entity. While auditing financial statements of a user entity, in the financial statements there will be salaries and various other expenditure related to employees. Now the user auditor, before auditing those items, he will have to verify controls around processing of those items, right? But in this situation, user entity is using the services of service organization. That means these transactions are being processed by service organization at the location of service organization. right? So here user entity cannot access controls over payroll activities in the user entity. Instead, user auditor has to visit the service organization to check the controls at the service organization, right? Now, just like service organization is providing service to the user entity, it will be providing these type of services to various other user entities. Okay, now if all the user auditors comes to service organization for verifying controls at service organization, it will not be possible for service organization to facilitate all the user auditors, right? So what service organization will do is, see, the user auditor need to understand controls or payroll activity. For that, he needs to visit service organization, but service organization cannot facilitate all the auditors. So service auditor will appoint service organization will appoint service auditor. Now what this service auditor will do is, he will audit the controls at service organization. Okay, this is service auditor. He will specifically audit controls at service organization, and this service auditor will give his report to user auditor. Okay, this report will be either type 1 report or type 2 report. We will discuss what is type 1 report, what is type 2 report, what are the differences between these two reports. But type 1 report and type 2 report, both reports are given by service auditor and both deals with controls at service organization. Okay, now with the help of this type 1 report or type 2 report, user auditor will understand the controls that are present at the service organization. Okay, now this is the context in which we are discussing SA 402. Now when user auditor uses this type 1 report or type 2 report, and when user entity uses services of service organization, what considerations has to be taken by user auditor? This is what we are going to discuss in this standard essay 402. Hope you understood this. Now, objectives of user auditor. What are the objectives of user auditor? Obtain understanding of nature and significance of services provided by service organization. Okay, what type of service the service organization is providing, and what is the importance of that service to the user entity, and their effect on the user entity's internal control to identify and assess risk of material misstatement. Next, design and perform audit procedures responsive to that risk. This is the objective of user auditor. If you see, user auditor is concerned with only those service organizations that provide services relevant to audit of user entities' financial statements. Now if you see, the user entity, it will outsource various activities. Okay, not only payroll activities. Let's say user entity has also outsourced manufacturing activity. Now this manufacturing activity, it doesn't have effect on the financial statements. Okay, it doesn't impact calculation of figures in the financial statements. So user auditor is not concerned with those type of outsourced activities which does not have effect on the financial statements. Okay, user auditor is only concerned with those service organizations that provide services relevant to audit of user entities' financial statements. Hope that is clear. Now, when are services provided by service organization are relevant to audit of user entities' financial statements? Okay, you told that user auditor is concerned only with those service organizations that provide services that affect the financial statements. Now, when will you consider that services provided by service organization are affecting the financial statements? Following are the situations. See, if the services provided by service organization affects any class of transactions in the user entity's operations, then you will say that the service organization's services are, affecting the financial statements. Next, another situation. Procedures See, the service organization services affects the procedures by which the user entities transactions are initiated, recorded, processed, corrected and reported in the financial statements. Okay, if service organizations services affects any of this activity of the user entity, then also it will be treated that service organizations services are affecting the financial statements. Okay, they are relevant for the purpose of user entities auditor. Next, another situation, related accounting records. Okay, those services will affect related accounting records, and the services will affect how information system captures events and conditions other than transaction. Okay, if the services provided by service organization affects any of these activities at the user entity, then it will be deemed that those services are relevant to the financial reporting of the user entity, and user auditor is concerned with only those types of service organizations. Next, if it will affect financial reporting process. Understanding services provided by service organization. Okay, while understanding user entity as per SA 315, the user auditor shall obtain understanding of how user entity uses services of service organization. Now, the user auditor, see, by now you should be clear with these terminologies: user auditor, user entity, service auditor, service entity. Okay, the services, with all these terminologies you should be familiar. Only then you can understand this discussion or this revision. Okay, now user auditor, while conducting audit of a user entity, generally he will obtain understanding of the entity and its environment as per SA 315, right? So in that understanding, user auditor should also obtain understanding of the services that are provided by service organization. So how he will understand, including nature and significance of services provided by service organization. Okay, what is the nature of services provided by service organization and how important those services are to the user entity. Next, you should also understand nature and materiality of transactions processed by the service organization. See, all these are easily understandable. Degree of interaction between the activities of service organization and those of the user entity. Okay, how much amount of interaction is there between user entity and the service organization. And finally, you should understand nature of the relationship between user entity and service organization. Okay, what is the nature of relationship? Whether user entity has a hired service organization or user entity has given contract to the service organization. What type of relationship is there between a user entity and a service organization, or service organization is a subsidiary of the user entity? Okay, what is the relationship between user entity and service organization? You should also understand that relationship. Next, user auditor unable to obtain understanding. See, if user auditor is unable to obtain sufficient understanding about service organization from the user entity, the user auditor shall obtain that understanding from the following. See, the user auditor is not able to obtain understanding about the service organization, not able to obtain understanding of the services provided by the service organization. In that situation, how he should obtain understanding? He can obtain understanding by taking type 1 report or type 2 report from the service auditor. Okay, we will discuss what is type 1, type 2 report in the next slide. Okay, this is one of the way to understand services provided by service organization. Or the user auditor can contact service organization through the user entity. Okay, the user auditor, he can call the service organization and discuss with the service organization and obtain understanding of the services provided by service organization. However, this contact must be through the user entity. Next, visiting service organization and performing procedures. The user auditor, he himself can visit service organization and he himself can perform procedures at the service organization. Okay, if he is not able to obtain understanding of services provided by service organization, then he can do this. Or using another auditor to perform procedures. Okay, on his behalf he can appoint some other auditor to perform procedures at the service organization. Okay, if he is not able to obtain understanding of the services provided by the service organization by sitting at the user entity, he can do any of these activities. What are they? He can obtain type 1 or type 2 report. He can contact service organization through user entity, or he can directly visit service organization and perform procedures, or he can appoint some other person on his behalf to visit the service organization. Okay. Next, type 1 report and type 2 report. See, these are the audit reports on internal controls at service organization issued by a service auditor. This I have already discussed. Okay, service auditor will audit controls at service organization and he will issue this type 1 report or type 2 report. Both the reports are almost equal, but a slight difference is there. Okay, both are same with a slight difference. We'll see. Type 1 report. Report on design and description of controls at service organization. See, type 1 report contains only design and description of controls at service organization. It will consist of description of services, description of service organization system, control objectives and related controls designed and implemented at specified date. See, the type 1 report will be prepared at a specified date. Okay, so this description will be prepared by management. Okay, prepared by management. Okay, description of service organization's system including control objectives and related controls designed and implemented at a specified date. Okay, which will be prepared by management. Now this description of system which is prepared by management will be audited by the service auditor, and he will include opinion on the description of system and control objectives and related controls and their suitability to achieve the specified control objectives. Okay, this opinion on the service organization's system will be provided by whom? By service auditor. Okay, these both together will be known as type 1 report. Okay, type 1 report deals with design and description of controls at service organization, these two aspects. Now type 1 report includes description of service organization system including control objectives which is prepared by management, and also this type 1 report includes opinion on description of service organization system, control objectives and related controls and their suitability to achieve the control objectives. This opinion will be given by service auditor. Okay, these two, description of system and opinion on the system, together will be included in type 1 report. Hope that is clear. Now moving to type 2 report. Now type 2 report is also similar, but along with design and description of controls, operating effectiveness of controls will also be included in type 2 report. Okay, type 2 report will also speak about operating effectiveness of the controls. Okay, whether controls are operating effectively or not, even that aspect will be dealt by type 2 report. So now you can consider that type 2 report is more detailed when compared to type 1 report. Why? Because type 1 report doesn't speak about operating effectiveness of controls, whereas type 2 report speaks about operating effectiveness of controls. Operating effectiveness means whether controls are operating effectively or not, as intended or not. Okay, so similarly type 2 report consists of description of service organization system, control objectives and related controls designed and implemented at specified date, same as that of type 1 report, and also it will be prepared throughout a specified period and operating effectiveness throughout the specified period. Okay, operating effectiveness of controls will also be there in type 2 report, and it will be throughout a specified period, whereas type 1 report is as on a particular date, whereas type 2 report is throughout a specified period, and type 2 report also includes operating effectiveness. This description of a system, control objectives, operating effectives, it will be prepared by management. Now, on this description of a system, control objectives and operating effectiveness, service auditor will give opinion. The same will be there. Okay. Opinion on the description of service organization system, control objectives and related controls and their suitability to achieve the specified control objectives and their operating effectiveness also, which will be prepared by service auditor. Okay, these two together will be known as type 2 report. Now tell me which is more clear. Type 2 report is more clear. Which report the user auditor will prefer? He will prefer type 2 report, because type 2 report will also discuss about operating effectiveness of controls, right? Hope you understood. The major differences are type 1 report doesn't include operating effectiveness. Okay, opinion on operating effectiveness of controls, whereas type 2 report will include opinion on operating effectiveness of controls also. And also type 1 report will be prepared as on a particular date, whereas type 2 report will be prepared for a specific period. Okay. Next, using type 1 or type 2 report. If user auditor plans to use type 1 report or type 2 report as audit evidence, user auditor shall determine whether this report provides sufficient appropriate audit evidence about controls by evaluating whether description, design and operating effectiveness of controls is at a date or for a period. Okay, when user auditor uses type 1 report or type 2 report as a evidence on the controls at service organization, the user auditor has to verify whether these reports are providing opinion as on a date or for a period. That you have to see, that user auditor has to see. He should also determine whether complementary user entity controls identified by service organization are designed and implemented by user entity. If so, test their operating effectiveness. See, what is this? Complementary user entity controls. Now, first of all, why user entity is verifying controls at service organization? Because the user entity's data is sent to service organization, and that data is processed at service organization, and processed data is sent back to the user entity. So here data of user entity is present with service organization. In order to avoid leakage of the data, or in order to avoid misstatements in that processed data, controls are being kept at service organization, right? So the user auditor is verifying services at service, user auditor wants to verify controls at service organization. Now, okay, controls are there at service organization, but what if controls are not there at user organization? Because of lack of controls at user organization, if misstatements occurs in the data, what will happen, right? There is also this chance, right? Even though controls are there at service organization, misstatements could occur because of lack of controls at user organization. So in order to prevent that, service organization prescribes to implement certain controls at user organization also, in order to prevent misstatements. These controls which are prescribed by service organization to be implemented at user organization or user entity are known as complementary user entity controls. Hope you understood this. So the user auditor, before using type 1 report or type 2 report, he should also verify whether the complementary user entity controls have been implemented at the user entity or not. Next, evaluate whether report provides sufficient appropriate audit evidence for understanding internal controls. Okay, you have to see, okay, I am using type 1 report or type 2 report, whether this report is providing me sufficient appropriate audit evidence with respect to user entities, with respect to service organization's internal control or not. That you need to see. Okay, if auditor feels that type 1 report or type 2 report is not providing sufficient evidence with respect to service organization control, then what user auditor will do? As we discussed in the previous slide, he himself will visit the service organization, or he will appoint some other organization to audit the controls at service organization, or he will contact the service organization, right? This, any of these things he will do. Next, using type 2 report. See, if you wanted to use type 2 report, then the same things what you have verified previously, the same things you need to verify. See, evaluate whether description, design and operating effectiveness is at a date or for a period. Determine whether complementary user entity controls are there. Okay, first 2 points are same as that of type 1 report. The third point changes. Evaluate adequacy of time period covered by test of controls and time elapsed since their performance. See, if you see, type 2 report will contain opinion on operating effectiveness of controls. In order to verify operating effectiveness of controls, that means whether controls are working properly or not, in order to verify that, service auditor should have performed test of controls on the controls of the service organization. Now, the user auditor, before using type 2 report, he has to see whether test of controls that are that are performed on the service organization cover proper time period or not, and how much time has elapsed since the time test of controls have been performed, right? See, the user auditor is using type 2 report on 30 May 2025. Okay, but the test of controls have been performed by service auditor on 30 May 2024. That means 1 year has elapsed since the time test of controls have been performed. There is a possibility that the controls have changed, right? So you should also check how much time has elapsed since the time test of controls have been performed when you are using type 2 report. Okay. Evaluate whether results of test of controls performed by service auditor provide sufficient appropriate audit evidence or not. Okay, this point we will do even for type 1 report also. Okay, if you see, apart from these 3 points, this point also got added if you use type 2 report. Okay, if the user auditor use type 2 report, apart from these 3 points, you should also check this 4th point. Okay. Next, inclusive method and carve out method. What is this inclusive method and carve out method? See, in order to understand this inclusive method and carve out method, first of all you should understand subservice organization. What is this subservice organization? See, let me tell you. Now, user entity is outsourcing its activities to service organization. That means the activities of user entity will be performed by service organization. Now, if work at a service organization has become very high, very more, then service organization will also outsource some of activities to subservice organization, right? That means user entities activities are outsourced to service organization, and service organization indeed has outsourced the same to subservice organization. Now, if you see, the user auditor, he has to verify controls at service organization and also at subservice organization, because some of the activities of user entity are being done by subservice organization also, right? Now, carve-in method means the service auditor, he will audit controls of service organization and he will give type 1 report or type 2 report. Now, in this type 1 report or type 2 report, if service auditor also audits controls at subservice organization and includes his opinion on controls of subservice organization also in the type 1 or type 2 report, then you will call it as inclusive method, wherein you have included the opinion on controls at subservice organization also. Hope that is clear. If your type 1 report or type 2 report doesn't include the opinion on controls at subservice organization, then you call that as carve out method. Hope you understood. Okay, the same you will find here. Next, Reporting by user auditor. How the user auditor will report? See, if user auditor is unable to obtain sufficient appropriate audit evidence regarding services provided by service organization, then he will modify the user auditor opinion. Since he is not able to obtain sufficient audit evidence with respect to services provided by service organization, he will modify the auditor's opinion. Now, if he is modifying the auditor's opinion and that modification is because of, in order to understand the modification, it is required to refer to the service organization or service auditor's report, then user auditor can refer to the service auditor's report in his audit report. See, if reference to service auditor's work is necessary to understand the modification, then indicate that such reference does not diminish the user entity's responsibility. Okay, user auditor's responsibility. See, user auditor has modified his opinion because he is not able to obtain sufficient appropriate audit evidence on the controls of the service organization. Now, user auditor feels that in order to understand this modification, it is necessary to refer to the work of service auditor. Then he can refer to the work of service auditor in his audit report. But he should mention that the fact that I am referring to the work of service auditor does not diminish my responsibility. That means does not diminish user auditor's responsibility with respect to the user entity's audit. Hope that is clear. If in case of unmodified opinion is provided by user auditor on the user entity, he cannot refer to the work performed by service auditor. See, user auditor shall not refer to the work of service auditor in the user auditor's report. Hope that is clear. So this is a revision of entire SA 402. Hope you clearly understood this standard. By this we have completed discussion of all these 4 standards. And before winding up the class, a small announcement. We have launched Lecturepedia app, and in this Lecturepedia app you can practice MCQs of all the subjects of CA Final, CA Inter and CA Foundation for free of cost. And also you can purchase courses of various faculties across India on Lecturepedia app. You can download Lecturepedia app from Play Store. Hope that is clear. We'll meet in the next video. Until then, take care. Bye bye. See you. In the today's revision class, we will be revising SA 800 series. In this 800 series, we are having 3 standards: SA 800, SA 805 and SA 810. And if you see, these 3 standards, they have been amended for May 2025 examinations. Since there are amendments in this standard, what I'll be doing is I'll be trying to go slow with respect to these 3 standards, covering all the amendments. Okay. And before starting the revision lecture, a small information. We have recently launched a Lecturepedia app. On this Lecturepedia app, you can freely solve MCQs of all the subjects of CA Final, CA Inter and CA Foundation. And you can also purchase classes of various faculties on this Lecturepedia app. And you can download this Lecturepedia app from Play Store. Okay, with this information, let us start revision of SA 800 series. This SA 800 series, we'll call this as specialized areas. Now, basically, for these specialized areas also, standards on auditing that we have discussed from SA 200 till SA 720, all these standards are applicable. Along with those standards, these standards are specifically applicable for these specialized areas. We will see what are the specialized areas. There are 3 specialized areas that are covered in this chapter. Firstly, SA 800, which deals with audit of financial statements prepared as per special purpose framework. What is this special purpose framework? We will see. Okay, SA 800 deals with audit of financial statements prepared as per special purpose framework. Now, generally there will be two types of frameworks. One is general purpose framework and another one is special purpose framework. Now, general purpose financial reporting framework will be used to prepare financial statements that are used for general use of all the public, whereas special purpose financial reporting framework will be used for preparation of financial statements that are for the use of specific users. Like for example, let's say you wanted to take a loan from a bank, and in order to give loan to your company, bank needs to analyze your financials. So for that purpose of analysis, bank might ask you to prepare financials as per the rules and as per the framework that the bank has developed. Now you need to prepare the financial statements as per the framework that the bank has developed, and you need to submit these financials to the bank. Now this type of framework is known as special purpose financial reporting framework, because here this framework, it is used specifically for the purpose of getting loan from the bank, from that specific bank, right? So these financial statements which are prepared as per special purpose financial reporting framework, let's say bank also requires the company, after preparing your financials as per this special purpose framework, you also get these financials audited by a auditor. Now company will appoint an auditor to audit the financial statements that are prepared as per special purpose framework. Now this auditor, while auditing the special purpose financial statements, he need to apply requirements of SA 800. Now along with SA 800, all the standards that we have discussed till now, they also will be applicable. The requirement of SA 800 is additional to those standards. Okay, it doesn't mean that all the standards that we have discussed till now are not applicable. They also will be applicable. Along with them, this SA 800 will be applied. Okay, audit of financial statements prepared in accordance with special purpose framework. Another specialized area is audit of single financial statement or specific element of financial statement. Okay, you might be required to audit only balance sheet, only profit and loss statement, or you might be required to audit a particular item of financial statements. Like you are appointed to audit a revenue audit, you will call it. You're appointed to audit only stock audit, you will call it. So for such a type of audit of a single financial statement or audit of a specific element of financial statement, SA 805 will be applicable. Next, audit of summary financial statements. These summary financial statements, they will be prepared from the complete set of financial statements. There are various requirements why these summary financial statements will be prepared, that we will be discussing while we discuss the standard. We will discuss that in detail. Okay, but these are the three specialized areas which will be dealt by SA 800 series. Hope that is clear. Now, structure of above standards. Now if you see all these three standards, SA 800, SA 805 and SA 810, in all these three standards, you can divide these standards into three parts. Okay, the content of these standards is structured in three parts. Okay, the first part will be acceptance of engagement. Okay, when auditor accepts this type of engagement, what type of considerations has to be taken into account, that will be the first part of all these three standards. Next, in planning the audit, what considerations has to be taken into account. Okay, in planning and performance of engagement, what considerations has to be taken into account. And the final part is reporting. See, forming an opinion and reporting. So you can divide the content of these standards into these three parts. Okay, next, SA 800, which is, you already know, special considerations, audit of financial statements prepared in accordance with special purpose financial reporting framework. You already know difference between special purpose financial reporting framework and general purpose financial reporting framework. Okay, examples of general purpose financial reporting framework Indian accounting standards, IFRS. These are examples of financial reporting frameworks which are general purpose. Okay, they are used for general users. They will be used by general users. Hope that is clear. Now, what is a special purpose framework? We already discussed this. Financial reporting framework designed to meet financial information needs of specific users. In the example that I have discussed with you, bank, right? And it can be fair presentation or compliance framework. Difference between fair presentation framework and compliance framework we have already discussed in starting standards itself. Some of the examples of this special purpose framework. First example, cash basis of accounting and also cash flow information that an entity may be requested to prepare for creditors. Now there was an amendment in this point. Okay, this point is amended point only. Okay, I have included amended point only here, but earlier, see, there is no change in the concept, but the terminology has been changed. Earlier this example was here, now it is cash basis of accounting, right? Earlier a different terminology was used. Okay, the meaning is same, but the term used was different. That's it. Okay, that small minor amendment was made in this point. Okay, next example, financial reporting provisions established by regulator to meet requirements of that particular regulator. Okay, if any particular regulator, let's say for example income tax department, in future it might issue a financial reporting framework and ask the companies to prepare financials as per that particular framework when they are submitting financials to the income tax department. So that becomes a special purpose financial reporting framework. See, that requirement is not there as of now, but I'm just giving you an example. Okay, next, financial reporting provisions of a contract such as bond, indenture. Now let's say company wanted to raise money from public, IPO. Now in order to raise money from public, or let's take another example, company entered into a contract with government. Okay, government wanted to construct a particular bridge or particular dam. So for that particular purpose, government issued tenders and the company participated in the tender and the company won the contract. But in order to give that contract to the company during the period of construction, okay, let's say construction of dam takes 5 years. So during that 5 years period, company has to prepare its financial statements as per the financial reporting framework that is specified in the contract between government and the company, and submit it to the government. Why? In order to assess the financial stability of the company, government has kept this requirement. Okay, because construction of dam is a huge project, lot of money is involved. Now whether company is in a position to handle that huge project, okay, whether the financials of the company can support that project. So in order to assess this, the government wanted the financials of the company in a different format. Okay, that is easy for analysis of this point. So the government has designed its own framework and it has kept that framework in the contract between company and government, right? So this is also one of the example for special purpose financial reporting framework. See, wantedly I'm going a little slow because there is an amendment in this standard. Okay, next, considerations when accepting such a framework. Now I have told you now these standards, they are divided into three parts. The first part is considerations while accepting this engagement. While you accept the engagement, what considerations you have to take into account, okay, with respect to the financial reporting framework. So that depends on who prepared these financial reporting framework. Let's say the financial reporting framework has been prepared by a standard setting body. Okay, see, financial reporting framework developed by organization that is authorized to formulate standards for special purpose financial statements. let's take for example ICAI. Okay, ICAI is a authorized organization to develop and issue standards on accounting and auditing, right? So if the framework, the special purpose framework is developed by ICAI, in such a situation, such framework will be acceptable to the auditor if the procedure followed and established is a transparent process. Okay, presumed to be acceptable if organization follows established and transparent process for developing that particular framework. Okay, next, if the financial reporting framework is prescribed by any law or regulation, in such a situation also the framework will be acceptable to the auditor until and unless there is anything contrary. Okay, see, presumed to be acceptable in absence of indications of contrary. Okay, until and unless there is any point because of which auditor cannot accept the engagement, uh, cannot accept the framework. In all other situations the framework will be deemed to be acceptable to the auditor if it is prescribed by law or regulation. Next, financial reporting framework as per a contract. In such a situation, that financial reporting framework will be acceptable if it contains attributes as per the requirement of SA 210, that is agreeing to the terms of audit engagement. Okay, so this is how auditor will determine the acceptability of the framework. There is no amendment in these points. Okay, all these points are present earlier also. Now the amendment comes in the next concept, which is considerations in planning the audit of special purpose financial statements. Let us see. If you see, all these 5 points, they are as it is, they are not amended, but the sixth point is added. We will see that. First of all, we will see these points. So while planning the audit of special purpose financial statements, what considerations has to be taken into account by the auditor? See, you need to comply with ethical requirements, 5 ethical requirements, comply with the requirements of relevant standards. Okay, along with this standard, you should also comply with the requirement of all other relevant standards. Example, special consideration in respect of some of the standards are: first one, determine materiality as per SA 320 irrespective of agreed threshold. Agreed threshold means now the financial statements are prepared by management and they are prepared for specific use of the user. Specific user, let's say that specific user is bank. Now management has entered into an agreement with the bank that in these special purpose financial statements management will not correct the misstatements until and unless those misstatements cross a particular threshold. Now that threshold which is agreed between management and bank need not be the materiality level. Okay, auditor, he should again determine the materiality level irrespective of the threshold accepted between management and that particular specific user. Okay, auditor, he needs to again determine materiality as per SA 320. Hope this is clear. Next, auditor should also determine those charged with governance responsible for special purpose financial statements as per SA 260. See, the people, those charged with governance for general purpose financial statements can be different from those charged with governance for special purpose financial statements. So the auditor, while auditing special purpose financial statements, he has to determine those charged with governance for special purpose financial statements. Okay, see, these are the requirements of other standards that needs to be applied while conducting audit of special purpose financial statements. Next, this is newly added point. Okay, you should also obtain understanding of any significant interpretations of the contract that management made in the preparation of financial statements. Now I have given an example. The financial reporting framework, the special purpose financial reporting framework can be prescribed as per a contract. The example that I have given is contract between company and the government. Now the auditor, before auditing those special purpose financial statements, he should first of all understand the requirements of the contract. Okay, generally as per SA 315, before you conduct an audit, you will assess the risk of material misstatement by understanding the entity and its environment. Just like that, here also you should understand the requirements of the contract. Okay, now here you can find obtain understanding of significant interpretations. Okay, interpretation means analysis of different points that are present in the contract, right? There will be various points in the contract. So how you analyze and how you understand those points is known as interpretation. Now what will be known as significant interpretation? See, auditor, he needs to understand only significant interpretation. Now what is a significant interpretation? The definition is given. Note, an interpretation is significant when adoption of other interpretation would make material difference in the information presented in the financial statements. See, what will be a significant interpretation? Let's say there is a particular point in the contract. Now if you understand this point in one particular way, then you will arrive at amount of some 50 lakh in the financial statement for a particular item. If you interpret this point in another way, you will arrive the same amount at 30 lakhs only. Now if you see, because of change in the interpretation, there is a material difference in the way in which you will determine the amount or the way in which you will present in the financial statements. So this is known as a significant interpretation if it affects the way in which it is presented or amount disclosed in the financial statement. Okay, see, I'll again read this point. An interpretation is significant when adoption of other interpretation would make a material difference in information presented in the financial statements. Hope that is clear. So this point is newly added point. This is amendment, you can say. Next, description of applicable financial reporting framework. Here also amendment is there. Let's see, the first 2 points, they were there earlier also. Point 3, point 4, point 5, these 3 points are newly added. Let us see, description of applicable financial reporting framework. Where will you describe applicable financial reporting framework? You will describe applicable financial reporting framework in the auditor's report. See, auditor's report shall also describe the purpose for which the financial statements are prepared, and if management has choice of financial reporting framework, explanation of management responsibility shall also make reference to responsibility for determining that applicable financial reporting framework. If management is having option to select more than one financial reporting framework, okay, it is having choice to select the financial reporting framework, then auditor in his audit report under management responsibility, he should clearly mention that it is the responsibility of management to select the applicable financial reporting framework. Okay, these 2 points, they are there earlier also. Next, if auditor wants to give any key audit matter in his audit report on special purpose financial statements, then requirement of SA 701 will be applicable. Now it doesn't mean that earlier, before amendment, the requirement of SA 701 was not applicable. Earlier also SA 701 is applicable for audit of special purpose financial statements, but now specifically this point is introduced in the standard. Okay, there is no change in the interpretation or no change in the applicability of SA 701, but it is explicitly mentioned now in the standard regarding applicability of SA 701. Same with respect to SA 720 also. Now if the special purpose financial statements are given along with a report, okay, generally the normal financial statements, they will be issued to the public by the company in the annual report, right? In the annual report there will be board's report, there will be management report, there will be various analysis, right? All will be included. Now with respect to that other information, basically in the annual report, apart from financial statements and audit report, whatever the information is present, that information will be known as other information, and auditor, he needs to verify whether that other information is consistent with the financial statement, right? Now the same thing will apply here also. If management issues special purpose financial statements in a specific report, then that report will be known as annual report for the purpose of this standard and the auditor, he needs to verify whether that other information is consistent with the financial statements. So here SA 720 will be applicable even with respect to this financial statements prepared as per special purpose financial reporting framework. Okay, next, audit report on special purpose financial statements may refer to audit report on general purpose financial statements in other matter paragraph. See, if auditor of special purpose financial statements in his audit report wants to refer the audit report of general purpose financial statements, then the auditor of special purpose financial statements can do so in the other matter paragraph in his audit report. Hope this is clear. So these 3 points are newly added as amendment. Next, alerting the users. Now in the alerting the users, a small change has been made. Generally, special purpose financial statements are used only for specific uses of specified users, right? All the users cannot use. Now there is a chance that the entity might publish these special purpose financial statements and audit report in the website. Now the users might confuse, might misunderstand these audit report on special purpose financial statements. So in order to avoid misunderstanding, the auditor in his audit report under emphasis of matter paragraph, he will clearly mention that this audit report is on special purpose financial statements. This is not for the use of general users. Like this, auditor will alert in his audit report. Okay, where will he give this alert? He will give this alert in emphasis of matter paragraph. Now what is amendment here? Earlier, before amendment, auditor used to give this point in a separate paragraph by heading alert to the users. But now that alert to the users paragraph is removed and this alert is being given in the emphasis of matter paragraph itself. Hope this is clear. Next, auditor can extend this paragraph to restrict the users. See, additionally, same paragraph can be expanded to restrict distribution or use of auditor's report. Okay, in the same paragraph, auditor can mention that this audit report has to be distributed by the management only to specific users. Okay, like bank or the other party of the contract. Okay, as per the circumstances, who is the specific user will be determined by the auditor, and he needs to restrict the distribution of this report only to that particular specific users. Hope that is clear. So by this we have completed revision of SA 800. Now I will open PPT of SA 805. Moving to the next standard, SA 805. Now this SA 805 deal with a specialized area. What is that specialized area? Audit of single financial statement. That means audit of only profit and loss statement, or audit of only balance sheet, or audit of only cash flows is known as audit of single financial statements. Now there will be various requirements to the company wherein auditor will be asked only to audit a particular financial statement or particular element of a financial statement, right? And a specific element, account or item of the financial statements. Now when auditor has got this type of assignment, then he need to consider requirements of SA 805. Along with SA 805, even other standards will also be applicable. Okay, now definitions. Single financial statement. What is meant by a single financial statement? You already know. A cash flow statement or a profit and loss statement is a single financial statement. Next, element of financial statement. Element of financial statement means a particular item of financial statements like revenue or inventory or asset, right? This is particular element of financial statement. Next, interplay between SA 800 and SA 805. See, SA 800 deals with audit of financial statements prepared as per a special purpose financial reporting framework. Right now, if auditor has got an assignment to audit a single financial statement or element of financial statement. Now, for audit of single financial statement or element of financial statement, SA 805 is applicable. Now, let's say if this is single financial statement or element of financial statement is prepared as per general purpose financial reporting framework, in such a situation only SA 805 will be applicable along with other standards, that is from SA 100 to SA SA 200 to SA 720. Those standards will be applicable. Along with those standards, SA 805 will also be applicable if the single financial statement or element of financial statement prepared as per general purpose financial reporting framework. If this is single financial statement or special purpose financial this is single financial statement or element of a financial statement is prepared as per special purpose financial reporting framework, then SA 800 will also be applicable along with SA 805, because these financial statement is prepared as per special purpose financial reporting framework. Whenever special purpose framework is involved, requirements of SA 800 will also be applicable, and this is a single financial statement, SA 805 will also be applicable, and remaining other standards from SA 200 to SA 720 they will however be applicable. Right, see, SA 100 to 700 series, SA 805 and SA 800 are applicable. Note, SA 800 and SA 805 do not override requirements of other standards on auditing. You need to remember this. Okay, whenever there is a clash between SA 800, 805 and other standards only will remain. Okay. Next, considerations when accepting the engagement. See, whenever you are accepting the engagement, the first thing that you will see is whether the financial reporting framework is acceptable or not. See, determine acceptability of applicable financial reporting framework as per SA 220. Sorry. Next, determine whether financial reporting framework provides adequate disclosures to enable users to understand the information conveyed in the financial statement or the element. Okay, you have to verify whether these financial reporting framework provides for adequate disclosures in the financial statement, so that the users will understand this single financial statement or the element of financial statement. Okay, you have to determine whether that is present in financial reporting framework or not. Next, a single financial statement or element may be prepared as per financial reporting framework that is based on financial reporting framework for complete set of financial statement established by authorized standard setting organization. Now, in some situations, what will happen is the single financial statement or element of financial statement will be prepared as per the financial reporting framework that is applicable for complete set of financial statement, like Ind AS or accounting standards. These financial frameworks, they are applicable for complete set of financial statements. Now, if the same framework is used for preparation of this single financial statement or element of financial statement, then such a framework is acceptable if it includes all requirements of framework on which it is based that are relevant to the presentation of single financial statement or of a specific element of financial statement. Okay, that financial statement will be acceptable if it contains all the requirements with respect to single financial statement or element of financial statement. Hope that is clear. Next, considerations while planning and performing the audit. See, considerations in planning and performing the audit. First of all, as usual, you will see compliance with requirements of all the ethical requirements, right? Comply with ethical requirements. There are
5 ethical requirements, right? Next, you have to obtain sufficient appropriate audit evidence. In case of a audit, the auditor, he will give the opinion by getting sufficient appropriate audit evidence, by basing his opinion on sufficient appropriate audit evidence. Now, if the auditor has already audited a complete set of financial statements, then for the purpose of that audit of a complete set, he would have obtained audit evidences. Now, if those audit evidences are useful for this single financial statement audit or for this element of a financial statement audit, then auditor can use the same audit evidences. It is permissible. Okay, see, audit evidence obtained as part of audit of complete set of financial statement can be used for audit of single financial statement or specific element if auditing in conjunction. Next, another point is that now if the auditor is auditing specific element of financial statement, let's say for example revenue, okay, sales, auditor is auditing sales. Now, auditor, he cannot audit sales in isolation. Sales are linked to debtors, cash, and also inventory, right? So when auditor audits sales, he should also perform some audit procedures on these relevant items like debtors for credit sales, and cash or bank balance with respect to check whether in respect of cash sales whether cash has actually been received or not, and inventory balance, okay, after sale has been completed whether inventory is moved or not. So even though auditor has been appointed to audit single element of financial statement, here auditor cannot audit that single element in isolation. So auditor might be required to audit relevant elements also. Okay, see, auditor may not be able to consider the financial statement or the element in isolation. Consequently, auditor may need to perform procedure in relation to interrelated items. Okay, just like the example that I have told you. Next, materiality for single financial statement. Sorry, yeah, materiality for single financial statement or specific element of the financial statement may be lower than the materiality for the complete set of financial statement. So auditor has to again determine the materiality for this audit of single financial statement or element of financial statement. Hope that is clear. Next, as I have already told you, all other standards from SA 200 to SA 720 series, they are applicable for the audit of single financial statement or a specific element. However, there are certain specific standards which have to be specifically verified. What are they? SA 240, because the SA 240 deals with risk of fraud. Risk of fraud is very significant. Auditor, he needs to comply the requirements of SA 240 specifically. Same with respect to SA 550, that is related party, and SA 570 with respect to going concern. Okay, auditor need to check or auditor need to perform the procedures as per these three standards specifically. Okay, this is the amendment. This point is newly added. This point is also newly added. The auditor, he needs to determine those charged with governance in the organization with respect to single financial statement or element of financial statement, because I have already told you in SA 800 that those charged with governance for a complete set of financial statement might be different with those charged with governance for single financial statement or element of financial statement, right? Next, there are some more points that we need to discuss. we'll discuss those points from the book. Okay, after that we'll again come to this PPT. Still with respect to reporting we need to discuss. Okay, we'll first of all revise with respect to reporting. After that we'll discuss those remaining points from the book. Okay, we'll first of all see the reporting aspect. Now reporting in this SA 805 is very important. Why it is very important, let me tell you. Now if auditor in his audit report on complete set of financial statement has given unmodified opinion, clean opinion, then auditor in his audit of single financial statement, he can either modify or unmodify his opinion. Same in case of a specific element also, auditor can modify or unmodify his opinion. Okay, if complete set of financial statements has unmodified opinion, then single financial statements auditor can give either modified or unmodified, and specific element also either modified or unmodified. Next, if complete set of financial statement has qualified opinion, in such a situation also on single financial statement auditor can modify or unmodify his opinion. In the same way on specific element also auditor can modify or unmodify his opinion. Hope this is clear. See, here we are checking if on complete set of financial statement auditor has given modified opinion, what opinion he can give on single financial statement or element of financial statement. Okay, in that aspect we are seeing. Next, on complete set of financial statements auditor has given adverse opinion. See, adverse opinion. In such a situation on single financial statement auditor has to give only modified opinion. He cannot give clean opinion. Why? Because adverse opinion means what? There are misstatements in the financial statements, and those misstatements are material as well as pervasive. That means they are present in various items, they are affecting the entire financial statements. So on complete set you have given adverse opinion, but on single financial statement you are you wanted to give unmodified opinion. It is not permitted because it will contradict your opinion on complete set. Okay, in complete set you are saying misstatements are pervasive, that means they are present across the financial statements. Then if they are present across the financial statement, how can you give unmodified opinion for audit of a particular single financial statement? You have to give modified opinion only. Hope you understood this. Next, on specific element or item also you have to give only modified opinion, but there is a exception for this. We will see what is that exception. Okay, exception 1. That means in such exceptional situation, even though on complete set of financial statements there is adverse opinion, auditor on his audit of a specific element or item of financial statement, he can give unmodified opinion in such exceptional situation. What is that exceptional situation? We will see. Okay, that exception 1, it is applicable for this, and for next point also same exception will be applicable. So after completing next point we will see the exception. Next, if the auditor gives on complete set of financial statement disclaimer of opinion, then on single financial statement only modified opinion has to be given. But however there is exception for this. This exception is exception number 2. Okay, both the exceptions are different, that's why I have given exception 1 and exception 2. Okay, the points that has to be satisfied in order to claim that exception or is different, so it is exception 1 and exception 2 that I have given. Next, if auditor has given disclaimer of opinion on complete set, then on specific element auditor has to give only modified opinion. That, but however there is a exception. This exception is exception 1. Okay, now we will see what are the exceptions. That means you should remember, in exceptional situation auditor can give unmodified opinion even though the complete set of financial statements contain adverse or disclaimer of opinion.
Okay, let us see. Yeah, the same I have given here. Now, exception 1. It is not prohibited by law or regulation to give unmodified opinion. Okay, along with this condition, both audit reports are not published together. Both audit reports means audit report on complete set of financial statements and audit report on specific element of financial statements, they are not published together. Okay, this is the second condition that needs to be satisfied. And the third condition, specific element do not constitute major portion of financial statement. Okay, the specific element that you are auditing should not constitute major portion of financial statement. If these three conditions are satisfied, then even though on complete set you have given adverse or disclaimer of opinion, on single element of financial statement you can give unmodified opinion. Next, exception number 2. This exception number 2 is applicable for second situation, that is when auditor has given a disclaimer of opinion on complete set and auditor wants to give unmodified opinion on single financial statement. Okay, so what is the exception? Example, I will explain this exception in the form of example. Now, in the complete set of financial statement, auditor has given disclaimer of opinion because of profit and loss statement and cash flow statement. Okay, because of these two statements, auditor has given disclaimer of opinion. But balance sheet is fine. There is no misstatements in balance sheet. Now, the auditor has been appointed to audit single financial statement, and that single financial statement is balance sheet. Now, in this situation, since the auditor's opinion or since the disclaimer in complete set is due to cash flow and profit and loss and there are no misstatements in balance sheet, and auditor has been appointed to audit single financial statement, and that single financial statement is balance sheet, you can give unmodified opinion on this balance sheet. Okay, this is the exceptional situation. Now, there are some more points, we will discuss them from our book, Audit Concise book. What happened to this? Yeah, yeah, yes, say 805. All this we have discussed, right? Consideration when planning the audit. The two amended points also we have discussed. Yeah, form of opinion. Now, the form of opinion on single financial statement or specific element of financial statement, it will depend on laws and regulation and applicable financial reporting framework. Now, whether auditor has to use the terms presents fairly in all material respects or gives a true and fair view. Okay, whether auditor has to use these two terms in the audit report of single financial statement or element of financial statement, that depends on following factors. What are the first factor? Whether applicable financial reporting framework is explicitly or implicitly restricted only to complete set of financial statements. You need to check that. Okay, if it is restricted only for the preparation of a complete set of financial statements, you cannot use these terms present fairly or gives true and fair view for the audit of a single financial statement or element. The next thing that you need to see is whether single financial statement or specific element of financial statement will comply fully with each of those requirements of the framework. And in order to uh, present more fairly whether deviation from the framework is permitted for the single financial statement. Okay, in order to achieve more fairness, if deviation is permitted, then you can use these terms present fairly or use truant fair view. Hope that is clear. Next, application of various other specific standards. See, these are not any new addition. Okay, basically this is not a change in the concept. Okay, all these standards, SA 700, 570, 701, all these standards, they are applicable even prior to amendment also. But now the institute has specifically included these standards in the SA 805. Even before this amendment also, these standards are applicable. Okay, for audit of single financial statement or element of financial statement. Now, SA 700. Basically, auditor is required to apply requirements of SA 700 adopted as necessary in the circumstances of the engagement wherever necessary while forming the opinion. Okay, requirements of SA 700 are applicable. Next, requirements of SS 570. Now, responsibility with respect to making assessment with regarding going concern assumption lies with the management. So you need to explain this responsibility in the management responsibility paragraph as per SA 570. This requirement is applicable even in case of audit of single financial statement or element. And next, you should also explain auditor's responsibility with respect to going concern in the auditor's responsibility paragraph. Okay, this is requirement as per SA 7 as SA 570. Next, SA 701. Whenever auditor wants to communicate key audit matter in audit report on single financial statement or element of financial statement, then requirements of SA 701 are applicable. Next, SA 720. This point we have already discussed even in SA 800 also. If the management decides to issue single financial statement or element of financial statement along with a specific report, then that report will be considered as annual report for this purpose, and the requirement of the auditor to check whether other information that is present in the annual information is consistent with the single financial statement or element of financial statement will be applicable even here also as per SA 720. Next, signature of the auditor he needs to sign the audit report. Okay, if it is a firm, on behalf of firm he needs to sign. If it is an individual, in his individual capacity he needs to sign. Next, implications of a complete set of financial statement auditor's report for the audit of single financial statement or specific element of financial statement. See, whether a matter included in the auditor's report on complete set of financial statement is relevant to the context of engagement report on single financial statement or specific element involves professional judgment. Now, the impact of audit report on complete set of financial statements on the audit report on single financial statement or element of financial statement. Okay, whether there is any impact or not, that depends on the professional judgment of the auditor. Okay, in deciding that, auditor's professional judgment will be involved. However, factors that may be relevant in considering these implications include following. What are they? Nature of the matter being addressed in the auditor's report on complete set of financial statement and extent to which it relates to what is included in the single financial statement. Okay, if in the auditor's report on complete set of financial statement, auditor is giving modified opinion with respect to revenue, and another auditor he has been appointed to audit specific element, and that is also a revenue. Now, obviously, for the audit of single element or specific element which is revenue will be having impact of the complete set of financial statement, because on complete set of financial statement audit report, auditor has modified the opinion because of revenue. Okay, since revenue is specified in the audit report and the specific element that is being audited is also revenue, obviously the impact of this complete set of financial statement audit report will be there on the audit report of specific element. Next, pervasiveness of matter described in the auditor's report on complete set of financial statement. Pervasiveness, this point we have already discussed while discussing the reporting point. Next, nature and extent of differences between applicable financial reporting framework. Okay, what is the differences between applicable financial reporting framework used for complete set and the specific element? Next, extent of difference between periods covered by the complete set of financial statement compared to the period or date of the single financial statement. Okay, you should also see the periods covered by complete set and the single financial statement. Let's say complete set of financial statement is for 1 year, and that 1 year is from 1st April 2024 to 31st March 2025. Whereas single financial statement audit is for 6 months, and that 6 months is also from 1st April 2025 to 30 September 2025. So here periods are different, so there will not be any impact of complete set on the single financial statement. If the periods are same, then obviously there will be impact. Okay, you need to see this. Next, time elapsed since the date auditors report on complete set of financial statements. Okay, uh, how much time has completed since the auditor has given audit report on complete set of financial statement. Okay, if the long time has passed, then there will not be any impact. If recently it has been given, then there will be impact. Okay, example of a similar kind is given here. Okay, another point, if auditor of sorry if auditor of single financial statement or specific element of financial statement wanted to refer to the audit report of complete set of financial statement in his audit report, then auditor can do so in other matter paragraph. Okay, that's it, and the remaining reporting aspect we have discussed already. However, another some 2 points are added. If the auditor's report on entities' complete set of financial statements include modified opinion or emphasis of matter paragraph, only these 2 points were there earlier. Okay, if auditor's report on complete set is having modified opinion or emphasis of matter paragraph, only then auditor will consider that impact on the reporting on single financial statement or specific element of financial statement. But now, even if there is a material uncertainty related to going concern as per SA 570 in the complete set of financial statement, auditor should consider this effect also on audit of single financial statement or element of financial statement. And also a statement that describes an uncorrected material misstatement of other information in accordance with SA 720. Okay, if auditor's report on complete set of financial statement specifies that there is a material misstatement in the other information, then auditor's report on single financial statement or specific element of financial statement should also consider this point for the audit report on single financial statement or specific element. Okay, so by this essay 805 gets completed. Hope you understood essay 805. Wantedly I have discussed this concept a little slow. Okay, now we'll go to next standard, which is essay 810, right? So essay 810, it deals with engagement to report on summary financial statements. What are these summary financial statements? Summary financial statements are prepared from complete set of financial statements. They will show a summary of the complete set of financial statements. Now, what are the situations in which these summary financial statements has to be prepared? Let's say, for example, for investor presentation, you cannot present entire complete set, you cannot discuss the entire complete set with the investors, because it will take a lot of time, and investors will also not understand the complete set of financial statements. So summary set financial statements will be prepared for discussing in the investor presentation. Okay, and these summary financial statements will be less detailed when compared to complete set of financial statements. See, these summary financial statements are derived from complete set of financial statements, and they are less detailed than the complete set of financial statements. They are used for investor presentation, submission to credit rating agencies, or including in prospectus for IPO. Next, engagement acceptance. Even this summary financial statements should also be audited by the auditor to check whether they are true summary of the complete set of financial statements or not. Now, in order to accept this engagement, generally, if the auditor who has audited complete set of financial statement has also been given the engagement to audit summary financial statements, he will accept the engagement. And in fact, in 99% of the cases, the auditor who has audited the complete set should only be given the engagement to audit the summary financial statements. Why? Because auditor has already audited the complete set, so he's having knowledge with respect to the entire financials and also business of the entity, so it becomes easy for him to audit summary financial statements. If you appoint some other auditor to audit summary financial statements, he will have to again understand the entire entity, he will have to understand the complete set, he will have to understand the audit done by the previous auditor, right? So all this has to be done. So mostly, if the engagement to audit summary financial statement is given to the auditor who has conducted audit of a complete set of financial statements, then he will accept that engagement. See, engagement to report on summary financial statement shall ordinarily be accepted when auditor has been engaged to conduct the audit of complete set of financial statements. Okay, now factors that has to be considered in determining acceptability of the engagement. Obviously, determine whether applied criteria are acceptable. Here, criteria means nothing but framework, financial reporting framework. Okay, the auditor, he will accept the engagement if the applied criteria is acceptable. Now, how to determine whether the applied criteria is acceptable? Preparation of summary financial statements require management to determine information that needs to be reflected in the summary financial statements so that they represent fair summary of the audited financial statements. Okay, it is the responsibility of the management to determine which items of a complete set of financial statements has to be included in the summary financial statements. Next, criteria for presentation of summary financial statements may be established by authorized or recognized standard setting organization or by law or regulation. Okay, the criteria for preparing summary financial statements can be developed by authorized or recognized standard setting organization or by any law or regulation. Now, where established criteria do not exist, if established criteria is not there, then criteria may be developed by management, for example based on practice that is available in the industry. Okay, if the financial reporting framework for preparation of summary financial statements is not there, then management, they themselves can develop the financial reporting framework. Now, factors affecting auditors determination of acceptability of applied criteria. What factors will affect the auditor's determination of whether to accept the criteria or not? Firstly, nature of the entity. What is the nature of entity and what is the purpose of summary financial statements, information needs of the intended users, and whether applied criteria will result in misleading results. Okay, these factors auditor will see to determine whether applied criteria is acceptable or not. If auditor concludes that applied criteria is not acceptable and shall not accept the engagement. Okay, if auditor feels that applied criteria is not acceptable, that is the financial reporting framework is not acceptable, then auditor will not accept the engagement. Hope that is clear. Next, auditor, he needs to obtain agreement of management that it acknowledges and understands its responsibility for preparation of summary financial statements to include auditor's report on summary financial statement in any document that contains summary financial statements. Okay, the auditor, to accept the audit of summary financial statements, he should obtain a written confirmation from the management confirming their responsibility for preparation of summary financial statements, and management will include the auditor's report on summary financial statements in any document that contains the summary financial statements. That means the management will not issue summary financial statements alone, okay, along with summary financial statements, management will also issue auditor's report, okay. It is a responsibility of the management to issue that, okay. So auditor has to obtain this agreement from the management. Next, to make audited financial statements available to the intended users of summary financial statements without undue difficulty. Now, to whomever you are issuing summary financial statements, for those users, along with summary financial statements, you should also give audited complete set of financial statements, because summary financial statement will not contain detailed information. If at all the users wanted detailed information, or if at all they wanted to understand in more detail of any item presented in the summary financial statements, they can refer the complete set of financial statement. For this purpose, whenever the management issues summary financial statements, along with that summary financial statement, you should also issue complete set of audited financial statements. Now, if you are not issuing a complete set of audited financial statements, at least you should communicate to the users from where they can get these complete set of financial statements. See, the summary financial statements describe clearly from whom or where audited financial statements are available, okay. By contacting whom or by visiting which website, you can get complete set of financial statements. That needs to be clearly there in the summary financial statements. Audited financial statements are on public record, or if the entity has already published these audited financial statements on the website, it has to tell to the users of summary financial statements that our complete set of financial statements are already available on public record. If you want, you can check them. Or management has established a process by which the intended users of summary financial statements can obtain a ready access to the audited financial statements, okay. If at all any process has been there to get access to the complete set of financial statements, you have to communicate that process to the users of complete set of financial statements, sorry, to the users of summary financial statements, okay. Next, agree with management on the form of opinion to be expressed on the summary financial statements, okay. So these factors auditor needs to consider in order to accept the engagement, okay. First of all, he needs to determine acceptability of the framework, that is criteria. Next, he needs to obtain written uh, agreement from the management with respect to its responsibility, and finally auditor has to agree with the form of opinion that he expresses on summary financial statements with the management, okay. Next, nature of procedures to be performed by the auditor. What procedures auditor will perform on the summary financial statements? Evaluate whether summary financial statements adequately disclose their summarized nature and identify the audited financial statements. See, the auditor, he has to check whether summary financial statements clearly disclose that they are summarized financial statements, and the summary financial statements should also refer or identify the audited complete set of financial statements. Next, evaluate whether audited financial statements are available to the intended users. We have already discussed this point. The management, whenever it gives summary financial statements to the users, along with summary financial statements, it should give audited financial statements also. If at all it is not giving complete set of audited financial statements to the users, at least it should make sure, or it should communicate to the users from where they can get complete set of audited financial statements, okay. Auditor has to check whether this facility is available or not. When summary financial statements are not accompanied by the audited financial statements, then evaluate whether they describe clearly from whom or where the audited financial statements can be obtained. The law or regulation that specifies the audited financial statements need not be made available to the intended users. If at all, as per any law or regulation, it clearly specifies that the complete set of financial statements, the complete set of audited financial statements need not be given along with the summary financial statements, then auditor needs to mention, then management needs to mention in the summary financial statements as per which law it is not required to submit or make available the audited financial statements. Next, whether such a disclosure is there or not has to be seen by the auditor. Next, evaluate whether summary financial statements are prepared in accordance with the applied criteria or not. This is a basic point that the auditor has to check. Next, determine whether summary financial statements agree with audited financial statements. Okay, obviously summary financial statements are prepared from complete set of audited financial statements, so the amounts of figures that are shown in summary financial statements should match with the audited complete set of financial statements, right? And evaluate in view of purpose of summary financial statements whether summary financial statements contain information necessary. Okay, based on the purpose for which summary financial statements are prepared, auditor needs to see to satisfy that purpose whether required information is present in the summary financial statements or not. Next, form of opinion that the auditor has to give on the summary financial statements. See, when auditor has concluded that unmodified opinion on summary financial statement is appropriate, okay, auditor wants to give unmodified clean opinion on summary financial statement. Auditor opinion shall, unless otherwise required by law or regulation, use one of the following phrases. Okay, what phrases auditor has to use when he determines that he wants to give unmodified opinion on complete set of on summary financial statements. The first phrase that you can use is summary financial statements are consistent in all material respects with the audited financial statements. Okay, this phrase you can use. Or summary financial statements or fair summary of audited financial statements. Okay, you can use any of these two phrases if you wanted to give unmodified opinion on the summary financial statements. Next, if law or regulation prescribes a wording of the opinion on summary financial statements in terms that are different from those described above, then auditor shall apply the procedures discussed earlier and any further procedure necessary to enable the auditor to express prescribed opinion. Now, if any particular law or regulation prescribes different wordings of the auditor's opinion on the summary financial statements than this, okay, instead of these two phrases, if any law or regulation prescribes different wordings, then auditor has to perform the procedures that we have discussed earlier and also other procedures. Okay, and also other procedures that are necessary to enable the auditor that particular type of opinion, and evaluate whether users of summary financial statements might misunderstand the auditor's opinion, and if so, whether additional explanation can mitigate. Okay, auditor should also evaluate whether users of summary financial statements might misunderstand the auditor's opinion. If at all auditor feels that users might misunderstand the auditor's opinion, then he has to determine whether additional explanation can mitigate misunderstanding of the users. Okay, if auditor feels that additional explanation also doesn't mitigate the misunderstanding of the users, in such a situation he shall not accept the engagement in the first place. Okay, you shall not accept the engagement. Next, elements of auditor's report. Basically, the format of auditor's report on the summary financial statement. First of all, you'll be having title. Okay, the general format. Next, there will be addressee. You need to identify summary financial statements, including title of each statement forming part of summary financial statements. Identify audited financial statement, that is complete set of financial statement, and you need to clearly express your opinion. And statement indicating that summary financial statement do not contain all disclosures required by the financial reporting framework, because this is a summary financial statement. Next, if required, state that summary financial statement and audited financial statement do not reflect the effects of events that occur subsequent to the date of auditor's report on audited financial statement. Okay, if required, you can state that neither summary financial statements nor audited financial statements, they both do not reflect the subsequent events that have occurred subsequent to the date of auditor's report on complete set of financial statements. Okay, that point you can mention. Next, refer to auditor's report on audited financial statement. Okay, in the audit report on summary financial statements, you should also refer to the auditor's report on complete set of financial statement. This reference you can make in other matter paragraph. Next, description of management responsibility. Statement that auditor is responsible for expression of opinion, Next, auditor signature will be there, union will be there, and date of audit report will be there, right? That is and place of signature. This is the format of audit report on summary financial statements. Next, modification to opinion, emphasis of matter paragraph, other matter paragraph in the auditor's report on audited financial statements. Okay, if auditors report on audited financial statements, that is complete set of financial statements, contains modified opinion or emphasis of matter paragraph or material uncertainty with respect to SA 570 or communication of key audit matter or material misstatements in the other information as per SS 720. Okay, if at all any of these 5 are there in audit report on complete set of financial statements. Okay, basically before amendment only these 2 points was there, now these additional 3 points also introduced. Then in such a situation, but already satisfied that summary financial statements are consistent. Okay, even though on complete set of financial statements modified opinion, emphasis of matter paragraph or material inconsistency in other information is there, auditor feels that the complete set of the summary financial statements, they are satisfactory in all material respects, then auditor's report on summary financial statement shall state that auditor's report on audited financial statement contains a qualified opinion, emphasis of matter, other matter, or material uncertainty, or key audit matter, or a statement that describe uncorrected material misstatement in other information. Okay, if auditor on summary financial statements feels that these summary financial statements are consistent in all material respects, but audit report on complete set of audited financial statements contains either modified opinion, emphasis of matter paragraph, or paragraph related to material uncertainty with respect to going concern, or key audit matter paragraph, or the material uncertainty in other information. If any of these 5 are there in audit report on complete set of financial statement, then auditor in his audit report on summary financial statement should also mention that in the audit report on complete set of financial statement these are there. Okay, either modified or key audit matter is there, or material misstatements and other information is there. Okay, that point you need to mention. Next, you need to describe basis for qualified opinion. Okay, see, all this it should be mentioned in summary financial statements audit report, stating that in the audit report of complete set of financial statement there is a qualified opinion or emphasis of matter paragraph like this. Okay, next, matter referred to in emphasis of matter paragraph, uncorrected material misstatement, effect thereof on the summary financial statement. Okay, what effect they will be having on the summary financial statement you need to mention. Next, when auditors report on audited financial statement contain adverse opinion or a disclaimer of opinion. Okay, if auditors report on complete set of financial statement contain adverse or disclaimer, okay, not qualified, then auditors report on summary financial statement shall additionally state that auditors report on audited financial statement contain adverse or disclaimer of opinion, and because of that, see, you should also describe basis for that adverse or disclaimer of opinion, and state that as a result of such adverse opinion or disclaimer of opinion, it is inappropriate to express opinion on the summary financial statements. That means whenever in the audit report on complete set of financial statements there is a adverse or disclaimer of opinion, then auditor he should not give opinion on the summary financial statements. Hope that is clear. Next, modified opinion on summary financial statements. If summary financial statements are not showing true and fair summary of the complete set of financial statements, then auditor he will give adverse opinion on the summary financial statements. Hope that is clear. Next, restriction on distribution or use or alerting the readers on to the basics of accounting. Now, just like in SA 800 we have read about alert to the users, the same thing you can alert to the users that these financial statements are summary financial statements. In the same way you can restrict the use of this audit report only to specific users. Okay, the same point. Next, unaudited supplementary information presented along with summary financial statements. If supplementary information which is unaudited is presented along with summary financial statements, then auditor needs to see whether the summary unaudited supplementary information has been properly differentiated from the summary financial statement. Okay, clearly differentiated. If auditor concludes that it is not clearly differentiated, then you need to ask management to change the presentation. If management refuses to do so, then auditor shall explain the audit report on summary financial statement that such information is not covered by the audit report. Okay, generally the supplementary information, on the supplementary information, auditor will not give his audit opinion. Okay, auditor will give his audit opinion only on the financial statements. Now, if management has presented supplementary information without differentiating it from the summary financial statements, then even though auditor is not giving his opinion on the summary financials on the supplementary information, users might feel that auditor is giving opinion on supplementary information also, because supplementary information has not been differentiated from the summary financial statements. To avoid this misunderstanding, auditor in his audit report, he has to mention that he is not giving his opinion on the supplementary information, he is giving opinion only on the summary financial statements. Okay, we have discussed this point even in SS 720 also. Next, other information in document containing summary financial statement, we have discussed this point also in SA 800. If in SA 800 we discussed, in SA 805 also we discussed, right? If summary financial statements are presented in a report, then that report will be considered as annual report for the purpose of SA 720, and auditor, he needs to check whether the other information that is present in that report is consistent with the summary financial statement. If at all it is not consistent, there are material misstatement, auditor needs to ask the management to correct those material misstatements. Okay. Next, auditors association. See, if the auditor who has audited the complete set of financial statements has not been appointed to audit the summary financial statements, and the management in a report that is containing the summary financial statements, it wanted to refer to the audit that has been, or it wanted to refer to the auditor who has conducted audit of complete set of financial statements, then such a reference can be made by the management only if the reference to the auditor is made in the context of auditor's report and the statement does not give impression that the auditor has reported on the summary financial statements. Okay, if management wanted to refer to the audit that has been conducted by the auditor on the complete set of financial statements, then such a reference can be made only if such reference is being made in the context of auditor's report, and such reference does not give an impression to the users that the same auditor has audited the summary financial statements also, because actually the auditor of summary financial statements is different from the auditor of the complete set of financial statements. But management in the report in which the summary financial statements are being presented, it wanted to refer to the auditor who has audited complete set of financial statements. Such a reference you can made, but such a reference should not give an impression to the users that the same auditor has audited the summary financial statements also. Okay, if at all the auditor feels that such reference is giving an impression to the users that he has audited summary financial statements also, in such a situation the auditor should request the management to remove such a reference or to change the wordings of such paragraph. If management refuses to make the change, then auditor has to take necessary steps to avoid the users from understanding that the same auditor has audited the summary financial statements. Okay, whatever the steps the auditor want, he can take to avoid the users from misunderstanding. Okay, that is with respect to this auditors association. Next, timing of work and events subsequent to the date of auditor's report. Now, auditor's report on summary financial statements should mention the point that audit report on complete set of financial statements and also audit report on summary financial statements do not consider any subsequent events that has occurred after the date of auditor's report on complete set of financial statement. Okay, this point needs to be mentioned. So this is with respect to entire essay, entire essay 810. Okay, there are also two more points. We'll also see these 2 points. The auditor may become aware of facts that existed at the date of auditor's report on the audited financial statement, but of which auditor previously was unaware. See, now auditor is auditing summary financial statements. Now, while auditing summary financial statements, auditor came to know about certain facts which are present on auditor's report on date of auditor's report on complete set of financial statement, but at that time auditor was not aware of those points, but now he has become aware of those points on the date of summary financial statements, right, on the date of auditor's report on summary financial statements. Now in this situation, auditor, see, I hope you are understanding what I am saying. This is date of auditor's report on complete set. On this date, there are certain facts which auditor was not aware on that particular date, but while auditor is giving audit report on summary financial statements, okay, date of audit report on summary financial statements, on this date auditor came to know about those facts which were present as on date of auditor report on complete set of financial statements. In such a situation, auditor has to give audit report on summary financial statements only if these issues are resolved. Hope you understood. Next, when auditors report on summary financial statement after completion of the audit of financial statement. See, if auditor is conducting audit of summary financial statements after he has completed audit of complete set of financial statements, then he need not obtain additional audit evidences with respect to audit of complete set of financial statements, because he has already done the audit of complete set of financial statements before doing audit of summary financial statements. Hope this is clear. So by this we have completed revision of entire essay 800 series, right? In the next class we will meet with another revision. Until then, take care, bye bye, see you. In the today's class we will be revising audit related services, that is SRS series, standards on related services. Basically in this series we are just having two standards. One is SRS 4400 and another one is SRS 4410. Okay, these two standards, they are very easy standards, and we will be discussing these standards from our audit concise book. I haven't prepared any PPT for this chapter, so we'll be discussing it directly from the audit concise book. And before starting the revision, a small information: recently we have launched Lecturepedia app. On this Lecturepedia app, you can practice MCQs of all the subjects of CA Final, Inter and Foundation. Along with that, you can also purchase classes of various faculties, topmost faculty classes you can purchase from Lecturepedia app, and you can download this Lecturepedia app from Play Store. Okay. So now without any waste of time, let us start the chapter. Audit related services. Now basically auditor, he will be appointed to conduct audit, that is assurance engagement. Now apart from assurance engagement, various clients will give works to the chartered accountant wherein he will not provide assurance. You can call them as non-assurance services or related services. Now when providing these related services to the client, the chartered accountant, he has to follow this SRS series. Basically two standards I have told you na. SRS 4400, it deals with performing agreed upon procedures, and SRS 4410, it deals with compilation engagement. Compilation means preparation of financial statements. Now another important point, these related services the management, they can appoint a non-chartered accountant also to provide these related services, right? So when non-chartered accountant provides these related services, it is not mandatory for those non-chartered accountants to follow these standards, but if chartered accountant provides these related services, he has to follow these standards. Hope that is clear. Now, what are related services? I have already told you. Related services are those services in which auditor doesn't provide any assurance. See, do not meet the definition of assurance engagement. Those services which doesn't meet the definition of assurance engagement will be known as related services. Examples: preparation of income tax returns, providing consultancy services, and engagements covered by standards of related services. They are agreed upon procedures and compilation engagements. These are examples of related services. Now, what is agreed upon procedures? We will discuss. In SRS 4400, we will discuss engagement to perform agreed upon procedures on agreed upon items. Now, in this, what will happen is management, they will approach the chartered accountant to perform certain agreed upon procedures on agreed upon item. That means agreed upon item, let's say inventory. Now management will approach auditor, we wanted to engage you to perform certain procedures on inventory. Now on which item procedures has to be performed, that will be decided by the management and the auditor before accepting the engagement itself. That is why we are calling it as agreed upon item. And what procedures has to be performed, even that will also be decided prior to hand itself. So we call it as agreed upon procedure engagement. Okay, you are performing agreed upon procedures on a agreed upon item. Now while taking up this engagement, the chartered accountant, he needs to comply with SRS 4410. Hope you are clear with this. You can see the definition. What is agreed upon procedures? And in this agreed upon procedure engagement, auditor will not provide any opinion. Okay, auditor, he will just to provide factual findings. Okay, as a result of those procedures, whatever the findings the auditor has found, that auditor will give in his report. So factual findings will be given. Okay, report on factual findings based on specified procedures on a specified subject matter. This is agreed upon procedure engagement. Now objective of SRS 4400. What is the objective of SRS 4400? To enable the auditor to report on factual findings by performing agreed upon procedures on agreed upon item. Now audit versus agreed upon procedure. What is the difference? In audit you will provide assurance. In agreed upon procedures you will not provide assurance. That is the difference. Okay, the difference relates to assurance. Examples I have given. See, comparing names of major suppliers, the amount outstanding on a date to related names and amounts in the trial balance. Okay, the management can appoint a chartered accountant to compare major suppliers amount outstanding as on date to the related names amounts in the trial balance. Okay, to cross verify whether the amounts that are showing as outstanding in the trial balance is actually outstanding or not. Okay, to perform this procedure on this item, the management can employ a chartered accountant. Next, obtain supplier statement or confirmation. Okay, to obtain balance confirmation. Okay, balance confirmation is a procedure, and you'll perform this procedure on a specified item like debtors or creditors or investments, right? This is also example of agreed upon procedure engagement. Next, comparison of such statements or confirmation to the amounts in trial balance. Okay, after getting the external confirmation from the respective party, you will compare whether the amount shown in the external confirmation is matching with the amount shown in the trial balance. Okay, so this entire thing is an example of agreed upon procedure. Here what procedure you are performing, what agreed procedure you are performing, procedure related to obtaining external confirmation and comparing it with the trial balance. Now what is the agreed upon item? The agreed upon item is suppliers, that is vendors or creditors, you can say. Okay, This is the example. Next, general principles. Now, while performing these agreed upon procedures, whether you have to comply with code of ethics, the 5 fundamental principles we have discussed, integrity, objectivity, confidentiality, professional behavior, and professional competence, and due care, whether these 5 fundamental principles needs to be complied or not. The answer is yes, you need to comply with code of ethics, but independence is not required, because here you are not providing any assurance. So for agreed upon procedure engagement, independence is not required. Hope that is clear. Next, defining the terms of engagement. Before accepting the engagement, you should define the terms of engagement and you should agree it in a form of an engagement letter. Okay, now what has to be decided? What is the nature of engagement and what is the purpose of this engagement? Identification of financial information on which to perform the procedures, and identification of procedures also. I have told you in agreed upon procedures, the procedures that has to be performed and the item on which the procedures has to be performed, they will be decided prior to hand itself. Next, limitation on distribution of report. Since this engagement is a specific engagement which is performed based on specific request of the management, this report on this engagement cannot be used by all the users. So you have to include, you should limit the distribution of this report. Okay, to whom this report will be sent, even that should also be decided before accepting the engagement only. Okay, all these terms of the engagement has to be defined. Next, planning procedures and evidence. So what procedures, what type of procedures you might perform in these agreed upon procedures? You can perform inquiry and analysis, recomputation, comparison, and other clerical accuracy checks, observation, inspection, obtaining confirmation. Okay, these are the general procedures that you already know. Okay, any of these procedures which have been agreed between management and the chartered accountant, they will be performed. Okay, these can be the procedures. Next, reporting. Now, in this, how this report on agreed upon procedure will be there? The format. Firstly, you will have title. Next, address, that is to whom you are giving the report. Next, identification of specific financial or non-financial information on which the agreed upon procedure are performed, and also statement that procedure performed was those agreed upon. Okay, you have to state clearly in the report that we have performed only those procedures that were agreed upon between us and the management. Next, you have to state that we have performed this engagement in compliance with standard on related services. You have to include this point only if you have complied with this standard. Next, identification of purpose for which agreed upon procedure engagement is performed, and list of specific procedures that you have actually performed. So see, all these should be there in the report that you give. Next, description of factual findings. Now, by performing those agreed upon procedures, you would have identified certain facts, right? So those factual findings, the description of those factual findings, you need to list down in your report. Next, you should clearly mention that since this is not an audit, we are not expressing any assurance, we are not providing any opinion. Next, a statement that had the auditor performed additional procedures, an audit or review, other matters might have come to light. Okay, you should also clearly state that since we have performed only agreed upon procedures, all the misstatements have not come to light. We have performed only some procedures. If in case we have performed all other procedures, then other matters might have come to light. You should mention this point in the audit report, and you should also mention to whom this report is restricted, and date of the report, place of the signature, and signature. All these should be there in the report that you provide in case of agreed upon procedure engagement. Next, documentation. What documentation you need to make? Auditor should document matters which are important in providing evidence to support the report of factual findings. Now, in your report, you have provided that these are the factual findings related to agreed upon engagement, right? Now, to prove that these are the findings that you have found, you need to maintain a documentation, okay, to prove that these are the actual factual findings. So that is SRS 4400. Very simple, right? Yes. See, here you just need to understand what is the related service engagement. Related service engagement are those engagements other than assurance engagements, and there are various types of related services, but these SRS series deals with two aspects. One is agreed upon procedure engagement. What is agreed upon procedure engagement? The example I have given. Next one is compilation engagement. Compilation engagement means preparation of financial statements. Now SRS 4410 we will see compilation engagement. See, in this compilation engagement, the chartered accountant, he will be appointed to help the management in preparation of financial statements as per the applicable financial reporting framework, because management, they might not be having the knowledge related to applicable financial reporting framework, so they will take the help of the chartered accountant. See, another point, management, it is not mandatory, that it is not compulsory that management has to appoint only chartered accountant for performing these compilation engagement. Management can appoint any person, even a non-chartered accountant can be appointed to compile the financial statements. Okay, if non-chartered accountant is appointed, it is not mandatory for that non-chartered accountant to comply with this SRS 4410. See, if he complies, it is well and good, but it is not mandatory on him. But if a chartered accountant is appointed to prepare the compilation, he must comply with SRS 4014, and he should also give a report on his compilation. Okay, let us see. What is a compilation engagement? Compilation engagement is an engagement to assist whom? Management. For why? Preparation and presentation of financial statements as per applicable financial reporting framework. Now, compilation engagement is not a assurance engagement. Even this compilation engagement is not assurance engagement. You will not provide any opinion or assurance on these financial statements. You will just prepare these financial statements. Next, objective of SRS 4400. What is the objective of SRS 4400? Its objective is to just provide assistance to the management, okay, in applying accounting and financial reporting, in applying accounting and aspects discussed in financial reporting framework for preparation of financial statements, and report in accordance with the requirement of this SRS. Now, scope of compilation engagement. Basically, the scope of compilation engagement, it depends on the circumstances. Okay, it will vary depending on the circumstances, but the broadly you can say your scope is to assist the management. Okay, now management retains the responsibility. See, because of the fact that you have assisted the management for the preparation of financial statements, it doesn't mean that you will take up the responsibility for that financial statements. No, the final responsibility for that financial statements will still lie with management only. Okay, if there are any mistakes in the financial statements, if there are any misstatements, those responsibility lies with management only. Okay, the final responsibility for preparation of financial statements lies with management only. Next, ethical requirements. Here, the chartered accountant, he needs to comply with the code of ethics, the 5 fundamental principles, but however, independence is not required. Okay, that is with respect to ethical requirement. Next, engagement, acceptance and continuance. See, for accepting the engagement and continuing the engagement, the terms of the engagement has to be discussed with the management. Firstly, intended use and distribution. Okay, what is the intended use of these financial statements and to whom these financial statements will be distributed? Financial statements or financial information. And identification of applicable financial reporting framework. As per which applicable financial reporting framework I have to prepare the financial statements, that has to be agreed with the management, okay, in the terms of the engagement. Next, objective and scope of compilation. Objective and scope of compilation means, what is the objective? Will my objective will end just by preparing financial statements, or should I also help you when auditor asks you any doubts, right? During the auditor, he will get various doubts. So should I also help you in clarifying those doubts to the auditor? So what is my scope in this engagement? Next, responsibilities of practitioner. What are the responsibilities of practitioner? And responsibilities of management for preparing financial statements, for establishment of internal controls, for accuracy and completion of records. See, for preparation of financial statements, the information, the records, the data has to be provided by management only. So that responsibility to provide information lies with management only. Next, judgments needed in preparation presentation of financial statements. See, while preparing financial statements, various judgments has to be taken. For example, debtors. So which debtor will turn doubtful and which will turn bad debt, the provision for that, all these are judgments, right? These judgments, they have to be made by the management only. That is the responsibility of management. Next, expected form and content of practitioner's report. After the compilation of financial statements, in which form and format the practitioner has to give report to the management, even that has to be agreed prior to hand itself. Next, performing the engagement. Now, how the practitioner he will perform the engagement? See, if you observe in this standard, we are not only in this standard, in SRS 4400 also we are using the term practitioner. We haven't used the term auditor. Okay, you have to use the term practitioner because non-CA can also be appointed to perform these engagements. Okay, so practitioner shall first of all obtain understanding of following. What are they? What is the entity's business and operation? And obtain understanding of applicable financial reporting framework. Okay, the requirements of applicable financial reporting framework. Then practitioner will compile the financial information and he shall discuss with management or those charged with governance significant judgments for which practitioner has provided assistance. Okay, if at all for any significant judgments practitioner has provided any assistance, that has to be discussed with management and those charged with governance, right? Next, prior to completion of engagement, practitioner shall read the compiled financial information. Okay, before completing the compilation and handing over them to the management, he has to once go through the entire financial statements that he has prepared. And if in the course of compilation engagement, practitioner becomes aware that records to documents, explanation or other information provided by management are incomplete or inaccurate. I have told you, the practitioner will prepare financial statements based on the data that the management provides. If a practitioner feels that the data that the management has given is incomplete or inaccurate or otherwise unsatisfactory, then practitioner shall bring that attention of the management. Okay, he needs to bring that fact to the attention of management, saying that management, the data that you have provided is inaccurate or incomplete. Now, if the practitioner is unable to complete the engagement because management has to fail to provide the records, see, after the practitioner has intimated the management, if management provides the correct data, then that is okay. If management fails to provide the correct data and because of that the practitioner is not able to complete the compilation of engagement, compilation of financial statements, then he shall withdraw from the engagement and inform management and those charged with governance reasons for such withdrawal. If practitioner becomes aware during the course of engagement that compiled financial information doesn't adequately refer to applicable financial reporting framework, see, after preparing the financial statements, those financial statements should refer to the applicable financial reporting framework, stating that these have been prepared as per the particular framework, and in the notes to accounts you have to refer applicable financial reporting framework. If such reference is not there, or amendments are required for compiled financial information not to be materially misstated, or compiled financial information is otherwise misleading, then the practitioner shall propose the appropriate amendments to management. Okay, if any of these three is there, then practitioner should ask the management to make appropriate amendments. If management declines to make the amendments, then practitioner obviously he will withdraw from the engagement. If management agrees to make the amendments, practitioner he will make the amendments because he has to help the management for compiling financial statements, right? So he will make the amendments. Next, if withdrawal is not possible, practitioner shall determine professional and legal responsibilities. If in case withdrawal from the engagement is not possible, then he has to determine professional and legal responsibilities that are applicable in the circumstance. Next, practitioner shall obtain an acknowledgement from management or those charged with governance as appropriate that they have taken responsibility for final version of compiled financial information. See, another important point, after preparing entire financial statements and giving them to the management, you have to take a written representation or an agreement from the management or those charged with governance that the responsibility for this final version of financial statements lies with management only. Okay, such an agreement has to be taken with the management, because in future there is a possibility that management might blame the practitioner, stating that you have prepared the financial statements, so it is your responsibility if any misstatements are there in the financial statement, right? So in order to avoid such type of situation, you have to take agreement with the management that I have prepared the financial statements, but I have prepared based on instructions that you have given, so the responsibility for this final version will lie with you only. I am not responsible for this final version of financial statement. Such an agreement has to be taken. Next, practitioners report. Now the practitioner's report, it should clearly mention that I will not express any opinion. Okay, does not express any opinion on these financial statements. Next, the format will be title as usual, addressee. Next, statement that practitioner has compiled the financial statements based on information that the management has provided. Okay, you have to clearly mention that yes, I have compiled the financial statements, but how? Based on information that the management has provided. Okay, I have not generated any new information. Next, description of responsibilities of management. You have to describe what is the responsibility of management. Next, you need to identify as per which applicable financial reporting framework you have compiled these financial statements. Next, identification of financial information and title of each statement that you have compiled. Next, description of practitioner responsibilities along with the responsibility of practitioner to comply with this SRS. Okay, you need to state that while compiling financial information, I have complied with this standard on related service. Next, explanation that since the compilation engagement is not assurance engagement, the auditor does not provide any, the practitioner doesn't provide any opinion. Okay, he doesn't provide any audit opinion. Next, if financial information is prepared using special purpose financial reporting framework, then you need to describe the purpose for which financial information is prepared and if necessary intended users, or contains a reference to note in the financial information that discloses this information. Okay, if these financial information has been prepared based on special purpose financial reporting framework, then practitioner's report should clearly mention what is the intended use of this information and who are the intended users. This should be clearly mentioned. If in case these two are not clearly mentioned in the practitioner's report, at least reference has to be given in the practitioner's report to the place where this information can be found in the financial information. And next, draw the attention of readers of the report to the fact that financial information is prepared in accordance with special purpose financial reporting framework. Okay, next, date of the practitioner's report, practitioner signature and place of signature. Next, engagement level quality control. The engagement partner shall take the responsibility for overall quality of compilation engagement and engagement being performed in accordance with firm's quality control policies. Okay, the engagement level quality control lies with, the responsibility for this lies with engagement partner himself. Okay, management is not responsible for this quality control. Okay, next, documentation. What has to be documented by you in this engagement? The practitioner shall document significant matters arising during the compilation. Next, a record of how compiled financial information reconciles with the underlying records, and a copy of final version of compiled financial information. All these needs to be documented. Okay, now if you see in this entire discussion of the standard, either SRS 4400 or SRS 4410, if you observed, I have completed the revision by just reading the points that are highlighted in red. Okay, so the advantage of this audit concise book is that before examination you can just go through all the points that are marked in red and you can complete your revision. Okay, so I hope you understood the two standards. The revision of these two standards gets completed. In the next revision class we'll meet with another chapter. Until then, take care, bye bye, see you.